countries in Eurasia and other regions followed a similar path of reform. The expectation was that these reforms would not only improve for the social security of covered population, but also provide positive impact on the country's economic and financial performance. Since then, a wide number of changes have been introduced in national pension models to improve its effectiveness and efficiency. Some countries like Kazakhstan had succeeded more in their journey, while others may not. But all lessons in implementation will be useful for us moving forward. Our roundtable will offer a unique platform for everyone, for the expert, policymakers, and stakeholders from around the world to exchange insights
y en todo el mundo para intercambiar la experiencia.
We have with us distinguished experts, including representatives from institutions such as ISA, ILO, World Bank, the Organization for Economic Cooperation and Development, OECD, International Organization of Pension Survivors, International Federation of Pension Fund Administrators, and those from the private sector enrich our discussion on pensions. Together, we can explore innovative solutions, harness technology, and ensure that pension schemes remain robust, adaptable, and responsive to the changing needs of our societies. In particular, the high-level roundtable compliance, investment, service delivery, and communication in social security. Therefore, I envision that this event will serve as a milestone not only for Kazakhstan, but for the global community interested in the development of the pension system. Once again, I extend my warmest welcome to all participants as we embark on this discussion. I encourage you all to share your perspectives, ideas, innovative solutions. Your voice on social security matters. So together, let us shape the future of pension and social security, ensuring a secure and prosperous future for generations to come. With that, thank you for your kind attention. I hope for a fruitful discussion with everyone.
Y espero tener la cooperación con ustedes. Muchas gracias. Muchas gracias, doctor Asman. Y señor viceministro, quería darle la palabra. Estimados colegas, señoras y señores, quería dar las gracias al señor Sandos y Ina Leonida también, y señor Marchenko, y quería expresar la gratitud también por todos por organizar este evento. Quería también agradecer a todos los consultores internacionales que participan en este evento y también expresar la gratitud a los organizadores. Quería leer, señores participantes de la conferencia, en nombre del Gobierno de la República de Kazajstán, quería dar
contributors has simplified the procedures for concluding pension agreements, and a number of services have been transferred online. I would also note that the coverage by pension system of the contributors also expanded. However, the negative consequences, of course, were also, we had also experienced the negative consequences as a result of this reform. First of all, the abandonment of private management companies led to a lack of competition in the pension services market. We lost the whole class of institutional investors at our local domestic market. Also, the rights of investors to choose the strategy for managing their pension savings was also lost. Equally significant problem was a decline in activity at the secondary stock market due to the departure of this entire class of institutional investors. The National Bank, choosing a moderately conservative policy, mainly invested in government securities, bonds of quasi-public sector in the primary market. Therefore, in January 2021, after quite a long consultations with the market, we decided to make amendments to our pension legislation, and we provided the right to our citizens to transfer excessive part of their pension savings to the management of private management companies. This excessive part is basically the amount of pension savings above the minimum sufficient threshold. It is calculated annually for each age, takes into account the indexation of future pension payments, pension contributions, and is set in an amount sufficient to ensure an adequate level of pension and of income once the person reaches his retirement age. Investors who have entered into pension annuity agreements with insurance companies, providing them with lifelong annuity payments within the limits of the balance of pension savings in the unified pension funds, were also given the right to transfer their pension savings to be privately managed. In total, as of beginning of 2021, with a total amount pension savings of 13 trillion tenge, the amount which exceeded the minimum threshold amounted to about 3 trillion tenge. The shortcomings of the previous model were taken into account when we improved the approaches to current system of private management of pension assets in order to ensure a unified system for assessing pension assets which were under the management of the National Bank and which were given to the private management companies. The personalized accounting of pension savings was retained by the single pension fund. At the same time, the private management company manages the pool of pension assets transferred to it from the unified pension fund. The adopted model for managing pension assets is based on the choice of the investor. The right to choose the manager, the investment strategy. Investors also receive the right to participate in the management of pension savings by choosing alternative investment policy for their savings and receiving a return that corresponds to the level of their risk appetite. If the contributor to pension fund prefers a more conservative management policy, he can leave his pension savings under the management of the National Bank. In this case, there will be a state guarantee for the safety of savings from inflation when the investor retires. When deciding to transfer pension savings to private management, the single pension fund depositor has the right to choose one or more management companies, and he has the right to change the company once a year. The selection of a company transfer of pension savings to its management is carried out by the investor electronically through the Unified Pension Fund website. Quantitative and qualitative criteria are established for a company who can manage pension assets, so not all asset management companies were allowed to manage pension assets. Currently, only 5 companies has this right. We're currently liberalizing the regulations, and we expect that 4 more asset management companies will be allowed to manage private pension assets of our citizens. The investment strategy is determined by the management company independently. It takes into account regulators' requirement for the list of financial instruments which are allowed for acquisition and also the requirements for portfolio diversification. So the list includes a wide range of financial instruments,
savings to private management. Conditions are created and work is underway to localize foreign management companies in order to expand the contributors' choice when transferring pension assets. In the future, the National Bank plans to continue the work on active investment of pension assets on market conditions in the economy of Kazakhstan, maintaining the share of foreign currency assets at the level at least of 30%. Diversification of investment in foreign markets, including by attracting new foreign management companies. Also, together with the state authorities, it's a plan to continue measures to increase the involvement of contributors in the formation of future pensions and the development of the Institute of Private Management Companies. Thank you for your attention.
Thank you. Mr. Bakhudjan Sagintayev, Minister of the Eurasian Economic
Association for inviting me into discussing the issues of into the relevance of the issues concerned with the optimal and sustainable models of pension system capable of guaranteeing pension savings of citizens and their well-being, which is one of the most important directions of social. The pension systems are pension system in many states are coming through this stage of establishment and development. Why? And hence why this is most important to study both positive and negative experience of pension reforms of other countries. And having such an international roundtable dedicated to the issues of pension system development is an important event, since such platforms give an opportunity to exchange experience and knowledge between experts of various countries and most important, contribute to developing efficient solutions in this field. The 25th year anniversary of the accumulated pension system of the Republic of Kazakhstan serves an evidence of the eligibility of the pension system as a success of the actions taken on development of institution and modernization. Kazakhstan is a member of the Eurasian Economic Union, within the framework of which a unified market for commodities, services, and capitals and labor resources is established, as well as establishing conditions for stable development of the economy of the member countries. In this regard, one of the key directions of development of the integration within the Union framework is the elimination of barriers in moving the workforce, and the unified market functioning of labor resources provides sustainability and compatibility of the member countries' economies. From the moment of the functioning of Eurasian Economic Union, a growth of volumes of labor migration is noted in the integration space, which was only suspended in COVID 2020. For example, in 2020, the amount of workers who were working in other countries of the Union was about 500,000 people. And in 2021, we see the growth in this indicator of around 30%, up to 640,000 people. And it reached an indicator of 740,000 of labor contracts. The positive dynamics of labor migration within the EAU countries sets the priority of the issues of implementation of their labor and social guarantees, including their pension rights. Issues of social and pension provision plays an important role in the integration processes between EAU member countries, with the purpose of establishing single labor market in the EAU agreement, like the development of common policy in the field of labor migration, as well as providing social security, has been stipulated with account of their work experience, has been stipulated. As it has been known, the contract of the EAU agreement has stipulated preferences for workers and the members of their families in the country they are working, which refers, among others, social security provided on the same conditions and in the same procedure that is which it is done for the citizens of the country they work in. Previously, lack of the legal regulation of the issues of pension, of the pension provision for citizens of member countries who work in other countries of the Union was a barrier to establishing the common labor market. And in this concern, the EU agreement has stipulated a standard on regulating the pension provision for the workers from the member countries and members of their families by a separate international agreement between them. The heads of the EAU member countries have signed an agreement on pension provision for workers of the citizens of member countries on 20th of December 2019, which became valid as of 1st of January 2021. With adoption of the agreement, the workers of the member countries of the Union and members of their families have acquired equal rights in the field of pension provision, which are being generated, safeguarded, and implemented on the same condition and in the same procedure as it is done for the citizens of the country they work in. The agreement has provided availability of pension provision, the extension of the pension provision coverage, providing equal rights for pension provision, establishing pension rights in the member country and the territory of which the labor activity is being implemented, regardless of the status of people at this, who are residing at this territory, and also the allocation of the member countries to generating the pension rights by the citizens. For the purpose of practical application of the agreement standards, a procedure of interaction of the competent agencies of member countries has been established. The acting agreement has a positive impact on the level of social protection of member country citizens. Nonetheless, there are nuances in the implementation of this agreement. The fact that there are various different pension systems operating in the countries of the Eurasian Economic Union, solidar system in the Republic of Belarus, funded in the Republic of Armenia and Kazakhstan, and combined in Kyrgyzstan and Russian Federation. And the main difference lies in the different approaches to funding pension system and distribution of pension assets. Apart from that, the system of pension provision are different structurally by pension age, the conditions of the emergence of right for pension, its amount, and sources of pension payments and other parameters. Hence, many problem issues arise concerned with the implementation of the agreement, therefore we're actively cooperating and are ready to develop the pension system further. Thank you very much. Thank you very much, Bakhajan Mirullah.
Of Financiers of Kazakhstan. Please take the floor.
Dear ladies and gentlemen, dear colleagues, I'm glad to be here today and meet people who introduced the basic principles of the private pension system in Kazakhstan 25 years ago. The semi-jabble of the reform is the right moment to analyze the previous ups and downs of the pension system outside the desired future development and the role of private pension asset manager. Let me show you some figures. To start, it is worth mentioning that we had literally no better option other than introduced an accumulated pension system since the previous pay-as-you-go system collapsed in 1997. The old system's main features include state monopoly, the absence of personal responsibility for well-being in old age, and distribution of the pension funds within the system.
Due to changes in population structure and level of income, it became impossible to distribute enough funds to provide for decent pension benefits. The main principle started in the concept of accumulative pension system adopted in May 1997, where personal responsibility of citizens for the retirement savings, efficiency of investment along with safety of funds. Citizens will provide the right to make pension contributions to the state or private pension funds on their own choice. We will see later that people understood the advantages of such system and the range of possibilities to increase their saving and investment income. However, in 2014, the new concept was adopted, which eliminated private pension funds, pension asset management companies, and had paternalistic nature with prevailing state control. The new concept, focused on provision of minimum pension guarantees and introduced the notional element of pension system, which is in fact the reintroduction of solidarity element of pension. This notional defined contribution has not yet been implemented and are expected to be mandatory from the 1st of January next year. Such non-personalized contributions will be demotivating both employees and employers. Given the following concentration of the pension assets, lost interest from citizens, and signs of sliding to solidarity system, it was a matter of time when exotic ideas like early withdrawals for real estate will be proposed. But we have also two good news. First, citizens understood that pension assets belong to them, and they should be able to control it. And second, private asset management was reintroduced. As we will see later, the transfer to private asset management is still extremely modest, but our experience and statistics shows that it is the most effective way to ensure the decent income after retirement. If you look at the slide, you will see the rise of participation ratio and asset accumulation for the period from 2005 to mid-2023. Unfortunately, there is no available statistics for earlier dates, but these figures are enough to understand the trend. As we see, the pension system met its goals to accumulate assets with amount, right now it's nearly 16 trillion tenge on the 1st of September. In relative terms, the system participants represent more than 55% of total population. Two spikes on the chart reflect the first, the introduction of unified pension fund, and most likely is due to some double counting, which has been cleared later. And COVID payments to citizens made on provision of a small payment of pension contribution to prove the employment. The positive interim results of our pension system are proved by the fact that although the proportion of pensioners to employed population during 18 years increased for 29 basic points, the share of pension paid from the budget substantially decreased for 40 basic points. By the way, the average nominal state pension increased 8 times. And right now, accumulated pension assets reached 12.6% of our GDP, which is twice more than in 2005. As a part of national wealth, pension assets are also increased nearly symmetrically in the total amount of deposits of individuals with banks. We also witness different discussions whether the accumulative system provides for enough benefits. This chart clearly indicates that we cannot judge yet. To estimate the results, we should be able to observe the full cycle of employment and making personal contribution, provided the system does not experience any extraordinary occasions, not our case. You see the 2022 real estate withdrawals from their systems, which are totally not in line with the ordinary course of things. And it is quite likely that this year we will see some similar picture. To change this trend, we should convince people that their funds are invested effectively and no more unexpected ideas will be introduced. What are the results of all the above at a glance? Understanding that making any conclusions on the basis of average number regarding pension asset, it is not quite correct because of different participation period and contribution made. However, we made such exercise to see the average pension saving per participant and his investment income. The results generally follow the twist of our pension system development. The average pension savings are growing steadily, with the exception in 2022 because of the large withdrawals for real estate, as we see from the previous slide. And the chart of investment income show much more clear dynamics. With minor downturn in 2008, average investment income rose sharply, driven by private asset managers. The first peak coincides with the merger of all pension assets to unified pension funds. The next slide. The slide illustrates one of the disadvantages of centralized pension asset management. The obvious prevalence of monetary and fiscal policies accounts for the share of government securities and conflicts with the goal to increase investment income to system participants. The rising share of government securities before the merger is also due to the changes in regulation of the pension asset managers. Having said all that, it is important to appreciate all recent improvements and identify the ultimate objective to all our future reforms. I think we all agree that our main objective is to have the sustainable private pension system management with a range of different investment strategies, strictly in the interest of system participants, closely monitored by them, and under reasonable control of the regulator. Any notional or solidary contribution should be eliminated. Social benefits and assistance should be paid directly from the budget and not by other pension system participants. We are far from that yet. Due to not the best timing in terms of reintroduction of private management, the proportion of privately managed assets is tiny, 0.05%. However, the results of the 1st of July this year are promising, though the regulation is far from optimal yet. 4 out of 5 asset managers show better results than the National Bank, despite small assets. This observation also highlights another task. It is necessary to align the requirement for both private asset managers and the National Bank in terms of compensation for the losses, regulation, and control in their role of asset manager. Obvious benefits will be trust of citizens, regular contributions, substantial pension benefits for those who made contribution, and less burden on the budget. The government will be able to grant more support to those who really need it, instead of providing a thin layer of assistance to all in their old age. I am sure we will have more interesting exchange of knowledge and expertise during the conference today, which will help us with new ideas to improve the pension system and follow our objectives. Thank you very much for attention.
Thank you. I would like to thank all our honorable speakers for their excellent presentations and their deep view on the problems and prospects to be resolved in our accumulation pension system. Of course, pension system is a part of our economy and actually is a mirror of our labor market. That is why all these issues that we are discussing right now are very important for further development of our economy and our social policy. Let me further have you immersed into our accumulation pension system in Kazakhstan. And you know that in Kazakhstan we have a multi-pillar pension system. In general, the system consists of two main components. First component, state pensions, pay-as-you-go and basic, paid from the budget. And the second component, accumulation pensions paid from individual pension savings. The second component was introduced 25 years ago and forms fully funded defined contribution pension system independent from the state budget. Why accumulation pension system is important for Kazakhstan? Let me show you some demography data. Demography shows that Kazakhstan population is aging. In 1990, you see the pyramid. We see almost normal demography pyramid, except some decrease in population aged from 52 to 59 due to the Kazakh famine in 1930s. And population in aged from 45 to 49 due to small cohort born during the Second World War. Next pyramid. So next pyramid. In 2000, we see decrease in children population up to 9 years old due to small cohort born in 1990s and early 2000s after the collapse of the Soviet Union. Then in 2021, we see consequences of the above events for young population of 15-24 years old. And finally, in 2050, this is a forecast, we expect the so-called demographic echo. So we see the decline in population of 15-24 years old due to less children born from small cohort of their parents who will be approaching the pension age. So you see that demography is very important for further forecasts of pension development. And actually we can study our history by analyzing these pyramids. So you see that we have the same tendencies as in other countries, and Kazakhstan population is aging due to two main factors. The first one is declining birth rates. We are in a better situation compared to many other countries, but nevertheless, we are expecting decline in fertility rates from 3.32 to 2.42. Globally, the fertility rate is currently 2.32, and the decline will be by 2050 up to 2.15. And also we have another factor, increasing life expectancy. According to United Nations and our forecasts, our actual calculations, by 2050, Kazakhstan will have decrease both in younger population, the first diagram, and decrease in the working age population, the second diagram. At the same time, we see on the third diagram steady increase in the elderly population, 65 plus years old. So we can emphasize that actually our population will continue aging, and that this will make some influence on our pension system. Potential support ratio. Let me remind you what is potential support ratio. Is the number of people aged from 15 to 64 per one person aged 65 plus. So this ratio describes the burden on the working population, but non-working elderly population. And as population ages, the potential support ratio tends to fall. So in Kazakhstan, we see that this is the case, and diagram shows that potential support.
Бұл диаграммада келтірілгендей, мұнда 1998 жылы бізде пикке жеткенімізді көріп отырмыз. Сол жақтағы диаграмма қарайтын болсаңыздар, және халықтың саны адам басына шаққанда 65 плюс жастағы адамдардың көрсеткіші келтірілген. Біріккен ұлттар ұйымының болжамына келетін болсақ, 1998 жыл.
We have a basic pension, actually demo grant, paid from the state budget. In 2014, we introduced occupational pension based on compulsory 5% employers' contribution in favor of workers employed in hazardous conditions. In 2016, military and civil servants' pensions coverage was returned to the state budget. And in 2024, additional notional pension based on compulsory employers' contributions up to 5% rate of contribution by 2028 will be gradually introduced. Let me show you some key indicators regarding our accumulation pension system. So the first diagram, top left, you see shows that the growth of pension savings in total. Currently, they exceed $35 billion, about 15% of GDP. And what is important that 37% of savings, so more than 1/3, consist of accumulated investment income. Second diagram, top right, shows steady growth of number of accumulation pension system participants, and total quantity of the individual accounts is about 11 million. And contributors as percentage of working age population comprise from 91 to 95%. Diagram 3, bottom left, shows the total number of active contributors exceed 7 million people. And density of contributions show that 76% of contributors, so 3 of 4, make from 6 to 12 contributions per year. In 2022, average density of contributions was 8.5 contributions per year. And finally, diagram 4, bottom right, shows steady growth of number of beneficiaries, receivers of their savings. Retirees use 3 options. The main option is program withdrawals, almost 90% of payments, and other 10% include lump sum and pension annuity payments. So you see from this diagram that actually dynamics of the accumulation pension system is quite good, and the main problem emphasized as follows. We have still low labor income of our employees, formal or informal, which leads to low contributions, to low savings, and hence to low pensions. Investment return on pension assets always attract high attention. So on diagram on the top shows return versus inflation during 25 years. So you see that, so blue line, the 2-digit inflation was in 1999, Russian crisis. In 2000, 2007, prior to the world financial crisis. In 2015, total turbulence. And in 2022, confrontations and sanctions. In most of the years, rate of return exceeded rate of inflation. As a result, accumulated return since the beginning of pension reform equals 732% and exceeded accumulated inflation. Diagram 2, bottom left, shows the high quality of pension asset portfolio. About 93% of investments are high rated, from BBB- to AAA. And in addition to this, we have a very important norm for our contributors. So in Kazakhstan, the government guarantees pension savings managed by the National Bank of Kazakhstan for all contributors against accumulated inflation and automatically pays the difference upon contributors' retirement. Let me pay attention to the figure top right. This figure shows that in 2022, the pay-as-you-go state pension, red line, comprises the main component, 25% of total replacement ratio, which is 45%. But in the future, the role of state pension, pay-as-you-go and basic, tends to decrease if nothing changes. So you see red and yellow lines. Whereas accumulation pension, green line, shows steady growth and after 2040 may become the main component in total replacement ratio. By 2030, the state pension needs adequate parameterization, and therefore it's good that the Minister of Labor have plans, along with the World Bank recommendations, to have minimum salary linked to 50% of median salary as an important state social pension parameter to be used. Since 2014, we have a unified pension fund which works as a single pension infrastructural institutions, both social and financial. The fund provides one-stop service, customer inclusion, centralized database, single asset valuation. Total administrative costs in pension system significantly decrease. So we have no duplicate accounts and regional branches, no agent fees, etc. So the fund is fully integrated with the state authorities, infrastructural institutions, market participants, banks, insurers, asset managers, custodians. So actually we are not competing with market participants. We work with them, collaborate with them, and doing the same work. As a result, figure shows that in Kazakhstan, total efficient fees in pension system is much lower than in other relevant countries. Total staff in accumulation pension system decreased 8 times since 2012, from 12,000 to 1,500. As for total expenses, they decreased 2 times, from 25 billion to 12 billion, despite of inflation. This slide diagram shows that the number of pension services, these services increased during 5 years from 19 million in 2017 to 30 million in 2022. Share of face-to-face services in regional offices decreased twice, from 33% in 2017 to only 5% in 2022. About 95% of services are electronic and automated. It was especially important in pandemic. All accounts are automatically opening with first incoming contribution. Customers have access to personal accounts and services 24/7 using website or mobile applications. So in general, for example, if your assets are invested today, tomorrow you can see the results of these investments, the investment return, using your application. This is very important for our customers, contributors, and interest to the pension savings increase highly. And also financial literacy is growing quite well. And actually, we believe that these practical issues which our customers meet on the market accelerate the financial literacy a lot. And so in 2022, ESA granted to our fund Good Practice Award among 96 European organizations for extending pension coverage via equal access, information and communication technology, and raising public awareness. And finally, about the prospects, I would like just to mention that in the coming year, 2024, our fund will open more than 6.5 million personal accounts for all children in Kazakhstan to accumulate the savings transferred annually from the National Oil Fund of Kazakhstan, 50% of annual investment income. And as a result, we expect that almost all citizens of Kazakhstan may become our customers. But this is another story. Thank you for your attention. Dear conference participants, we actually finished ahead of our schedule. So we have more than 15 minutes for questions and answers. And so just please, if you have any questions to our honorable speakers, please address your questions to them. Thank you.
The speaker is inaudible. Oh, finally, thank you. So all participants need 65 trillion tenge. So the system essentially is experiencing a deficit, at least 3/4 deficit. And this hall mostly hosts people who were born in 1980. So in 20 years' time, they will attain their retirement age. So they will have like basic pension. So it's around 40,000 tenge. And all the rest is supposed to come from this accumulative system. And it is understood that this accumulated system shall conform to that. So the question is, how will this challenge be solved? So how will the regularity of regular participation of contributors, take part in that? So, I have my pension by my experience, by my service age, but others will not have it. So when those private pension funds were liquidated, that were actively funding the banks, the financial system, and the financial system had loan money to credit the economy. Now you, Mr. Tutushkin, as the representative of NBK, you manages the CNPF, and you have 16% of those, and there is some portion that private management fund has, but you have 65% in government securities. So the question is, is it an adequate portfolio breakdown? Because you've taken it from the private managers, but I don't represent the bank, but here we talk about employment and labor, so it's all related. So this is the question for Mr. Tutushkin. And the question for Madam Abulkasimova. So most of the people transfer their funds to annuity companies, and I really don't understand what actuarial calculations they use, because they have the survival rate or the life expectancy rate, and I understand that the annuity system is for those who survived their pension contributions, and they use the money of those who did not reach that age. So if we have 30-year period, so the question is who actually live for 30 years once they retire, they reach their retirement age. So even though we don't take into account those actuarial calculations, that actually is reflected in the pension rate, because even with annuity, the pension payments will not be large. So thank you for the question. So if you've listened tightly, there was the slide that shows the actors or the participants of the pension system. If we take a look at the employees, so we reach a total around 8 million, and 96% of them are part-up contributors, and most of them actually make their pension contributions within 9 to 12 month period, so no problem with that.
So we have an issue with the self-employed population that is working in informal sectors of economy, and it is concerned this year with participation of our colleagues, the International Labour Organization, and the representative of the World Bank. So we've worked together and said that we need to simplify the opportunity for registration and participation of these category of people in the social security and the pension system, because as you have maybe mentioned, that we've introduced a concept of independent employee. So basically this could be an individual who is not registered anywhere, but he could or she could participate on an online platform. His public contract and which has been concluded. So if the platform operator would transfer the funds, he would be considered that he's a participant of the pension system. This is one thing regarding the self-employed people. And the second part is that we have introduced a unified payment for micro and macro business. And I think right now, by results of the first 6 months, we would see first changes. The most important for us is to start working on coverage of the self-employed population and the implementation of an awareness campaign to clarify the importance of participating in the pension system and social security system. And the second part, as for the individuals who were born or participating in the accumulative funded pension system. So my colleagues have said that starting 1st January next year, we would have a standard in place. The employer would start contributing a mandatory pension payments in favor of the employers. You know that we work a lot with the employers. A lot of issues has been raised, and many stated that this would lead to the extension of informal economy and the growth of salary. But together with our colleagues, we have shown that throughout all the world there are 3 participants of the pension system: is the employee, employer, and the state. So the responsibility should be distributed. And for the first time throughout the last 6-7 years working with employers, we've came to that they would start contributing 1.5%, and to 2028 is going to be 8%. So in order to avoid problems that we have felt since 1998 to 2005, somebody participates in the pension system for 3 years, somebody for 5. So they have other the issues concerned with salary and other, but that the period of the lesser period of participation also affected the amount of their pensions. In order to avoid that, we've decided that so basically the employers would contribute for those who were born after 1975. So so by 2041 for females and in 2043 for males, they would have at least 20 years of job experience and accumulated funds. So with account of the return that is going to be provided by the financial institution, I hope that it would provide some tangible results. Yes, we have came to a period where the main pension should be paid from the funded system, and now, since despite that next year we're starting these contributions, so we've said that this is the funded system, and but when concerned with the fact that we're not paying it yet, an issue would be considered whether that is going to be we would have a funded system, or that would be actuary system from the point of view of the funded system. And I would like to draw attention that the accumulated pensions that are being paid to every citizen of retired citizen of Kazakhstan, more than 80% are are funded by the state. So around 12-15% are they come from funded pension. But here the period of participation and what has been shown, so the wave that we're dealing with concerned with our economic issues. So young people, same as we have it today, they would have 3 kinds of pensions, but we have to understand that it would depend on how would we be present in the system, how regularly we would contribute to the system, and the amount of pensions would depend on the income that they from which they transfer this, make this contribution from. Thank you for very much for your question. So I would start with the fact that the National Bank is a conservative investor in contrast to the private pension funds. So our investments stipulate minimum level of risks. So these are usually financial instruments with higher rating. And overall, I would like to know that there are no restrictions on investing the UAPF assets into corporate bonds are lacking in the investment strategy. So that there is such an opportunity. The thing is that maybe there are no securities that meet the criteria set by the National Bank. But this year, we are changing. We're making changes into our policy that would stipulate that we would make an emphasis on purchasing banks' bonds, and this year, next year, the UAPF portfolio in part of bonds would be extended. Thank you, so regarding the pension annuities, I think it is important, what I said in my presentation, is the cost. So basically, the cost of the pension annuity is not just made with actuary settlements on the endowment. It also depends on return. So in 2021, we have decreased the return, and we have increased the indexation on the income. So it's a guaranteed return that is being made a part of the calculation for actuary calculations, and it includes the inflation of 7.5%, and the cost of pension annuity decreased by 40%, which makes this instrument more available. And what it provides, the most important that you have mentioned, so when you have accumulated savings in the UAPF with with low income individual, and this individual can get only the amount that he or she has accumulated until he would run out of money. The advantage of the pension annuity is that it's guaranteed throughout your life, and with account of the endowment period, it has been calculated, and the payments would be guaranteed from the insurance accumulating system. I think that's a big advantage. The issue was raised that very often, even people who would like to use and have pension annuity had insufficient savings, and now we have joint annuity. So, and right now, a wife and a husband, they can basically purchase this joint annuity, which provides these advantages. Thank you.
Any other questions? Please, if you have any questions, raise your hand. If not, so let me thank our honorable speakers for their presentations. So we have more time for a break, and we start at 11 o'clock, and we're looking forward to having 4 sessions, and actually all other presentations will be from our international experts. So 20 excellent presentations. Please stay focused and attend the discussions to be arranged by our honorable moderator. Thank you.
Английский язык. 1, 2, 3. 1, 2, 3. Английский язык. Английский язык. 1, 2, 3. 1, 2, 3. 1, 2, 3. Есть? Есть? Нету? Нету. Один, два, три. 1, 2, 3. 2, 3, 1, 2, 3. Говорю на английском. 1, 2, 3. Английский есть? Есть, да?
Құрметті ханымдар мен мырзалар, келесі сессия 3 минуттың ішінде басталады. Өтінемін, өз орындарыңызға өтіңіз.
Attention, ladies and gentlemen, we are about to start our first panel session. Please proceed to your seats.
Because we have online speakers, they can see us all in that broad area. So we decided that we should make a compact formation so it would be easier for them to see us. So let's start. We have a first working session. The formal presentations are over. And we have several very good speakers from different international organizations and several countries. I would like to remind those who know something about pension system in Kazakhstan that it was very much influenced by a seminal book by the World Bank, Averting the Old Age Crisis, which was published in the early 90s. And one of the employees of the World Bank, Dmitry Vitas, who played a substantial role, he published an article called Swiss Chilean Poor. And in that article he was arguing, but that was over 30 years ago, that the optimal pension system would be a combination of elements from the pension systems of three countries, Switzerland, Chile, and Singapore. And our idea was to have in this session representatives describing pension system of Chile, Singapore, and Switzerland, but unfortunately Singapore delegation didn't arrive. But we still have two speakers from the relevant countries. But the first speaker is Mrs. Himanshi Jain from the World Bank, Senior Social Protection Specialist, who would make a broad presentation about the development of pension systems over the world, lessons from pension history, and I would like to give the word to her. Thank you. Please go on. I don't know. Okay. Please go forward. Proceed.
Great. So my warm greetings to dignitaries, delegates, and my fellow speakers. Thanks a lot for inviting me to this session. So in my presentation today, I'll first walk you through the global history of pensions across regions. I split them into 4 eras, and as you can imagine, through these 4 eras, there have been conflict, crisis, and most recently the pandemic that we witnessed globally. Next, I'll talk about the multi-pillar framework, which moderator just alluded to, and a more recent framing by the World Bank under our Protecting All white paper that was released last year. Lastly, I'll leave you with a very practical methodology that we found useful when analyzing pension systems. And I especially want you to leave with this methodology because sometimes pensions can be such a heated topic that we stop seeing the forest for the trees. So it stops looking at the big picture and focus too much on the design. So I hope this starts a conversation more broadly on the big picture issues. So to begin on the historical perspective, this slide is a nice reminder of how far we have come globally in the pensions journey. The gentleman on the left side, Otto von Bismarck, is known as the father of contributory pensions as we know it today. And increasingly on the right-hand side is what I'm trying to depict as the fintech in the pension space, which is becoming increasingly common. So talking about the 4 eras, as I split the discussion in history, the first era saw a rise of defined benefit schemes across much of Europe and America. I hear some echo, but I hope it's not an issue at your end. This era also witnessed the world wars, and towards the end of this era, what started happening is an emergence of concerns around the sustainability of defined benefit schemes. Countries in Asia and Africa also started becoming independent around the first era, and they started taking on the DB schemes from colonial times. So that's how the first era, the rise of growing concerns around sustainability. Especially because in this of penicillin, there was a huge increase in life expectancy. So that started creating challenges on sustainability of DBs. And what we saw is this shift to DC schemes, defined contribution schemes in LAC, in Europe and Central Asia, and UK, and you started seeing this emergence of hybrid schemes, a mix of DB and DP. Now, by the third era, the policy conversations once again started shifting. Developing countries started worrying about coverage, and OECD countries were increasingly concerned about sustainability, and some issues around adequacy started also emerging as these DC schemes were maturing and were not promising the replacement rates that were initially thought about. Now, fueled by these concerns, the third era started seeing significant parametric reforms to the defined benefit scheme. We saw some full or partial reversals on coverage has taken center stage. But also for the developed countries where traditionally there have been high rates of formal employment. So for example, in those instances as well, there's been a growth in non-standard gig economy, employment, etc. And as you can see from the right-hand side, there's a graph where we show the pension coverage globally between 1990 to 2015. And except for a few outlier countries, largely the story is that coverage has been very hard to grow. Alternatively, if we look at health insurance coverage, that has expanded a lot in emerging countries. And it has largely been because governments decided to heavily subsidize health insurance, and that led to a massive increase in coverage. But that same story has not been replicated in the pension space. COVID-19 pandemic has also been somewhat of a flashpoint for the pension policy, because it showed that depending only on payroll financed ways is probably not going to be sufficient given the pension coverage and adequacy goals of countries. So there's now a renewed conversation on how other sources, notably the consumption based sources of financing, can be used to complement the traditional payroll-based financing. So that's where we are on the history of pensions. The multi-pillar taxonomy of the World Bank in the 90s essentially introduced the idea of having zero, first, second, and the third pillar. I won't spend too much time because my sense is everyone is very familiar with this multi-pillar taxonomy. But essentially what this tried to do is make the case that you have different you need to use different instruments given different objectives. And the three core objectives are poverty protection, consumption smoothing, and ensuring longevity insurance. And those objectives still remain relevant. All pension systems, those are the primary objectives. Secondary objectives, of course, depending on the country, can be deepening financial markets, ensuring intergenerational equity. But at the core, I would say these are still the relevant objectives. So since 1990 to now, what have we learned and what is happening in the world? We are really living through a period of change where there's multiple disruptions that are hitting labor markets and are changing the nature of work. So oftentimes what is very commonly talked about is artificial intelligence and how technology is changing labor markets, but there's actually a host of changes that's affecting labor markets. And what all of this is leading to is more diverse and fluid forms of work than, say, were the expectations back in the 90s. So we feel the need to remain relevant, to revisit some of the foundational assumptions that were made, that were initially made and then now being challenged. So, for example, this idea that payroll is the only observable way, and that is not necessarily the case. With digitization, we are seeing increasingly that governments are able to observe other behaviors. The fact that you need a firm to intermediate between the state and the citizen, that is also not necessarily true. G2P or G2P payments directly from government to individuals is also transforming that space. And this notion that once you are in a job, you'll stay in that job for long periods of time, that's also being challenged increasingly. People are in and out of formal and informal employment, in and out of work. So there's really a need felt now, given the evolving world of work, the institutions, regulations, and interventions also need to change, and being rigid leads to issues. So what is, in 2022, so last year, the World Bank released the white paper, Protecting All, and this calls for a blurring of lines between social assistance and social insurance, and providing a comprehensive package of protection, paying particular attention to how these are financed. So, for example, at the core of this package is the guaranteed minimum protection. The way to think about this is it's the coverage against the biggest shocks, which, if left uncovered, are going to pose the greatest social losses. That should be financed with the broadest base tax revenues. The second is protections mandated through regulation, but it is individually financed. These are essentially risks which are important enough in terms of the size of the risk that the state should take some action, but they're common enough that it's reasonable to expect that individuals will also act on their own. On top of that layer, and I think of this as the layers of an onion, on top of that are the measures which are important enough for the state, and there should be regulations to nudge people, and the outermost is the purely voluntary, not leaving it to the individual. So this is how, in the context of the changing nature of work, we sort of rethinking the package of protection and clarifying how financing can play a role in thinking this through. So what does this really mean when it comes to implementation for countries? Essentially what you have, taking a stylistic example here, but a lot of countries have systems like what you see on the left. It's a fragmented social protection landscape where the poorest tend to be covered under non-contributory schemes. There's an exclusion for what we call the missed middle, and there's some protection, but it's not necessarily actually fair or adequate. And what one needs to do slowly is move to a more seamless sort of social protection continuum, which you see on the right-hand side, and this will look different for different countries. But the idea here is to blur the social insurance and assistance elements and taper it, because there's limitations on resources, and ensure there's seamlessness and coherence across these different benefits, so that you don't create disincentives to participate. I'm happy to share the link to the Protecting All paper, which has a lot more details on this new way of thinking about social protection. Just to end, like I said, I like the case methodology that we often use when analyzing pension systems. CASE really just stands for coverage, adequacy, sustainability, and equity. And the argument here is that it is important to look at all of these four aspects in the context of pension systems, so that you're not fixated on any one, because after all, pensions is all about trade-offs. And to do some things like these are some suggestive questions that one can ask. So for example, on coverage, try to look at both contributor and beneficiary coverage. Try to look at any areas where there's underreporting, there's a fall in contribution density, which was a big issue with countries like Chile. It was really the contribution density which was so low that it affected replacement rates. On the adequacy, so just walking you quickly over these, coverage, there are different ways of measuring these, but the point being, look at contributor coverage or beneficiary coverage and the density. Adequacy, again, it's about not just adequacy at the time of retirement, but also what is the adequacy during retirement, and indexation policies play a big role there. And oftentimes you're asked this question, what is an adequate pension? And I often respond to this question by asking the follow-up question, what is your objective in the pension system, and looking at what other needs of old adults are being met, say, through your health system or long-term care system or family support. The sustainability for defined benefit schemes, this is a much bigger question. The financial sustainability of DB schemes, funded pensions by definition are financially sustainable, but there's also a need to think about social sustainability, and that's a conversation sometimes we don't have because we're so fixated on the financial sustainability. And largely the equity aspect, what do systems mean for intergenerational equity, for intragenerational equity, and especially when we're talking of the blurring of lines, equity becomes a huge concern and often an overlooked piece, but very important to ensure social sustainability of pension reforms. With that, I hope I didn't exceed my time. I'm happy to get back to any questions in the discussion section, but that's it from my end. Over to you.
Okay, Himanji, thank you very much. I think we will have questions by the end of our session, and I see it's quite interesting and even fascinating that we have representatives from 3 major international organizations: World Bank, International Labour Organization, and International Social Security Association. And if you follow their presentations, they'll see that they see the future of pension systems quite differently. So I think it's a very useful type of, okay, I'm sorry, I didn't know if you heard me, Himanji. Thank you very much for your presentation. But I said that we have on our panel representatives from 3 major organizations, ILO, World Bank, and ISSA, and you all have quite different views on the future on the pension system. So I think that it's quite interesting to have meetings and roundtables like that, so that the people in our part of the world could take part in discussions of the future of the pension system. Our next speaker is Mr. Krum, the view of ILO on the current situation and also how ILO sees the future of the pension system. Please proceed, Krum.
Honorable Deputy Prime Minister, important event to share with you the ILO's perspective on the issues that gather us today, namely how to build universal, comprehensive, sustainable pension systems that provide adequate levels of protection. And I'll be giving you the standpoint, the viewpoint from the international social security standards adopted within the ILO and the guiding principles that are enshrined therein. As most of you know, let me just see if the slides work. Yes, as most of you know, when the ILO is asked to provide its advice and assistance, it places at its core the vision and the principles that the ILO constituents, the governments, the workers, the employers, have agreed to place in ILO's international labor standards. And if there is one thing I would like to retain from this presentation is that it would be that these standards are not a straitjacket. They actually are very flexible. They are able to adapt to each country and its national circumstances. However, they also establish certain red lines. These are meant to delimit what goes from what doesn't go. Of course, countries can go beyond and provide additional benefits and services that are based on different sets of principles. And actually, there are quite a few countries that do so. And I am going to give you a sense of how many they are and what they do and how they do it. However, as the ILO, our vision is that these additional mechanisms are just that, additional mechanisms, to provide additional protections, not a replacement for the solidarity-based mechanisms that constitute the core of social security and that observes the internationally agreed around the world how it looks like when it comes to income security in old age. And the first observation is that the situation is not as bad as one could have imagined. Protection in old age is the oldest branch of social security, but also the most widespread out there. The ILO was giving poverty as recognized also by the 2030 development agenda. Comparatively, pensions have always been at the top of the curve when looking at the branches of social security that have been established worldwide, but there has been an observed trend over the last years, and especially the 2 decades, to expand their non-contributory sides. Main models exist, and you all know that the Bismarckian one, where the protection is a function of the previous earnings, and the Beveridgean one, financed mostly through taxation. Of course, today no pension system is exclusively based on one or the other of these 2 models, but virtually all pension systems have elements of both operating in parallel so as to reach universal protection in old age. Social insurance schemes are often complemented by minimum or flat rate benefits for identified categories of the population, as well as means-tested social assistance mechanisms. It is only by either alone, but most often in combination with non-contributory ones, means-tested, universal, or categorical. Rare are the countries where only one mechanism is non-contributory and exists on its own. What we also observe is that with a presence in 90% of the countries, defined benefit schemes are by far the most common mechanism for providing protection in old age. Within these countries, the 90%, 16 also have DC, defined contribution schemes complementing the defined benefit one. Conversely, if we look at DC-only schemes, they are rather marginal and are found in about 7% of the countries worldwide. As far as NDC-only schemes, even more marginal because they represent only 3% of the countries out there. Over the last years, many countries, mostly developing ones, started boosting their non-contributory schemes in the quest of reaching universal social protection, but many questions regarding how to sustainably secure the adequacy of these pensions remain, and we therefore need to be conscious about the limits of extending these non-contributors, where only marginal parts of those in old age are actually protected, as you can see from the map, with Africa significantly lagging behind with an average rate of 27% of coverage only for those in old age. If we look at active contributors' side, however, the question gets more concerning, with only 32% of working population worldwide contributing to protection in old age. Again, this average masks important disparities between high and low-income countries and between the various continents. You see on this map that the number of countries in blue has diminished in comparison with the previous one, which looked at coverage of persons already in old age. This is, of course, a source of concern, as these people will be relying exclusively on tax-financed protection mechanisms once they reach old age, which creates significant constraints on public finances. Disparities in coverage are, of course, also reflected in disparities in old age expenditure, which is globally at around 7% of GDP, an average that also masks significant disparities between countries, expenditures going from 0.8% of GDP for low-income countries up to 11.3% on average of GDP in Western Europe, for example. Now that we have completed this overview, I want to us to dive into what is the architecture which has been agreed internationally to guide the building of pension systems. For most of you, it is not going to be a surprise that this architecture has been designed jointly by governments, employers, and workers within the ILO since 1919. They all decided at this date to give the ILO a clear mandate to develop international standards on this matter. Later, in 1948, the right to social security was recognized as a human right by the Universal Declaration, and with it, the right to protection in old age. And the ILO became the flag-bearer institution to guide countries as regards how to give effect to this human right through technical standards, establishing the life risks to be protected, which are these life risks, the minimum parameters of the protection to be provided, as well as the core principles that are the backbones on which national social security systems should be based. You have here on screen the main international instruments, starting with the flagship convention ILO Convention 102, setting the international minimum standard of social security, followed a few years later by two more advanced standards, Convention 128 and Recommendation 131 on old age, invalidity and survivors benefits, which remain faithful to the principles that Convention 102 established, but boosted the parameters of the protection to higher levels. The latest international instruments, Recommendation 202, expresses the dynamic vision of how to advance towards universal social protection in the 21st century and recognizes a new notion in the international legal order, that of national social protection floors for basic levels of protection as a fundamental component of national social protection systems. It is very important to stress here that Convention 102 sits at the basis of the entire international social security legal architecture. It is used internationally as the yardstick against which to measure how good or how bad social security systems are performing. It is not used also by the human rights bodies, even when countries have not formally ratified it. This is most certainly because Convention 102 is the only international instrument that defines social security by reference to what it should be providing in order to provide this protection. But maybe also because while it remains flexible, and we said Convention 102 established the 9 social risks that should be provided, it recognizes that countries can ratify it starting by ratifying 3 initially. The Convention also establishes a clear minimum set of quantitative and qualitative criteria for measuring whether the protection in old age is adequate or not. Concretely, it also establishes the principle that benefits need to be provided in the form of periodical payments the level at which they should be provided, and the necessity to revise them periodically. It also sets the minimum levels to be guaranteed throughout the contingent. For each social security benefit, ILO social security standards establish the minimum levels of adequacy through 5 main parameters. Firstly, they define what the risk that is covered needs to be defined, and what that risk should be, how that risk should be defined. Second question, what is the minimum coverage to be achieved by law and demonstrated in practice? Third question, what is the type of benefit to be provided and what should be the minimum level of this benefit? Fourth question, what should be the eligibility conditions? And fifth question, last question, how long should these benefits be paid for? Of course, having such clear benchmarks is good, and here you have an example of what Convention 102 defines as these parameters in the case of old age, with the definition of the contingency, with what should be the minimum number of persons protected, what should be the minimum that is established when in the case of earnings-related schemes, flat rate schemes, means-tested benefits, what is the minimum duration after which a pension should be served, and the principle that the pension needs. But of course, having these benchmarks is good, but having them circled by a number of core principles is even better. In 2020, when the ILO held a high-level tripartite roundtable on pensions and pension reform, 9 main principles recognized by ILO social security standards were identified as key to build effective and sustainable old age protection systems. You can see them here on screen, regrouped in a sort of temple of principles. At the top lies the principle of the overall and primary responsibility of the state. Here we recognize that only the state has the long-term vision that is necessitated, especially in the case of providing long-term benefits, such as old age pensions benefits. Of course, it means that the state cannot discharge themselves of this responsibility by, for example, delegating it to the administration of the pension system to the social partners, to private access, for example, but the state always bears and carries the responsibility, the ultimate responsibility for how the system performs, that the benefits are properly provided and that the system is properly administered. Then we have down below 3 main axes, 3 main pillars that give us the main strategic vectors that the state needs to pursue through their general and overall responsibility. The first one is to pursue the vector of universality, progressively reaching universal coverage. Of course, this can be achieved only by regulating and establishing entitlements guaranteed by law. This applies to who is protected, what should the benefits be, what are the situations that the benefits need to be provided under. Of course, universality also means having policies in place to avoid discrimination and rectify discrimination, and including securing gender equality. The second main axis is adequacy. Adequacy means that the benefits are sufficient. It means that they're predictable, set at predictable levels, and paid throughout the contingency, and in the case of old age, as long as a person lives. Adequacy also means needs to be related to economic, financial, and fiscal sustainability of the schemes. And this kind of sustainability is ensured, of course, by having the principle of social solidarity and collective financing, by pooling people and resources into the protection mechanisms. Sustainability is also ensured by making sure that there is transparent and accountable management, and including tripartite participation in the administration and the management of the schemes. Importantly, as you can see from this temple, there is no mention there about whether schemes need to be defined benefit or defined contribution type. And actually, international standards adopted within the ILO are agnostic when it comes to this question. However, these standards require that both defined benefit and defined contribution schemes need to abide by these principles and assure that the minimum benchmarks that they are established can be met. If they can meet these principles and these benchmarks, then the schemes are validated. We could actually spend a week here discussing about these issues, but these are in a nutshell the most important characteristics and guidance provided by ILO standards in answer to the question how to build effective and rights-based sustainable pension systems. And this is actually the question that most countries have been trying to answer in the last 2 decades, and even before, but since the last 2 decades there has been an increase in pension reforms. And what we see is that pension reforms are indeed the most frequent type of social security reforms in view of the multiple challenges countries are facing, and we already mentioned a few of them. Low levels of coverage, high levels of informality, low levels of protection in old age, especially of the non-contributory benefits, but also the contributory ones, demographic problems related to aging populations, low levels of earnings in the country and reflected in the level of pensions, gender inequalities in the labor markets that are then reproduced and even magnified during old age. Most often, the reforms are parametric, affecting the minimum contributory periods, benefit formulas, the retirement age, conditions for retirement, conditions for pre-retirement, equalizing retirement ages for men and women, etc. And we see here on screen that the multiplicity of reforms that were in a variety of countries. Some of these reforms, however, have been more structural and tended to replace defined benefit schemes by defined contribution ones. To this date, we have had 32 out of the 192 countries that actually attempted to substitute defined contribution to defined benefit schemes, and have the two run in parallel and sometimes compete against each other. However, many of these 30 countries actually rolled back these reforms either entirely or partially, or introduced a new mix between the public and private pillars during the last decade in response to the problems that they were facing, including the non-compliance of defined contribution schemes with the principle established in international social protection and social security conventions, the lack of improvement of coverage that they didn't bring, the benefits did not increase but sometimes decreased, high-level transition and administrative costs, governance issues, excluding the representatives of persons protected from the administration, etc. So what is the ILO's approach? Taking all these principles and standards into account, the ILO has come up with its own multi-pillar pension model, which reflects also the latest conclusions that were adopted in 2021 by the International Labour Conference by the representatives of governments, employers, and workers. In these conclusions, they recognize that member states are called to complement social protection floors by ensuring adequate and higher levels of contributory social security based on solidarity in financing and a fair division of contributions between employers and workers, and allowing for the existence of additional complementary pillars, including voluntary contributory pillars, in line with ILO standards and according to national circumstances. So at the basis here of this graph, you see that the ILO multi-pillar pension model, here lies the first component meant to secure basic income security in old age for all persons in need of protection through a social protection floor. And this is illustrated on screen as the zero pillar. For these able to contribute, the first pillar is constituted by social insurance. Again, collectively financed social insurance. And when I see my colleague from the World Bank saying that the second pillar in her graph was individually financed, I have some concerns because these benefits I have some concerns because these benefits need to be collectively financed according to international standards. And for those able to contribute, then the second and third complementary and optional pillars aim at providing additional protection, with these mechanisms being sometimes voluntary, sometimes mandatory, and can be financed by employer and worker contributions in most cases. In a number of countries, these additional mechanisms were constituted by the so-called defined contributions, but we could also name them undefined benefit schemes, where the level of the resulting benefits is usually unknown in advance and not regulated by law and related to the performance of the financial markets. They are most often run by private insurance companies that do not associate the representatives of the workers and employers to their administration. And this has been documented by the supervisory bodies of the ILO, which have concluded that these benefits in most cases cannot be accounted for to demonstrate compliance with the international social security standards. So they first...
One more minute.
Thank you. I was finishing just to say that when the international monitoring bodies look at how ILO conventions are implemented, they only look at universal pillar and social insurance pillar because these are the ones that most often comply with the benchmarks and comply with the principles that are established in these standards. Thank you.
Thank you very much. Actually, our panel again shows how people are very wonderful creatures. Some of the when we're talking on all these conferences, many people have economics degrees and some of them are certified actuaries, but they somehow don't get that if each of 6 speakers speaks for 20 minutes, the panel will take 2 hours instead of 1 hour and a half. And besides, the moderator, would have to not to speak all his wise remarks that I have prepared. So my request to the speakers is still stick to the 12-minute presentation, so we'll have some time for questions and answers by the end of the session. Thank you. Now I give the word to Mr. Dmitry Karashev from International Social Security Association, and he will tell us about the principles and guidelines. And again, I would recommend to see the difference in views between ILO, World Bank, and ISTA. Please.
Thank you very much, Chair. I will be shorter. Уважаемый вице-премьер правительства.
Dear Vice Premier of the government, Tamara Husseina-Kusainova, and dear Chair of UPS, Mr. Janat Kurmanov, dear participants of the roundtable, ladies and gentlemen. First of all, I would like to express deep gratitude to the UAPF of the Republic of Kazakhstan for inviting the ISSA in the preparation of this high-level forum and express hope on the continuation of the cooperation in such a format. Also, I would like to thank a representative of the ILO representative, Mr. Markov, on a very interesting presentation on the social standards of pension. And I have to note that the ISSA guidance is made to assist many managers and in managing the pension assets, and we can say that the ISSA ILO are helping each other in promoting the international standards. And allow me to remind you that this is the leading organization that basically unites the state agencies insurance agencies and pension agencies in 160 countries of the world. And the strategic vision is to promote a dynamic social provision as a social measurement of the globalization by applying high standards of governance. In 2013, at the World Forum of the Social Security in Doha, Qatar, we had an opening of ISSA Center on improving the governance standards, and this event basically opened a new age of developing the standards for social provision and provision of efficient and high quality services to ISSA country members. They're currently developing the professional standards is a part of the 3-year technical plan of ISSA committee and is made within as a main activity of the Department of the Social Security of our organizations. Based on positive feedback from our members and partners, we can confidently say that the Doha Forum was a milestone, a turning point between the General Secretariat of ISSA and member countries, and now we can divide ISSA history into 2 stages, before Doha and after it. And what's the value of ISSA guidance, or as we say today, added value for the member states? And the answer is obvious. The management of ISSA being an aggregated international experience of administrators from various regions of the world in the field of social security allows to optimize the governance structure from the cost-wise and efficient service provision-wise, including coordination, control, external and internal communication issues. One has to note that the process of guidance development is an ongoing process, and it never ends. So the guidance are being updated with account of with account of the changes in reality. So in the World Forum on Social Security in Marrakesh, new guidances were discussed on managing the human resources and also on the continuation of the social security, despite that the governance of the social resources were always important for our work. COVID-19 pandemics has anticipated the development of these fields. So in ISSA report, the reload of the Social Security for Workforce, which was published June last year, as special attention is given to revising the parameters of governance. Also the human resources management are being considered in hybrid work environment, and also the development of retaining the personnel. And dear colleagues, the efficiency and provision of disruptive services play a crucial role during taking measures throughout the pandemic. And now, at post-COVID development track, the economic uncertainty and the climate change issues has exacerbated the challenges that stand in front of our services. Based on them, our guidance incorporated a lot of new recommendations in this area. Dear colleagues, the administrative social security always faces a lot of challenges. For example, how the reforms could be done while reducing the costs and improving the quality of services, or how what strategies are there for the communication and IT technologies and simplification of using the resources and the planning of organization activity, or for example, you have a need in increasing the contribution density, or how to make people come back to the occupation. What are the mechanisms in place? And these are issues you have to tackle in your everyday work, are being reflected in various tools of our associations. Currently, our guidance are available in the following fields: conscientious governance, quality of service provision, information and communication technologies, collection and discipline in paying the contribution, the sustainable occupation, communication and organization of self-employment, actuary activity, administrative practices on the inclusive coverage, return to the labor and reintegration, the protection and occupational safety, fighting the tax evasion in social security system, human resource management, administrating the social security agencies, and the last guidance on the on the continuation and the non-disruptive character of the social security services works. All above mentioned guidances are uploaded to ISSA website and available in full. So all the guidance are based on a single model that includes the introduction, then the particular recommendations on particular mechanisms and aspects of implementation. Some recommendations also provide references to the best innovative practices of the member organizations in particular fields. So as per the issues we discussed at our round table, the most in-demand guidance would be the one on the collection of contributions and also on communication and actuary operations. So I would like to specifically draw attention to the latter one. So this guidance was developed by ISSA in cooperation with ILO. First of all designated for actuaries and other specialists involved in actuary activity. And the main goal of this guidance is to provide recommendations to various interested parties in their everyday work concerned with planning, funding, and provision of benefits. And it also includes the list of principles of structures and processes that has to be implemented in the actuary activities of the social security agencies. A part of recommendations are aimed at providing particular help to actuaries in their efforts to comply with the international and national standards and regulatory requirements. At this, I would like to highlight that an actuary guidance is not a legally binding document. It should be considered as a tool, as an instrument which provides details of a particular practice in purpose of improvement of actuary work and monitoring over it. Also, we need to know that the goal of the actuary guidance is not doubling or replacement of international standards of actuary practice of the International Actuary Association, IAA, or any other national actuary standards. And this instrument encourages the people who works as an actuary is to improve their operation and to comply with the actuary code and IAA. Dear participants of the round table, availing myself of the opportunity, I'd like to inform you that from 1st to 7th September this year, the ISSA would have its annual 21st conferences actuary, which would be held under the slogan, the provision for the provision of social security in context of global of economic uncertainty and instability, and events such as COVID-19 and its consequences, the growth of inflation and geopolitical tension have highlighted that the current global context may be characterized by higher volatility and risk. And at the conference, one may listen to the real opinions of actuaries around the world on a number of risks with which the social security problems would face in the near future. And this conference would highlight the importance of cooperation between various specialists to develop sustainable and adaptive systems. Dear colleagues, at this I would like to conclude my presentation, and taking the opportunity of being at this tribune, I would like to congratulate the organizers of our roundtable with the 25th year anniversary of the Accumulative pension system of the Republic of Kazakhstan, and wish us all success in building efficient social security programs. Thank you very much for your attention. Thank you, Dmitry.
Now I will give the word to Mr. Guillermo Artur, President of International Federation of Pension Fund Administrators from Chile. Can we see his picture? Guillermo, ¿me oyes?
Yes, I am here.
Muy bien y muchas gracias. It must be very late now in Chile, so thank you very much for taking your time.
Thank you very much for your invitation, Sanat Kurmanov. I would like to be there, but you know, I live in the other side of the moon. So, good morning to you. To me, I don't know if good morning or good night. It's 3 o'clock in the morning here. Well, you asked me to speak about the Chilean pension system that has served as the foundation of the reforms implemented by many countries, including our host, Kazakhstan. So I would like to summarize the main characteristics of the Chilean system. The mandatory saving made by all social security dependent workers are capitalized in individual accounts owned by the worker. These savings are managed by private companies, the Pension Fund Administrator, AFP, which have separated assets of those of the pension fund. Also, they have an exclusive purpose in order to avoid conflicts of interest and are subject to strict control by the state agency, the Superintendence of Pension. On behalf of the worker, AFP invests these resources in local and foreign fixed income and equity instruments, and whose sole objective is seeking profitability and security of such investment. Therefore, the regulation establishes maximum invest limits according to the type of instrument, issuer, and risk rating, thus obtaining adequate diversification and profitability of investments. Workers can choose among 5 different types of funds offered by the AFP, and which differ in their risk exposure. Thus, the first fund, designed for the youngest, invests up to 80% in equity, and the fifth fund, being the most conservative, invests mainly in fixed income instruments. Consequently, pensions are financed with the contribution made by workers and the profitability obtained from such investments. For those who become disabled or before reaching the legal retirement age, 65 years for men and 60 years for women, there is a disability and survival insurance that provides the funds missing to finance a pension equal to 70% of the average of the last remuneration. The Chilean pension system is mixed, since part of the pension is financed with state contribution in general taxes through a non-contributory pension focused on the most vulnerable sectors of the country. The contribution paid equals 10% of the taxable salary plus to an average of 1.15 for management commission and a premium of 1.54% to finance the disability and survival insurance. I would like to talk about the reason of this reform made in 1980. This reform was carried out due to the unsustainability of the old pay-as-you-go system, where an even smaller number of workers had to finance the pension of a growing group of pensioners. The most reliable demonstration of the unsustainability of pay-as-you-go system, which are also called defined benefit system, is that they could not fulfill such promise. The promise was giving a defined benefit. Indeed, in the last 27 years between 1995 and June 2023, 82 countries raised the contribution rate, 66 raised the retirement age, and 66 froze or simply reduced the amounts of the benefits granted. It is for this reason that in recent decades, the number of countries having pay-as-you-go system that have incorporated individual saving mechanisms in their various modes has increased significantly from 17 in 1999 to 51 in 2022. The other reason of the reform was to align the contribution efforts to the benefits granted. One of the reasons of the underfunding of the pay-as-you-go system in Chile was due to the fact that pensions were calculated based on the last salary, which was an invitation to under-contribute throughout life and over-contributing during the years prior to the retirement, in which the level of pension was calculated. The result of the system has been successful. During the 40 years the system has been in operation, the profitability of the pension fund obtained from the investment has been an average of 7.2% real per year, which means that the fund accumulated by the first generation of workers have quadruplated their contribution made. Indeed, the Workers' Fund corresponds approximately 25% to the contribution made by them, updated in real terms, and 75% to the profit obtained under the concept of profitability. In other Latin American countries where the Chilean system has been applied, profitability has been similar to that of Chile. Along with this, since these funds are invested under profitability and security criteria in instruments issued by companies with great economic potential, the system has been an enormous contribution to the economic development of the country, where it has been implemented. Indeed, according to a special study of Sura in 2013, between 6 and 13% of the average of the GDP growth of the country having individual saving system stems from their saving and investment in the top of performance company. I would like now to talk about our main challenge. Notwithstanding about the terms of sustainability and success in improving saving and contribution to economic development, the system is not exempt of enormous challenge. The main one is to the low density of contribution that necessarily translates it into a deterioration of pension. The problem must necessarily be addressed with the solidarity pillar financed through general taxes, having in mind the most vulnerable sectors. I emphasize that the financing should be through general taxes, because having it rest on the contribution of the workers is regressive, since the highest income people are not included there. The tax system represents, in the best way, the people's ability to pay in a more reliable way. Another challenge is to improve the 10% of contribution rate that has been in place for 40 years. Although the life expectancy along the same period, and therefore the period to finance pension, have grown by 55% for men and 48% women, and the legal pension age. One of our challenges is to improve voluntary saving. That is a pending task. In this matter, it would be advisable to incorporate mechanisms based on behavioral economics, such as automatic enrollment. This means that workers joining a company are automatically registered to make voluntary saving to their individual account, which can be supplemented with resources from the employer. Workers can request to be exempt from this obligation if they so wish. In practice, in countries where automatic enrollment has been incorporated, the disenrollment rate is relatively low. For example, in the case of the most mature automatic enrollment system, the United Kingdom, between 86 and 92% of the workers remain in the system. That is, only between 8 and 14 that opt out. Changes in the labor market show that a growing proportion of workers are independent. In the traditional wage work and the dependency bond has been dramatically decreasing. Therefore, it is necessary to review whether the same parameter to finance pension should be a percentage of salary, which would aggravate the effect of low contribution density. There are already studies which are assessing the possibility that either part or all the pension should be financed with a deduction of the consumption and not of the salary. I would like to say some comments about the perspectives. As I pointed out, the replacement rates have not been at the level affiliates expected, mainly due to the low density of contribution, which stems from the informality and change undergone by the form of work, where the wage labor has given way to self-employment. As an example, Chile women contributed for an average of 15 years, and at the retirement age, 60 years, they have a life expectancy of 32 years. Therefore, it is impossible to finance an adequate replacement rate for 32 years when having 15 years of contribution and for only 10% of their salary. Consequently, it is urgent to raise the contribution rate to the levels of other OECD countries, that is close to 20%. At the same time, it is urgent to raise retirement age, since the increase in life expectancy results from a general improvement in the health of the population, which justify postponing the pension age. Regarding the new form of work, which is one of the reasons for a low density of contribution, it is necessary to explore other sources to finance pension, which may come from consumption. In other words, from the moment the percentage of wage workers has decreased, it is necessary to seek alternative financing that could be a percentage of the consumption, as we see in the World Bank presentation in this seminar. Another reason for informality is caused by poverty, unemployment, low educational level, etc. Notwithstanding this clear challenge, the reform process taking place in Chile and in some other Latin American countries have focused for merely ideological reasons on restoring pay-as-you-go mechanisms, despite the evidence that they fail in the work, and despite the fact that many other countries are incorporating mechanisms of capitalization. The exponential increase in life expectancy in the world, together with the appearance of new forms of work and levels of informality,
Guillermo, excuse me, 1 minute.
First, raise the contribution rate and the pension age. Second, look at alternative mechanisms to finance countries through either consumption or others. Three, strengthen a basic solidarity pillar focused on the most vulnerable sectors that, due to the poverty or unemployment, have not been able to finance an adequate pension. Four, encourage voluntary pension saving to complete mandatory saving. There are successful experiences of increasing voluntary saving through behavior economics, such as automatic enrollment, in which workers must automatically make voluntary saving unless they expressly opt out. To face this challenge, it is necessary to have to leave the ideology trenches and populists from where we require change are usually analyzed. It is important to carry out that in this seminar to channel all the reform based on technical criteria that allow us to improve the situation of the pension system, as demanded by the workers facing old age after a working life. I would like, as conclusion, to say that despite the enormous challenge the pension system faces, we think that they should be addressed by considering the experience of recent years. Therefore, any reform process should be approached without modifying the foundation of the system, the main ones of which are, in our opinion, first, the pay-as-you-go system are not sustainable for demographic reasons, whereas the savings system contributes to the financing of pension not only through the contribution of workers, but through the return of investments. Second, additionally, saving systems have the advantage of making a significant contribution to the economic development of country, which increases insofar as the investments diversification incorporate new financial instruments. Devote to and protect the property right workers have over their funds, as well as over the profitability of the investments. Then, four, the administration of pension resources should be done under the competitive environment that stimulates profitability and cost reduction. Five, in the light of challenges already described, it is necessary for the source financing pension to be diverse. A first non-contributory pillar, financed through general taxes and focus on sectors that, for different reasons, cannot finance their pension. A second contributory and mandatory pillar through automatically revised contribution rates in response to change in life expectancy. And third, pillar of voluntary saving that complements compulsory saving using behavioral economic mechanisms. Six, work funds should constitute assets separate from those to the administrator, about which they will only have a fiduciary role. Seven, the investment administrator made with workers' fund should have the sole purpose of making adequate profitability and ensuring their security, which requires diversifying investment by class or instrument issuer and geographical areas. 8, disability and survival insurance should be established for those who have an accident or die before gathering enough funds to finance their pension. As you know, the Chilean system has been very successful. Nevertheless, we need to face with all these challenges that are present because the life expectancy, the increase of the life expectancy, the change on the way of workers, and so we have to make an effort as the effort that you have made in Kazakhstan to prepare this seminar. Thank you very much.
Thank you very much and good night, Guillermo. Okay, now I give the word to Dr. Alejandro Bonilla Garcia, President of Grey Cells, who would tell us about the Swiss pension system.
I have a PowerPoint. I wonder if it's already there. Thank you. Well, good afternoon, everyone. Honorable Vice Prime Minister, Mrs. Yusinova, CEO of the United Community Pension Fund, Mr. Kurbanov, thank you very much for inviting me, and it has really been a pleasure, and I would like to congratulate you on the organization of this event. In the past, I was director of the Social Security Department of the ILO, and I was acting Secretary General of ISA, but now I'm speaking here as a consultant. My origin is Mexican, but I'm also Swiss. I'm a member of the Swiss Association of Actuaries, member of the Mexican Association of Actuaries, and member of the International Association of Actuaries. So I'm a consultant. I'm going to go away practically to be in charge, in line with the time that has been given to us. As a consultant, I do many feasibility studies. And when I ask for one of my clients one project and I want to submit it to a bank, they ask me, I need your plan. I need your feasibility study. Show me that your plan works. And in many countries, I cannot find the plan. I have the description of the legal instruments, I have the description of the organigram, but I don't often have the plan. Who's going to pay? Who is going to benefit? And I was a bit surprised that after 25 years of functioning, for example, of the Accumulated Pension Fund here in Kazakhstan, still now the vast majority of pensions are paid from the government budget, if I understood correctly. But I will move on. To me, we shouldn't be surprised that our population has a low density of contribution. We shouldn't be surprised that there's an informal sector in our economy. We shouldn't be surprised that there are poor people. We shouldn't be surprised that there is a rural sector. We shouldn't be surprised that there are people that do not have a salary. That is something that we should include in our plan. So for me, it's like a little bit like the doctor. You have to look first at the patient and afterwards to the medicine. In many countries, we arrive to the medicine, and this is what you're going to have. I don't care if the density of contribution is low. I don't care if you have an informal economy, which is the vast majority. I don't really care if you have poor people. I don't care if you have rural people. This is the medicine, and I don't have a plan. So to me, that's a dismay. And this time you asked me to present the Swiss pension scheme. I'm going to rush to die with the 12 minutes. So I will present the patient. Switzerland, the patient. It's in the center of Europe, so it's a very fantastic location. Everything is close to Switzerland. Switzerland is divided. It's a multi-linguistic unity. It has been working as a union for more than 700 years. 700 years that they have been between the German part, between the French part, and between the Italian part. And we have cantons, and I mention this because each one of the cantons has a role to play in the pension system. Of course, life expectancy is very high in Switzerland. You can see the figures here. There's not such a big difference between men and women. There's, of course, some difference, but life conditions are well. But quality of life is really very good. If you compare mortality now with mortality 20 years ago, you see that the 65 years old or 65 years old now have a mortality of those who were 55 years old 20 years ago. So, and they told me, for example, in my gym, I'm 72 almost, but my condition is only like 55. And that happens to many people in Switzerland because it has very characteristics. I'm going to rush. Switzerland, in the development index of the United Nations, #1, Switzerland, developmental index. In the macro resilience index, Switzerland is #1. Yesterday, it was published this in the most innovative economies. It was published yesterday in Geneva. Switzerland is #1 of the innovative companies. So if you want to copy the Swiss pension scheme, maybe you should copy also all the rest. Otherwise, it would not work. Very important thing. This is not the rate of return, but the interest rate on savings, which is not investment, on savings. And in Switzerland, we've had 0 or negative returns for a number of years. The average rate of return in the last 5 years has been around 5%, but with a very big discrepancies. The minimum has been like 1.6, and the maximum has been like 12%. So you see there's a big disparity. If you take the 10 lower rates of return of pension funds, they average something like 3.4%. And if you take the 10 highest rates of return in Switzerland, they average around 7%. Of course, I will go rapidly. This has to be confronted with inflation, and inflation has been controlled quite vastly in Switzerland. We know from demographic projections what is going to be the balance between active and passive person and retired persons in Switzerland. And to me, the ratio between people alive and retired people, it's not a good one for a pension scheme. It's contributors. How many are contributing? Because in the country you have many people and it's getting old, or how many are contributing? So that's another ratio that I think it's interesting to know. This is inflation, sorry for the mistake. Inflation has been turning around for 2% for a number of years, and something that is really crucial for the pension fund. I don't know if you know, the government in Switzerland lasts for how many years, do you think? Just 1 year. We have the president for 1 year, and he designates his group. And everything, I think this is it. If you see the voting, everything in Switzerland is voted by the people, We vote almost every month on something. It really works. We have direct democracy, and we have been voting on pensions for a number of years. And in the same case that, for example, in Switzerland, you got manifestations against the increase of retirement age. In Switzerland, we had a vote. So they say, are you in favor or against increase the retirement age? And we voted, and we increased it very nicely. And each time that we have a vote, you have the explanation of the position of the government. You have in a different pages, all the pages that you need, the explanation of those who are in favor of increasing the age and all the arguments. And you have again, in the same bulletin of vote, those who are against. So most of the decisions by most of the populations are really informed decisions. So I'm really going to go very fast. In Switzerland, we have a balance of institutions in the South, Geneva and International Geneva. The invention of Internet was a concern over there. We have the World Economic Forum, we have the WTO. In Zurich, we have a financial hub, which is really, really important. And in Basel, we have the regulations, the standards for insurance companies that have an impact all over the world. Is it moving? Every day we have in Switzerland workers that go from France to work in Switzerland, from Germany to work in Switzerland, from Italy to work in Switzerland. And investors from all over the world, they send their money to Switzerland. So in Switzerland, as they say, we throw the money through the window, from the outside to the inside. So it's a very successful economy. There's an ADN. I will let you read the presentation afterwards. It's a direct democracy, including pensions. If you see number 3, it's prudence. Number 8, economic prosperity. So it's very important. And to me, this is key. We cannot tell the patient that he has cancer, but luckily he's safe in the rest of this. We have to see the patient as a whole. And pensions is just a block of the Swiss Social Security system. The Swiss Social Security system, as you see, has many pillars. We are focusing on the 3-pillar pension system that I'm going to present. But we have unemployment insurance. And unemployment in Switzerland is 1.5%, very low. And in the canton where I live in Geneva is less than 1%. So we don't have unemployment. Most of people are paying. we don't have informal economy. And we have, on top of the pensions, accident insurance, supplementary benefits, family allowance, and maternity insurance. And also, all the property is insured. All cars are insured. You cannot drive a car if you're not insured. And even transactions on the internet, there is insurance. So to me, it's a paradise for insurance people and for social insurance. And also, there's the question about money and finance, but also the question about society. There's a big network of NGOs and government facilities to promote insertion and participation of senior and retired people in the society. There are many activities. Seniors are voters, and seniors are dealt with correctly in their life. They are accompanied, even inclusive, you see the exit label there. Assisted suicide is legal in Switzerland. You have to be well in your head. You have the time to take a decision. If you have a terminal illness, you will be assisted. So it's not only money, it's pensions and all the rest. I will go rapidly. So finally, we go to the three-pillar system. We have a public pillar, which is pillar number 1, state pensions, pillar 2, occupational benefits insurance, and pillar 3, private pensions. I don't know if anybody of you would have an idea of how many pension funds are there in Switzerland. 1, 2, 3, 4, 5, 6, 7. Let me, oh, this was in the wrong order, sorry. We're going to read. We have 1,400 pension systems. I'm going to explain. But to me, what is really the most important, I think it's the most important message that I would like to deliver, which is really very much in line with what Kuhn mentioned and Markov mentioned and Dmitry Karasiov, is that the whole Social Security system, including the three-pillar pension system, responds to the human rights. If you see there, it responds to the Declaration of Human Rights, but to me, most importantly, it responds to the agreement on pensions that all the members of the ILO agreed, and to me, it's a date that it's important. It's what was called the new consensus in 2021. And what the governments, employers, and workers in the whole world agreed in 21 is that it's nonsense to make in opposition public and private venture. They have to work together. It is nonsense to misunderstand or put in opposition savings and insurance. Savings are fantastic. Insurance, it's another animal. Insurance, it's not the same thing. And that doesn't make any sense to put in opposition individual issues with collective issues. If you see all insurance companies in the world, all of them, they have collective funding. And the ILO, and this is recognized in that agreement, mentioned, this is nonsense just to mention that there is pay-as-you-go and individual funding. There is full collective funding, there is partial collective funding, and all insurance companies do this to distribute and manage the risk. So I don't know why in some presentations you can hear that it's either pay-as-you-go or individual funding. There are many ways of funding the pensions. I will. Ross, the first pillar is survivors insurance, disability insurance, and supplementary benefits. And this covers the whole population, but the whole population contributes to it. I will go rapidly. The second pillar, contributions are 10.6 of the income is split equally between workers and employer. The second pillar is occupational, and the objective of the second pillar is to maintain the standard of living in old age. But the standard of living, considering that your consumption basket is not the same. Now I am a grandparent, I live along with my wife. But when we were my children at home, I had to pay their clothes and school and travel and holidays and everything. And now that my wife and I were alone, we have a different consumption basket. So retired people have a different consumption basket, and we have to know it. In some countries, they assess what is the consumption basket of older people. It's not the same as an active in many cases, in most cases actually. And the third pillar, the number of pension funds, this is in the wrong order. You see, we had more than 2,000 in 2011, and for competition and the very harsh economic and financial situation around, it has been reduced to almost 1,400 right now. So it's very complicated, it's extremely sophisticated. And there's not one type of pension fund. We have 1,400, but you can consider them, there are autonomous pension funds where they decide exactly what they are going to do. They have their ambitions. They have semi-autonomous pension funds. They join forces with insurance companies, and there are collective pension funds. Because you saw the map of Switzerland, there are big cantons, very strong financially with high population, and there are very small cantons. They don't have. And there are small companies, they didn't have the strength to build a pension fund. So small companies get together to participate in a collective pension fund. So you see, we can have pay-as-you-go, partial funding, collective funding, individual funding, autonomous pension funds, semi-autonomous pension funds, and collective pension funds. So the options are there, and they have to be included in the plan. For the second fund, the contribution rate varies according to the age of the person. Younger person, they pay a lower contribution rate than the older persons because that money will be invested for a longer period. And they know that young people have lower salaries, and they are building their house, they are getting married, they are buying things, they are paying for many things. And the third pillar is voluntary, additional savings, and it has two parts, one which is tied, as you see in the graph, and one which is flexible. Here, everybody puts the money that they want. There is one part that can be deducted from taxes, and one part that cannot be done. There is a ceiling that can be done. And this is something that most Swiss people do. I always remember the anecdote. My daughter married a Swiss young man, and on the first date they went out, my daughter was like 19, and this guy, he was like 22. And my daughter came back home and she said, you know, this guy is a little bit, what? He asked me in a first date if I'm contributing to the third pillar. What is he talking about? I'm too young. This is going to be in so many years. So I like this guy, And this is something that in Switzerland, people know they're going to get old. People know that it's not to ask the others to do for us, it's that we all have to put, and the sooner you start, the better you're going to be at the end. So the rate that you're going to have at the end depends on the system, on the plan, but also on your own contribution. And
Alejandro, 1 minute.
Yes. Actually, here too, the replacement rate in this graph, you see it's the green dot is actually below the OECD average. It's 65% of replacement rate. But it's a fantastic replacement rate. It's far beyond the requirement of the Convention 102 of the ILO that's established at 40%, but it's surrounded by universal health care, it's surrounded by social support, it's surrounded by housing, it's surrounded by many other things. So this 65% has to be considered in the context. In a country where you don't have all those surroundings, the the replacement rate is really, really important. What is the future? The future in Switzerland is that we're going to have, again, new voting, and it's going to be the people who are going to decide. Each one of us, we're going to hear the experts, hear the politicians, hear the different parties, who's going to pay what are the needs, and what do we want to do with our system. So we're going to vote in Switzerland on to reform the system. It's not a question of experts, it's a question of people. And, and to me, this is the key when you're analyzing pensions. First, consider which are the principles. Second, which are the means? Because in many cases, we just focalize on the means. And if you follow the ISA guidelines and you ratify the ILO convention, you're on the safe side. And also, I would love to have a seminar or an activity like this, not talking about the principles, about the means, but about the results. Instead of experts having pensioners sitting here and telling us what their life is with the pensions we are providing. What are the results? And it's no surprise. They have a good result in Switzerland in development, in competitivity, in all the rest, because it's the decision of the people. So I think we should focus very much on the results, respect the principles, and adopt the means to those two. Well, thank you very much for your attention.
Okay. Thank you. Our time has run out because of wonderful feeling of Swiss time by presenters from Switzerland. Swiss people are usually very punctual, but not when they are talking in Kazakhstan, obviously. So we have one more presentation, and I've spoken with the organizers, and the lunch will start at 1. And so if I can see the picture of our next speaker, Dr. David Knox, who is a senior partner in Mercer. Mercer is an Australian group which is presenting Mercer CFI Institute Global Pension Index. And Kazakhstan is this year, or at least is supposed to be included in that index. And I would like to give word to David to see his opinion about different pension systems in the world and the trends of the development of pension systems. Thank you.
Thank you very much, and good afternoon.
Okay, I can see you now. Go
on. Good afternoon, and are my slides being seen? Can you see my slides?
Yes, yes, we can.
Excellent. It's wonderful to be here, and thank you very much for the invitation. And I'm going to look at the Mercer CFA Global Pension Index from last year, but as has been said, Kazakhstan is in it for this year, and this year's results will be announced in 3 weeks' time. We all know that pension systems are very different around the world, and I won't go through the slide at the moment. Sorry, I'm just having some troubles here.
Go on, we can hear you and see.
Here we are.
Okay.
Okay. So can you see that? There we are. So we know that there's a lot of uncertainty in looking to the future, and it really is too important to ignore. We have to look at how we can make our pension systems better. In view of the time, I will go through these slides fairly quickly, but you will be familiar with some of them. The World Bank model is a multi-pillar approach, as we have heard many times today. In the index, we look at 5 pillars. The first 2 pillars are around the public sector or government paid, the basic pension, the demo grant, and social security. Pillars 2 and 3 are about the voluntary not the voluntary, the private sector, whether it's mandatory or whether it's voluntary. But Pillar 4 is also important, and that is what financial support is there beyond the pension system, whether it's from the government or whether it's private savings, home ownership, etc. So we look at the broad picture in thinking about financial well-being in retirement. I'm going to start by looking at three fundamental questions that we look at in the index. And they are words that we have heard about already today. The first one is adequacy, which is all about the benefits that you get in retirement. So we look at the minimum pension, the basic pension for someone who has very little or nothing. But we also look at the net replacement rate for a worker who has had 40 years in the workforce. We look at various system design features in terms of longevity protection, in terms of portability or preservation, in terms of leakage out of the system. So what are some of the features of the pension system? Then I said we looked at household savings or household debt. In households, that has to be paid for when people retire. That will affect their standard of living. If you own your own home, you have greater financial security. And ideally, we would look at investment returns, because if you get returns, you will get a better outcome. But that's very difficult around the world. So we look at the level of assets in equities, in shares, in property, and other growth assets. Last year, the top three systems in terms of adequacy: Iceland, Portugal, and the Netherlands. And down the bottom, when we had 44 systems in it last year, systems that are still developing: Korea, Indonesia, and India. That's adequacy. Very important. But is the system sustainable? Can it keep going, not only to next year, but for the decades ahead? And we've already heard today about the importance of coverage of workers, gig workers, the self-employed, the informal labour market. We want to make sure that all workers are saving for their retirement. How much money is put aside for the future? The level of assets. In the multi-pillar system, it is a combination of government financing and savings for the future. Demographic issues. We've already heard about the ageing population. Many countries are facing falling birth rates. What about the next generation? How much money is being put aside for the future that is funded, not used immediately, but put aside? If you can work a little bit longer because the retirement ages are a bit more flexible, that gives you more opportunities to save. Similarly, public pension costs. A lot of governments are going into increased debt as a result of the pandemic. Can they afford the future levels of pensions? So how much will the public pension cost as a proportion of GDP? And again, real economic growth. If the economy is growing, the future looks stronger. In terms of the sustainability index, last year, Iceland, Denmark, and the Netherlands came out on top. And down the bottom, Brazil, Austria, and Italy. You might be surprised to have two Western European countries of Austria and Italy down the bottom. But the reason for that is firstly demographics, and secondly, they're very heavily reliant on government pensions. And if their demography is poor, that is, they are getting older with not many babies being born in effect, they're in trouble financially. And they have not put money aside for the future. Now, the third sub-index we look at is integrity. And this is really all about, can you trust the system? Because if people are putting money aside for the future, for the next 10, 20, 30 years, they've got to have great trust and confidence in the system. So therefore we look at things like the regulation of pension plans, the governance, what protection is there for members or individuals if something goes wrong? How well are they communicated? It's really important that we have a level of transparency because we are talking about people's finances for years and years to come. And similarly, how much does the system cost? And of course, the lower the cost, the better the system in terms of integrity. In terms of integrity, the better systems last year, Finland, Norway and the Netherlands, and 3 systems that are still developing, Mexico, Argentina and the Philippines. So we look at all these together and we say, so which countries have the better systems in the world when we take into account adequacy, sustainability and integrity? And what you find last year is that the top 3 countries, which we classified as A grade, Iceland, the Netherlands and Denmark. I won't go through all the countries, but the countries A, B, C and D grade. And of course the D grade countries are countries where the pension systems are still emerging. From the index and from our work, we believe there are some significant reforms that are needed around the world in many pension systems. Here are a couple. We need more people to participate in private pensions. Talk about coverage. We've heard about that today. People need to be involved. We need to encourage more private savings so people put aside not just 10% of their employment. We want that consumption smoothing throughout your lifetime. We need to increase the state of pension age or the retirement age as we live longer. Encourage higher labour force participation. And we also need to, in some systems, stop the leakage out of the system. Because in some countries, people can move out of the system and access their money, and therefore it's not there for their retirement. And of course, we constantly need to improve the governance and the transparency of the system. Now, just briefly, I want to look to the future and express a challenge that applies to many systems around the world as we move from a defined benefit system where we had pensions supported by employers or governments through to a defined contribution system. And the Nobel Prize winner, William Sharp, said, when you retire and you have this lump sum of money, it's very hard to know what to do because you've never had so much money before. And he said, knowing how to strike a balance between having enough income to meet your current needs and having enough to get through your lifetime is the nastiest, hardest problem in finance. So it's the importance of having adequate income, but again, having that protection of longevity in case you live to 100. So what I want to leave you with is when you think about your defined contribution pension pots, we need to think about how to educate individuals and households, how to engage with your members, not only when they retire, but as they approach retirement in the years before. Do they need to put a little bit more money in to have what they want in retirement? And then, what are their expectations? What's the lifestyle they're looking for in retirement? And finally, equity. Our World Bank speaker earlier spoke of the importance of equity and fairness, because if there's not fairness in the system, it won't be trusted. So lots to think about. Pension reform is needed around the world, Many countries are doing it differently, but we can learn from each other and deliver better systems for everybody. Thank you very much.
Yes. Thank you, David, for your interesting presentation. I'd like to say on personal note that I enjoyed your Australian English. Thank you.
Thank you.
You take care. So I would like to say that we have run out of time. So basically, I'm not going to stand in the way between the participants and their lunch. I do urge you to read the presentations because there is a lot of interesting information in both Mr. Markov's presentation and Mr. Bania. I think that we could exchange questions and answers with the speakers during the lunch and after that. I would also restrain myself from making all these wise remarks that have been prepared. Thank you very much and have a good lunch.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Один, два, три, четыре, пять, шесть, семь, восемь, девять, 10. Говорю на английском. Один, два, три. Один, два. 1, 2, 3, 4, 5. Ты на русском слышишь меня? Да. На английском, на английском. Нет, ты-то на английском говоришь, а я тебе перевожу с казахского. Теперь наоборот, давай-ка ты русский включи. третий канал. Английский слышно. Спич с трибуны надо выключить, там микрофон включен. Так, давай второй язык.
1, 2, 3, 4, 5. Английский говорю. 1, 2, 3, 4, 5. Также мой голос туда-сюда уходит или как? Один, два, три, четыре, пять, шесть, семь, восемь, девять, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Как слышно? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Один, два, три, четыре, пять, шесть, семь, восемь, девять, 10. 1, 2, 3. Один, два, три, четыре, пять, шесть, семь, восемь, девять, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Как слышно? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Гейны. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Да. 1, 2, 3, 4, 5. Третий ноутбук, третий. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Я уже устал, давай быстрее. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5.
Ссылку отправлять, да?
Почему можем?
Ну, то есть вебинар запущен, этот же, и
можем.
В этом же вебинаре зайти на сайт, ссылку ему отправить.
Да, можем. Мы же не изменяем ничего, мы же просто копируем.
Нет, не копировать, а именно редактируем, и мы же его как докладчика в вебинаре добавляем. Ему, наверное, лучше просто...
Как хотите, через...
Сейчас, давайте, надо будет ссылку.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. А? Подальше вот так вот говорить. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Алексей, как говорите обычно? Вот так вот, на таком расстоянии?
1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Один, два, три, четыре, пять, шесть, семь, восемь, девять, десять. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. О, на только его похож человек. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1, 2, 3, 4, 5, 6.
Не работаешь. Все, а вон там посмотрим. Остальные каналы тоже так же чисто слышно? Да, проверились? Да, мне тоже слышно. Да, казахский, да? В зуме у него должно быть выключено все.
Құрметті ханымдар мен мырзалар, орындарыңызға жайғасуларыңызды өтінеміз. 2 минуттан кейін.
Dear ladies and gentlemen,
Dear ladies and gentlemen, the next session starts in 2 minutes. Please proceed to your seats. Thank you.
So it's 12:04, but let us wait a couple of more minutes so that people get back from lunch. Dear participants of our conference, the 25th anniversary of the Kazakhstan's pension system. Now, we have a very interesting session on the coverage and public awareness, as well as the education and the intergenerational connections and retirement age. Also, we have 3 distinguished speakers here, present physically here. We have 2 more speakers who will join us online. I will introduce them later. And there will be the presentation on the failure to estimate the risk of own surviving rate, as well as all other risks related to life expectancy and everything that should have been done in the younger age. But before I proceed, I want to show you a couple of slides on the topics that we discuss. So first, this is done because our distinguished lecturers were not preparing their presentation also to include the Kazakhstan experience, but we have our lessons and achievements, and I want to show them now. So first of all, the coverage of the pension system is the issue that is very relevant for our country. And for self-employed population, there was the aggregate payment introduced, and even though 30% of it were later transferred to the pension fund, it did not, in the end, contribute the pile-up of those funds. But this contribution itself makes some payments that were like as deduction to the income tax and also the social security fund, etc. But as we can see currently, there are around 1 million people who are not registered, as we call them, individual entrepreneurs or sole traders. For this group, there was some compensation paid out of the budget because of the pandemic, and also the payment of these contribution was made, and also we had to make payments to the medical insurance fund. And around 20% or less than that were paying on a regular basis the contributions. And the system was in operation for 5 years, and the desire to incentivize the engagement of the public in the pension system became effective for some 75%, but still we have some people who are not covered by the pension system. And also there was the new payment introduced. So it is the payment that the sole traders or individual entrepreneurs pay to fund their coverage by the Accumulative pension fund. So we have the minimum thresholds of pension savings that were set to limit the volume of withdrawals from the pension fund. So let's say that if a 40-year-old person has the pension phase savings at the level of that minimum threshold, then by the time he or she retires, his funds will not suffice. So the idea of the pension system is to create the adequate level of contribution so that they match the future needs. So it was 20%, this unified payment was 20% in 23 and 21.9 in 22. I asked the minister previously, and I mentioned that the public itself is not engaged to a great extent to the pension in the pension system. So we used to have the solidarity system, and once there will be the transition, then we will have different mechanisms of distributing funds. So my estimate shows that there will be about 65 trillion to make sure that people, once they retire, will have sufficient money. We currently have 16 trillion, which is 3 times less than is required. So I will not dwell on these slides, but still you can see the structure of our pension savings. And I wanted to show you these slides just to give you the context, and so that our distinguished speakers take this into account, but I'm sure that you're going to dwell on that in your presentations. And we have one of our speakers, Dr. Guillaume Fillon, who is the Chief Project Manager, and who will talk about the strategy for the coverage expansion and how to improve the social pension systems coverage, because now, for instance, we have a platform-based employment, and the question, of course, is how to engage them, and I'm sure that there will be information on that. Then we have Dr. Michaela Grimm, who is the senior economist from Allianz SE, and she actually is engaged in how the demography affects different aspects, and she'll talk about the right to work versus the right to retire, and she will be about the ageism, about the intergenerational relations, and Dr. Grimm, I would also like to hear your opinion on the increase of the retirement age, and actually, if we are to increase it, how to build the policy so that people understand why it's done and who will benefit from that, whether it's good or evil if we want to increase the retirement age. Then we have Dr. Abigail Hurwitz from the Hebrew University of Jerusalem, and he will be online and from Jerusalem, and he will talk about the financial regret at all the ages and longevity awareness. And we have Sona Lalayan, the OECD policy analyst, particularly financial education, and she will also join us online from Paris and talk about the global survey results and findings on adult financial literacy. And the last to present is Ariel Ferrari, Director Representative of Retirees and Pensioners at the Social Security Bank. And we will also hear about the financial literacy in pensions, and we will have the case from Uruguay, and this is the session in front of us. And now the floor goes to the first speaker.
So good afternoon, ladies and gentlemen. I will try to be short and concrete for several reasons. First, it's the worst time for a seminar since we just had our lunch, and I know how it is difficult to follow a speaker between 2 and 3 p.m. Second, I have to say that I had several questions to raise after the last session, and we had no time to ask these questions, so I hope that we will have time to be as interactive as possible now. And third, I have to take into account the fact that the interprets are doing a great job right now, so I have to be fluid but also a little bit slow in my presentation. So my name is Guillaume Fillon. I am coming from the International Social Security Association in Geneva. I am coordinating the issues on pensions in the ISA, as well as the programs of the guidelines. My colleague Dimitri Karasyov just presented to you this morning. Just to recap, even if it has been presented as well by our chairperson, Dr. Aznan, this morning, the International Social Security Association has been built under the auspices of the International Labour Organization to deal with operational issue, managerial issue, how to implement the political decisions made by the government the best way we can. All the documents I'm going to show to you during this presentation have been provided to the organizers, so if you think that it's interesting, you can have the full reports, guidelines, and good practices I will refer to afterwards, and I hope we will be able to discuss as well these questions later. I was asked to more about the coverage, and especially the coverage of difficult to cover groups, and among them the people who are working with platforms, the platform collaborators, the collaborators of the gig economy, the new shapes of work, the new forms of work. So, why new forms of work matter? First, as you know, social security is a common good. As such, it has to avoid any kind of moral hazard. But the increasing mobilities of factor of production due to platforms, to the gig economy, to the collaborative economy, as they call themselves, offers new perspective for informality and for fraud. So it's an issue as for what regards the coverage of the population for social security rights. Another issue with these new forms of work is that we are confronted with various cases. You've got several types of platforms. You've got on-site working platforms, for example, when you hire a driver with a Uber, when you receive some food with Deliveroo. You've got virtual platforms, and people working for virtual platforms are more linked to the internet intermediation, for example, in the forums, or how to design the website. In some countries, these new ways of working can constitute an issue as for what regards formality, and this is for the country where the economy is very formal, when the formal economy is the majority of the economy. But it can also constitute a way to improve coverage and especially in, I would say, in the emerging economies, where the informal economy is the majority of the economy, and where you can find a counterpart with the platforms. So in the International Social Security Association, as I told you, we are trying to gather, to group, and to organize a knowledge that is coming from the field by, for example, managing a database on the best practices around the world to tackle issues with which social security institutions are confronted, such as well the guidelines on social security, guidances, soft laws that propose ideas for social security institutions to tackle this issue. So as you can see, I hope you can see it, as you can see, there is an issue as for what regards the social security coverage of the workers of the platform economy. We have here a table that recalls first the number of people who are covered. I'm sorry, the table is in French. As you know, Geneva is in the French-speaking part of Switzerland. So people who are covered for healthcare, for pensions, against occupational risks, people working for platforms on-site. Remember, this is the first family of platforms: Uber, Deliveroo, taxi drivers, service to people. And the second ratio is the ratio of people covered for healthcare, occupational risks, unemployment, and pension schemes, but people working for the virtual platform. So, as I said, for example, the website management, the design, the moderation in the forums, and this kind of thing. And as you can see, and as it was said, this morning, a lot of people working for the platform economy are not covered. They can be partially covered. They can be covered for one risk. They can be, I would say, not so well covered for one or several risks, but not of all are covered. Basically, what we can see is that on-site platforms do provide more social protection solutions, do contribute more than virtual platform. So this is a concern, and this is even more a concern since the flux of the gig economy, of the people working with the platforms, is dramatically increasing. In 2021, for example, our colleagues from the ILO showed that while in 2010 we had something of about 140 platforms available, in 2020, that is to say 10 years after that, we had 777 platforms available and hiring people with this strange gray status of collaborator of the gig economy. In the US, we know that 22% of the active population has got a relationship with platforms. But we don't know the quality of this relationship. And once again, this is what is of the essence. It is not the same thing, for example, to sell your used car via a platform or use table, used furniture, or to work for a platform. And for this, we need to deepen our knowledge of people who are actually depending on the platform's revenue, the platform income coming from the platform. So in the International Social Security Association, we had actually several guidelines dealing with the notion of formalization and of coverage. The guidelines on extension of coverage, the guidelines on contribution collection and compliance, the guidelines on error, evasion and fraud, the guidelines on communication, the guidelines on ICT, and the guidelines on employment. In fact, they were dealing with this issue, but not directly with it. They were dealing with the notion of difficult to cover group. Among them, self-employed people were identified as a difficult to cover group, as well as people working for the informal economy. But we had to deepen as well our knowledge on the way to tackle this issue of platform collaborators. That's why we progressively focused on practices that can fit to this issue, practices that are done by colleagues from various national institutions, with the aim of formalizing the self-employed people, also called self-employed people, hired by the new shapes of work, hired by the platform and the gig economy. We also produced some technical reports on the coverage of the platform workers. One of them is coming from the Technical Commission on Pensions, the one I am managing, and it states basically that most of the collaborators of the platforms, most of the collaborators of the gig economy are actually precarious workers with, I would say, not perfect coverage. Even in developed countries, for example, in Germany, there is no compulsory coverage for pensions and for long-term risks for the people working for the platforms. So we started to work in this, with the ILO and the OECD for a G20 technical group on the platform economy, and we provided info and data for the G20 regular meetings on this very specific and topical issue, since the gig economy is quite important in developed countries, once again, but in emerging countries, it can be a kind of formalization of the economy and a new way to have a better rate of contribution collection for social security institutions. So this is an example of the monitoring we do and the follow-up. We had a few weeks ago our regional conference for the Americas, and as you can see, for each continent, we do a follow-up of the reforms that have been put in place, or not put in place but discussed, or not discussed but envisaged, or even special tools that have been put in place countries by countries. I'm sorry once again to go a little bit too straightforward on this, but the knowledge is quite huge, believe me. So if you want to know more, do not hesitate to contact the organizers. They have all this documentation available. But basically, and to summarize, here are the main results of our research and what we can do from an operational point of view. So first issue, well, the idea was to analyze and understand these new shapes of work, the collaborative economy, this new way to work together, and this kind of thing. And from a legal perspective, the answer is that, in fact, it's not new shapes of work, it's old shape of work. It's the collaboration between the worker and the employer, as it was understood in the 19th century. When you went to the manufacturers in the 19th centuries in London, for example, it was quite clear that you bring your work, you are the owner of your work, and you've got a contract between equals, between peers, with the employer, and if you've got an accident, if you don't save enough, if you feel sick, well, it's for you to deal with. You are the equal of the employer. So this is the way the work used to be understood in the 19th century, and basically the platforms are just doing the same thing, but using the mobility that is allowed by the new techniques and the new technologies. So even if, as I told you, we have various platforms, the problem is that this notion is exactly the notion on which social security and labor law was built to answer to this. Because, of course, there is no equality between the employer who is providing the income and the worker, who is the dependent worker. So this is the first answer that was formulated about these new ways of working, which are actually 19th century ways of working with use of new technologies of information and communication. So how to tackle this issue? Since we cannot control it from an administrative point of view, from a national institution, from a body that is compulsory on a territory, basically a national territory, most of the cases. So the idea would be, so the answer that is proposed by the ISA is first, to increase the controls, how to better anticipate the evading maneuvers that are allowed by these new techniques of collaborating together. So the answers that are proposed are based on the fact of the capacity of institutions to increase the data sharing with other social security institutions, with the tax offices, but also, why not, with the platforms themselves, as it is allowed, for example, in Uruguay or even in France, where it is possible for the platform to receive the contributions on behalf of their collaborator. So developing the capacity, the institutional capacity for massive use of external data, using as most as possible smart tools via, for example, the risk profiling, so that you can anticipate on potential maneuvers that are aimed to avoid the collection of contribution, and even more than risk profiling, that is about statistics, you know. Developing what they call the data mining, which is something linked to the artificial intelligence. So it's not about profiling a risk according to the size of the platform, I don't know, the length of service of the platform, or the number of people who are hired, or this kind of thing. It's about using algorithms to detect potential divergence between the classic algorithm of a company, the way it works, the way it lives, the budget and the annual budget it has, and so on and so forth, and the same profile of the controlled platform. Second answer, the possibility to help this platform to comply with the regulations and to become business friendly. This is what we call compliance by design. That is to say, we simplify, the recommendation is to simplify basically the red tape, to avoid too complicated declaration, to simplify the life of the collaborator or of the platform so that they can understand the needs of the administration and they can, answer to the needs of the administration one time forever. As I say, the one-stop shop idea is that you do that declaration once for whole administrations, social security, tax administration, I don't know, local registration, local administration, national administration, and so on and so forth. This compliance by design is of the essence in the gig economy, where people do like fluency. The gig economy is a moving economy. So the less heavy you are, the better it is. There is also to take into account the potential alignment of interests, because self-employed or so-called self-employed, the collaborator of the gig economy, has got a short-term view on his life. He or she just want to end the month, to earn enough money to have a car, a house, and eventually to feed his or her children. So they don't have got the long-term view on the pension risks, for example, or this kind of thing. And the solution to attract these people is, for example, the solution that was followed in China is to give a grant, that is to say, to incent people to contribute to the social security scheme by explaining to them, if you put a shred of money, the rest will be taken by the collectivity. We subsidize, basically, your registration to social security institution, and it works. And once the self-employed, the collaborator or the platform is immatriculated, once you've got the profile and the data, the individual data of this person, then you can progressively come back to normal and receive a full contribution. Yes. Okay, so I'm not short enough. Okay, so I jump to the third solution, the communication. So the communication is of the essence as well. For that, you have different levels and layers of communication to explain to the people that social security is their common good, social security is their, I would say, common house. And one very successful practice is coming from Uruguay, and it's a partnership with the schools and the national education to explain social security, as you explain democracy, as you explain citizenship, as you explain how to read, how to calculate. And in the end, the compliance of the people is more important. That would be my final point. I would say, so these are examples of good practices that I selected for you, but once again, you've got them, if you want them extensively, you've got them via the organizer. I would end, if you allow me, Mr. Moderator, I would end on this. I heard that the question of redistribution was formulated this morning, and the interest of redistribution. So to be absolutely clear about the platform workers, redistribution is of the essence, or else they will not comply. Thank you very much.
Thank you very much, Mr. Fillon. As during the previous panel session, we'll try to leave the time for Q&A session at the end. Right now, I would like to give the floor to Dr. Michaela Green with her presentation. Senior generation, would it continue working or they would retire? Please, the floor is yours.
Thank you very much for the invitation. The topic of my presentation will be the right to work versus the right to retire. So what's that all about? We heard this morning several times that one measure to improve the long-term sustainability of pension systems is the increase of retirement age. But this would dampen not only the increase of the old age dependency ratio, that is the relation of older workers, retirees, to the working age population, but this would also help to cushion the impact of demographic change on the labor markets. However, to achieve the latter, it needs also reforms in the labor markets, because labor markets need to be adapted to the needs of an aging workforce population. The acceptance of older workers in the labor market needs to be increased, and the employability of older workers needs to be increased. Otherwise, any further increases of retirement ages might be perceived simply as a prolongation of unemployment before reaching retirement age and as a hit cut in benefit levels. So if we look at the demographic developments that are in front of us, it calls for a need to adapt the labor markets to the aging workers population. You see here behind me the further development of the working age population in the age group 2064. Here the numbers of the UN population division. So we see here until now, until recently, there was a steep increase of the labor force population worldwide. Since the end of the baby boom in 1970, it increased by 1.8% per year on average, and this increase will go down slightly to 0.6%. Even in Asia, in Latin America, and the emerging markets, we saw the increase of 2% per year. In America, it was 1.2%, and even in the European Union and in Europe, it was still a slight positive 0.3%. So keep in mind, economic growth is one part human capital growth. So in the future, as I said, this will go down markedly. As I said, the world population in this age is said to increase by merely 0.6% in the future. In the US, it will go down to 0.2%. In the emerging markets in Asia and in Latin America, we will see increases of about 0.2 and 0.3%. The only region where we will see further development, population growth will be Africa, where we still expect an increase of 2.5% per year on average. So, and what does this mean in absolute figures? That today we have about 4.6 billion people in this age group. Until 2050, it will increase to 5.4 billion. However, 1.6 billion of these will be older than 50 by then. That means the age group 50 to 64 will make up about 30% of the workforce population by mid-century in all world regions. And we have some differences. We see, for example, that even in some countries like China, Brazil, or Japan, we will have shares of more than 40%. In Europe, we will have 36%. It's the same about in the US, where we'll have also about 30% of the working age population in this age group. However, if we look at the company level, it's striking that many companies, despite these foreseeable developments, still don't seem to have a structured approach of how to deal with the challenge of an aging workforce. This might have several reasons. One of them might be that today the share of the population in the age group 60 to 64 who is still active on labor, who is still working, is markedly lower than in the younger age groups. We see here a drop in all countries in the OECD to different levels. So we see that in countries like Iceland, New Zealand, or Japan, or even Sweden, we have comparatively high activity rates in the older ages already today, where we have only about 22% in the labor force in this age group in South Africa who is still available on the labor market. So one reason might be, of course, the retirement age. In countries where the retirement age are rather low, well, people retire, or there are early retirement possibilities available. But one other reason might be that older workers are still forced out of the labor market by ageism. We know that older workers, when they are 55, they have difficulties to find a new job, and they get unemployed. They take twice as long to find a new job than the average workforce population. And we know also that the risk of being unemployed for longer time, for more than a year, is much higher in the age group 55 and older than in the younger cohorts. These are the numbers of the OECD. We see here that since the turn of the century, the risk or the share of being unemployed in higher ages was 10 percentage point higher than in younger ages. So what are the reasons for this? Well, the reasons given are often that older workers, they lack the current skills or formal qualifications. They lack the technological proficiency. They lack recent experience in applying for a job, and they lack the experience of presenting themselves. But above all, it's especially negative stereotypes which keeps them out of the labor market. Older workers are seen as they are less productive, they're less motivated, they are harder to train, and it's not worth to train them because of the relative short tenure. They have more sick days, their health is deteriorating, and above all, they are more expensive than younger workers because they receive higher wages. So how to fight these prejudices? Because most of these points are just prejudices. We know, for example, from studies that if we talk about learning, older people like to learn. They learn, but they learn a different way than younger people. We know from surveys within HR professionals, I think of one survey I read from an Australian HR survey among HR professionals, that 50% of those who were asked said they see absolutely no difference when it comes to adapting to change. 70% said, well, they see absolutely no difference when it comes to performance. In fact, most of the people of the HR professionals said, well, we see older workers perform better than the youngest ones. It was 27% versus 5% who said, okay, we see the youngest actually perform better. But nevertheless, if the same HR professional was asked, do you hire or do you especially tap at older workers when you have a new job, when you have open positions, only 12% said, yes, we are looking for older workers. And this corresponds to other surveys from the ARP, for example, where only 39% of the companies who were asked in international level that have already policies in place to make sure that in the recruitment and hiring process there are no age biases. So the American Association of Retired Persons in a recent survey said 78% in fact of the people aged between 40 and 65 already experienced or saw ageism in the workplace, and 62% of those older than 55 who were looking for a job said, well, we experienced ageism when we were applying for the job in the applying process. So the question will be, given these demographic developments, how to make workplaces more age-friendly, how to combat ageism, and how to retain older workers in the labor market. So, first of all, make the companies, make the workplaces more age-friendly. This starts with make them ergonomically more age-friendly. adjust the workplace equipment, for example, then especially what's most important, especially for older workers, offer flexible working hours and flexible workplaces. That is what's on the top of the list. If you ask older workers, what would you like to see? What would you make to work longer? Then another measure would be to offer trainings and career opportunities for all age groups, because in many companies we see that after the age of 50 or even 45, you are not even considered for a first career step. And this is especially difficult or problematic since lifelong learning gets more and more important, especially if we look at the new technologies, if we look at artificial intelligence, if we look at robotics. So people need to be able to take over other jobs, or even if they work in physically demanding jobs in younger ages, they need to be reskilled, they need to be trained constantly, that maybe in older age they can take over jobs that are less physically demanding. Furthermore, it needs to foster age-diverse teams to guarantee the knowledge transfer from the older generation to the younger generation, but also because younger and older employees often say, well, we like to work in multi-generational teams. This also increases productivity in the long run. And last but not least, companies can offer health and prevention programs, but right from the start, and not only when you're age 50, and they can also offer, for example, or should offer training to the staff to fight ageism, to make them aware of hidden age biases. And by the way, just one remark, if you make a workplace more age-friendly, you make a workplace or a company also more attractive for younger workers. Because studies showed that, for example, that especially those companies who introduced these kind of measures were also more attractive for graduates, for example, or for young parents who were looking, for example, for part-time jobs. So how can the government support this? So subsidies especially are often targeted to small and medium-sized companies who don't have the financial resources, for example, to offer training support, training programs for their employees. So this would be one measure. Grant subsidies to companies who need to fund trainings, help them in offering or redesigning their workplace, make it more economically healthy. Then grant, for example, older workers who need to relocate, grant them mobility grants, or subsidize companies who employ workers who were older workers who were unemployed for longer, for example. This would be some measures. But, excuse me. The most important measure from the government side is reform of the pension system, because it needs to have, you need to have a smooth transition from retirement, from working age to retirement. Make it possible to have a combination of pension income and wage income for a longer time, like for example in Norway, where we can combine this until the age of 75. And last but not least, maybe one should take a new approach to retirement. Given that everybody is aging individually, given that life expectancy is increasing, given that job profiles are different, the concept of chronological retirement age might be outdated. So in fact, those countries like Sweden, for example, who introduced an age corridor, abolished this mandatory retirement age in a narrower sense, they are most successful when it comes to retaining older workers in the labor market, because at the same time, these countries also grant the older workers a kind of right to work. That is, until the age of 69, for example, in Sweden, companies are not allowed to fire a worker or to stop the work contract because of age reasons. So this is it. In a nutshell, we need to adapt the labor markets to the aging workforce population to make sure that further pension reforms are accepted. And in a nutshell, we don't have any longer more time for ageism. Thank you very much.
Большое спасибо, госпожа.
Thank you so much, Madam Grimm. And now the floor goes to Dr. Abigail Hurwitz from the Hebrew University of Jerusalem, who will join us online. Dr. Hurwitz.
Can you see my slides? You can. So first of all, I'd like to thank you for having me here or in Jerusalem and presenting my work. This is a joint work with Professor Olivia Mitchell from the University of Pennsylvania. And we work, this is part of our longer work on financial regrets of older Americans. And, sorry? Okay. So, in general, we know that there's a substantial effort, and I heard some of your discussions earlier from regulations and, of course, among academics, in an effort to increase savings and demand for insurance and annuitization and so on. But we ask, to what end? So do people really save too little? Do people really need to buy more insurance? And our way of looking at it is to ask them about regrets. So looking back, would you take different actions? Would you do something different? Okay. So this study is motivated by prior findings from the literature showing that older Americans regret. They regret for undersaving for retirement, and specifically about 60% of older Americans regret that they didn't save more during their working years. We also know that there is a very low demand for long-term care insurance and longevity insurance in the US, and there's a substantial literature trying to explain these puzzles. Also, all the decisions that I just described above are closely related. Do you have, I hear someone, do you have questions? No. Okay, so we know that the financial decisions that I just described are closely related to longevity expectations and to perceptions about mortality. In this regard, we know that people prefer to avoid thinking about mortality, and also that they exhibit some systemic biases when they're predicting their own survival probabilities or their own expectations. And there are previous findings, including ours, showing that when we inform people about life expectancy and about longevity, which is a different, slightly different thing, we can alter their demand for annuities. So we have some experimental evidence that merely giving people information about longevity can change their behavior and suggestion to others. From the regret perspective, there's a substantial literature. And this literature, only in a nutshell, suggests that regret occurs when comparing the outcome of one choice or one decision to potential outcomes from others. That is, regret is more likely when people, regret is less likely when people are unable to compare the outcomes of the decision they have taken to other outcomes. And potentially, regret could lead individuals to avoid learning about other possible outcomes. So wrapping all this information, we hypothesize that when providing people with survival information, they will, we will make them think about other opportunities, other outcomes they did not take, and that way we can increase their regrets about these financial decisions. So in this paper, and in this presentation, I will try to give you some information about 3 specific questions. One, which financial decisions do most older Americans regret? And it's important to emphasize that we are focused on older Americans because we want to understand how people, what people think about their financial behavior when they are already close or at retirement. We also ask who regrets more, and I'll give you just, due to lack of time, I'll give you some of the information, but there is much more in our papers. And also, I will try to show you how longevity expectations shape financial regrets in later life, or do the fact that we inform people about longevity changes their perceptions about regret. So how do we do that? This study is based on an experimental module that was fielded in the American Health and Retirement Study, which is a study among older Americans. We basically asked all our participants, and I'll show you some details in a slide, about various regrets, while 2 of the groups were also asked or provided information about longevity, where in one group was only asked about their subjective survival probability, and the others, the second treatment group, also received the objective information from life tables. Sorry. Okay. So for the first question, do older people regret? And I think this is the main information, the main takeaways I want you to take from here. So first of all, in the first row, we replicate results from previous studies. 52% of older people in our sample, and the mean age in our sample is 71. I don't want to give you too many details, but 52% in the sample regret not saving, which means that the regulatory effort to increase savings is based on actual suboptimal saving rates. Also, with respect to insurance, 33% of these individuals regretted not buying long-term care insurance, while 26% regretted not purchasing lifetime income insurance, annuities, which are rare in the United States. So these are really striking numbers. Also, we know, we heard about Social Security before, and in the US, you can postpone your claim age. 19% of our sample regretted claiming Social Security too early. 34%, and this relates to the previous presentation we heard, regretted quitting work too soon. So from this we can learn that people would have preferred to work longer. Finally, 9% of our sample, regretted being financially dependent on others, and we have some analysis related to the gender, but I don't have time now. I'd be happy to talk and answer questions afterwards. Who are those who regret? When we look at the various financial regrets, we find that the proportion of female is higher among those who regretted not buying long-term care insurance, lifetime income, and also being financially dependent. So basically what we see here is that females significantly regret more. Also in the US, we see that the proportion of Black participants is higher among those who regret. And one more interesting detail is that those in good health are less likely to be in the group of people who regret. So they are more likely to mention that they did not regret. So we know that older Americans regret, and we have documented the characteristics of those who regret more. And now the question is, what can we do? And as I mentioned before, our idea idea was that since in order to understand in order to regret, you need to understand the other potential outcomes. We provided participants with additional information about survival probabilities. So without going into too many technical details, what you see here is the treatment in which we provided life tables information to participants in our study. And basically what we see here is that comparing to the mean, to the average of the regret among this subgroup, those receiving information about the expected life expectancy, expected longevity in the population reported an increased regret of 32%. And this is just the number over the full sample. When we study subgroups who are more likely to regret, we find, for example, that for healthy individuals, being provided with longevity information increased financial regrets by even more. So for example, their lifetime income regrets, the regret for not buying insurance, longevity insurance increased by almost 52%. They also regretted more claiming Social Security too early. Again, these are the healthy individuals. And to give you an additional example, these are people with higher income. This is the median income earners. And we see that these people, when provided with survival probabilities, with longevity expectations, increased lifetime income regrets by more than 100%. So the comparison between this number and the average is more than 100%. So these people regretted even more for not buying lifetime insurance. They also regretted not saving because probably they could have. And this could be used as a policy tool. So to conclude, I was told I speak 10 minutes. We show that many older individuals in the US express regret about key financial decisions, and that women, Blacks, Hispanic, less educated, unhealthy, those with low health, etc., regret even more. We show that providing longevity information can shape regrets, specifically about longevity insurance and claiming Social Security, and for some people also for undersaving. This suggests a potential mechanism explaining past findings that we know from the literature and from our own work about the role of longevity information. And as I'll end up with what I said at the beginning, we show in previous work, also with Orly Sadeh from Hebrew University, that providing longevity information, at least in experimental setting, increase annuitization and increase recommendation to others to and buy insurance. So potentially this goes through a mechanism of regret. Thank you for having me, and I'm happy to answer questions.
Thank you very much, Ms. Horvitz. I think that we need to build the awareness policy, population awareness policy, in such a way that so what are the events with higher probability, well, at least that their generation would meet when they meet retirement age, under different behavior concerned with the participation in the pension system. And I think indeed that the regular informing and incentivization for people, so that people would think of it more often, would help to make the population be a more active participant in the pension system. And the next speaker is Sona Lalayan, an analyst of the Department of the Financial Education in OECD. And she would tell about the improvement of the financial literacy, please, Ms. Lalayan. She also participates online. We can hear you. The floor is yours.
Thank you. Thank you. Can you hear me well? Yes.
Да, да.
Yes, we do.
Yes. Thank you for inviting the OECD to this very important event. It is my pleasure to present today and to share some results and findings of the OECD Global Survey on Adult Financial Literacy. And first, I would like to start my presentation by introducing the OECD International Network on Financial Education to give a brief background about our work. The network was established in 2008, and now it comprises more than 270 public institutions from more than 100 countries and economies. And the work of the network focused on important components of financial literacy, including collection analysis of data on the financial literacy of adults, students, and MSMEs. Also encouraging the strategic approach in form of national strategies for financial literacy, supporting recent trends in finance, including digitalization of finance, financial resilience, sustainable finance, providing guidance and tools for different target groups such as youth, women, MSMEs, seniors, and also conducting Global Money Week. The work of the OECD INFA is recognized in global fora, G20 and GPFI being the implementing partner of the OECD, and also OECD INFA regularly contributes to APEC and Asian deliverables. The network implements also some regional and technical assistance projects in European Union, Asia, Latin America, in CIS countries, and Southeast Europe. I just wanted to flag very quickly the main instruments of the OECD, which is the OECD Recommendation on Financial Literacy. It presents a single, comprehensive, updated instrument of financial literacy to assist governments, other public authorities, and relevant stakeholders in their efforts to design, implement, and evaluate financial literacy policies. And it also drives a holistic approach to financial consumer issues, where financial literacy, together with improved financial access, the necessary consumer protection, regulatory frameworks are expected to support the financial resilience and financial well-being. And the key areas focuses on, as I mentioned already, on national strategies for financial literacy, the various sector of financial landscape, including saving, insurance, pension, investment, credit, and also on effective delivery on financial literacy programs. And the recommendation emphasizes the importance of evidence-based policies and data collection. In this slide, I wanted now to talk about the measurement of financial literacy and about the methodology that the OECD follows. We follow the methodology of the OECD INFA toolkit, which was updated several times since its creation. The last update was made in 2022. The questionnaire included in the toolkit is primarily designed to measure financial literacy in an international comparable way. And the financial literacy components of the questionnaire reflects the OECD definition of financial literacy, namely a combination of awareness, knowledge, skills, attitude, and behavior necessary to make sound financial decisions and ultimately achieve individual financial well-being. And the financial literacy scores is computed measuring a set of basic knowledge, behavior, and attitude. So it includes questions to measure these components, but it also collects information on a number of other outcomes, related outcomes, such as financial inclusion, financial resilience, financial well-being. And we have introduced a new measure, which is the digital financial literacy the last toolkit, and I will talk about some of the results of this measure in my next slides. And here I just wanted to show the reports that have been produced using this toolkit. The new report will be published this year, where more than 30 countries provided data on financial literacy. We have also regional reports, including in the region of CIS. Now, time to talk about the results and findings. This is the result of the OECD IFE 2020 International Literacy Survey, and we can see from the slide that financial literacy is limited across the participating countries and economies. Because scoring the maximum of 21 effectively means that an individual has acquired a basic level of understanding of financial concepts in their financial dealings long-term attitude of finance. However, instead the average score across for participating countries and economies just 12.7 out of possible 21 and 30 for OECD members only. This represents 65% for the total sample and 62% for the OECD participants from the maximum possible. In this slide, I wanted to show some results from the CIS region from the report financial literacy levels the CIS produced in 2021, and we can also see that the financial literacy is limited in CIS countries. The average score across all participating countries and economies is just 11.7 out of a possible 21, showing that there is significant room for improvement, and the average score is below of the average score that we have seen in our previous slide of the international report, and it's also below from the OECD average score. The average heights are important disparities because higher scores were achieved, for example, by adults in Uzbekistan, in Kazakhstan, 12.5, but while low scores were obtained by adults in Kyrgyz Republic, Armenia, and Tajikistan. And further important patterns and heterogeneities exist between the components of financial literacy, which are the financial scores, knowledge score, financial behavior score, and financial attitude score. And we can notice that the financial behavior score is the highest relative score across all the participating countries of the CIS. And we can also notice that Kazakhstan scored high in behavior, which is of 65.4% of maximum score, but also the scored averaging attitude. In this slide, I wanted to emphasize the questions that are used to compute a financial knowledge score. So this looks at the levels of basic financial knowledge, focusing on responses to 7 questions, which are designed to test the knowledge that is widely considered to be useful to individuals when making financial decisions. We can see that on average, the question most widely answered correctly across the sample is about understanding simple interest charged on a loan. It's 81.5% of all adults. 81.5% of adults gave a correct answer to this question. However, we can also see that understanding both simple and compound interest is a very challenging concept, and only about 1/3 of respondents in the CIS were able to make a simple interest calculation, and a very small minority, 14.4%, of respondents were able to show understanding of both simple and compound interest. The survey also asked participants to rank their own financial knowledge. We use this question to understand how confident individuals are in their own financial knowledge, which may lead them to more active use of financial products and services, but also riskier behavior. And you can see the results in the slides. The larger number of respondents assessed their own financial knowledge as average, 66%, and about 1/5 of adults in the region assessed their financial knowledge as high, while only 12% suggested their financial knowledge was low. In this slide, we show the measure of financial well-being scores across the CIS region. The core elements of the operational framework of financial well-being proposed in the OECD toolkit include financial control, day-to-day financial life, and long-term financial planning. And the result shows that the average financial well-being average score of all participants is below 50 of the maximum. And this suggests that on average, the surveyed individuals do not consider their financial situation to contribute positively to their financial well-being, but rather to add stress and worry.
I'm sorry, Ms. Lalayan, we are short of time. Can I ask you to continue?
Yes, I will be very, very quick. And I will move to my next slide, which shows some measures of financial resilience. The financial resilience is important, especially in a time of crisis, and the components looks to see the differences in available financial safety net in case of loss of income, and also how individuals act when they deal with financial shortfall. And also the results are not encouraging here, because we can see that only 30% of respondents could live for longer than 6 months if they lost their main source of income. In my next slide, I wanted to show some results again from related to long-term planning and retirement. And to the question if they plan their finances for a long-term run, only 58% of participants stated that they plan for the long-term financial planning. And we also wanted to show what are the reliance on the retirements that adults on CIS plan to use. And we can see that about 70% of adults on CIS suggest that they plan to rely on a government pension when they retire. And evidently this is not considered enough, because over 50% should that they will rely on a partner or family for financial support in old age, and they would have to continue working and use saving they have accumulated over their lifetime. For example, it's 58%. Just to flag the results for Kazakhstan, there is a greater reliance on public pension, 78%, but also there is the highest proportion of individuals responding that they plan to rely on a private pension, which is 59. So this was my last slide regarding the results. I will be very brief on my next slides. I just wanted to flag some of the tools and guidance that the OECD has produced. I will not talk because it will be because I'm short of time, but you can find all the relevant recommendations that OECD produced on financial literacy to support countries to improve the levels of financial literacy of their population, and supporting also the needs of different citizens.
Спасибо.
Thank you very much.
Спасибо, госпожа Лейян.
Thank you. Thank you. I've actually explored this report, the 2021 OECD report, and our population is very much advanced when it comes to online banking technologies, and they're really good at short-term financial matters and not so good at long-term financial matters. And our system could be really a good platform, to for financial literacy and public awareness, but it is yet to be. And 78% of population that rely on the pension system indicate on what concept of the pension system is. So not everyone has really good understanding of what the picture is. Our next speaker is from Uruguay, Mr. Ariel Ferrari. Please, the floor is yours. Hello, everyone. My apologies, but I speak only Spanish, but I will try to convey my message. I thank the organizers Unfortunately, now the technology replaces everything, and we had some issues with translating all the things. And I thank our Spanish interpreters, Svetlana and Amir. We thank them for helping out. So I think that we now have the time to explore the situation in our country, and we are geographically located rather far away, but still there is something to learn. So Uruguay is the country that is well developed when it comes to rural development, but it's also one of the 30 countries that that shows the signs of financial instability since 1995, and also we also have had the pay-as-you-go system, and now we have this mixed system, so it is partially pay-as-you-go system, and also some portion of security there, and now we are updating it. So now it is very important for us because we have people from Venezuela and Cuba, and we cover in them as well. And we also need to look into the labor regulation of our migrants, and we need to sign agreements. And Uruguay now have 30 bilateral agreements with the different countries who also, and there are 5 big agreements, and this is Mercosur, and it is not only about the pension system but also the mobility and some seasonal work. So it is the right for people, who come just for seasonal work or to work in other countries. So it has to be regulated, and it has to meet the reality, and we need to tailor it to the social security system. So now the labor force is replaced with technologies, and we need to analyze how to administer it. And we need to look at the retirement such as the pension funding as the pension system is being reformed, and also financial resources. We need to look into the life expectancy and how to extend it. But labor, like physical labor, now is replaced with the technologies. So we need to think how the social security be insured by the government, and how investments can be made by private companies to increase their revenues. We also needed to ask them made contributions to fund social security. Канал не тот. Канал. So now we need to make investments, and oftentimes the depositors who do not want to be in. So oftentimes these contributions are seen as another tax, so they don't want it, and potential contributors try to invest somewhere sideways. They simply don't want to be in a situation that they are part of the system, and the system doesn't let them go, especially when they have young children, small children, and they have some commitments. And in the end, it becomes even more important to maintain financial stability of the entire family. So the system, as it evolves, as it was evolving, was changing, and the pension system is closely related to the healthcare system when it comes to the coverage of basic needs. And sometimes one family member would be earning money to provide for its own members, and thus there was a need not only to formalize it, it was really important to create such a system that people would want to be a part of it, and this system could rest on a few pillars. And we understand that some of the potential contributors may not well understand what the system is all about, and sometimes the salary is not enough to cover the basic needs, so they may not be really incentivized and motivated to fund something that may or may not happen 30 or 40 years later. So whether these long-term funding makes any sense. So it is really important to raise awareness and to make sure that people understand how it all works. So also the accessibility of information become even more important. And of course, we are a part of this economy, and there are a number of researchers who studied and looked into the asymmetry of information and how it is provided. And even though everyone may have symmetric information, there would still be some processes, and not a single market participant would explain the processes that would come later. And it appears that many people don't understand what happens on the financial market, and they have some gaps in their knowledge, and there was a negative experience in Chile where everything was planned, everything was good, and but less than 2% of people understand the commission that or the that they pay out and the contribution that they pay out, and not so many understand what percentage of their income shall be deposited. And we had this really interesting situation in Chile, and we had the Bravo Commission, and the main idea was to create a social security awareness campaign so that the administrators of the pension fund were able to even make the topic more important. And maybe some of the programs have to be piloted. But what's most important is to make sure that people participate on a regular basis. It's not only to increase the volume of the savings, but also to make sure that the quality, the knowledge themselves of the information provided is of high quality. And we need to understand how do we manage the assets and what are the priorities of those people who still work and those who are retired. So it is important to engage the experts, and also important that people would have sufficient knowledge, so that we don't have situation where people lack knowledge or they have no information at all. Sometimes people do not know how to select the administrator. Sometimes they choose the administrator not on the return that they can potentially have, but sometimes it's all about relations. And people think that it's good when others have nice vacations, and it means that if a person can pay this much for vacation, then they can manage the asset, which is not necessarily true. And there was a book published in 2020 that covers 4 decades of privatization in Latin America. And there was an attempt to describe the new economic reality in Latin America, and low-level contributions don't always correlate with social policies. So it is also important to pay attention to the fact that only 22% of employees on average contribute somehow to the pension system. And if we compare it with our experience, I actually have like 4 books with me. So we have the books about the first, the second, and the third decade, and it was well described. And it's more like how an adult feels once he or she completes the education, and what they think about the pension system, about the accumulative system. So we do need to raise the awareness. And this book also has the portion on what was happening after 1980s in 30 the Latin American countries, including Uruguay. So it's only 22% of workers who are actually contributing to some public programs. And after 13 years, of course, their share increased, but to increase their participation in the collective system, it required a number of years of educating them. Human factor does play a role, so we do have some obligations and commitments, and we do need to be mindful of the rights of other persons that we need to respect. And we have to also keep in mind that priorities may change. And here this slide shows the data for 2018 across 13 countries, and so it's 40 in Latin America, 40 in Eastern Europe, including some Soviet Union countries, ex-Soviet Union countries, and also United States and other countries with developed economies, but aging populations. And some countries do not think about accumulated systems, but the methodology has to be different depending on the context. And also, there can be some sanctions for failure to meet some requirements, but oftentimes these sanctions are insignificant, or if there is zero participation in the system. So all these risks are pretty high. Nevertheless, we have a lot to do if we want to make the retirement a comfortable period. And of course, a lot of actions is required to make the system sustainable. And recently there was a reform in Uruguay, and we hope that in 5 years' time the reform will be in full throttle. But we need to continue working in different areas of economy. So of course we mean aging population, and I think that it is the most relevant topic that we have today, and we do need to think how to engage adult population, older population. We all want to live longer, and we don't want to lose the quality of life as we live longer. In 1994, the World Bank reviewed the aging population as the crisis, and it was a problem for many countries, and there was a need to generate this economic activity. And this economic activity had to be generated to support the aging population, and oftentimes they were investing in other economic sectors because they didn't know what will be happening to them. So the truth is that the Latin Americans cannot claim their pension benefits for any reason, and we understand that there should be some alternatives, and we may want to be more flexible with our depositors, but in Uruguay we have another vision, and more or less there is all the same, and there was not a precedent that there would be choice given to a person to dispose of their pension assets. So, but my message is that during the transition, countries may work in a different way, and the approach to that, or the methodology, is not the top priority. The top priority is the quality professional management and administration of the assets. In 2006, even though the funding issues were resolved, the bank would not actually put in the center the main goal of the pension system by maintaining the budget, the restrictions, and receiving the contribution, and also the elderly population's revenues were not in the focus because they were not seen as an important part of the social security. And when we spoke about the decent pension, we did not take into account the revenues of the adult population.
And quite a generalization, and we were witnessing 4 decades of active privatization in Latin America, and in most of the countries, political regime at the moment of reform was far more democratic, and the more democratic was the regime, the higher the probability of the full privatization of pension, and a similar situation occurred in Chile. And speaking about structural reforms, speaking about the privatization, very often these reforms were not preceded by a social tax. And in 1995, when we had a voting in Parliament, and it has been stated that it won't be a reform of a social system, that it won't be sustainable eventually, because our structure and the structure of the organization it does not fully present the political forces as per the coverage of the older age population, and we see that it's being extended in the majority of the countries, but not due to the accumulative. And it's also not thanks to the active involvement of the states. Very often, private systems undertake more and more responsibility, and also there is an understanding that female, on average, the life expectancy is higher. So we've taken the 15 minutes of coffee break that should have been, and we would need somehow to let the other panel session begin. Thank you. Yes, I would conclude then my speech, and I would like to say that indeed, on the other hand, it was an important part, but starting 2007 to 2020, in the education field, we had various programs, and we've spoken a lot within the framework of these programs about the social structure, and we have worked a lot with the representatives of academia. We've spoken about the social insurance, and starting 2020, this subject remained relevant, and it's really one of the issues that are still relevant. And every student has these books on his or her table, and starting 5th or 6th grade, every student has access to these materials, and we have a separate discipline in our schools. And also we're stating that we've managed to provide this education to 2 million of population, and the total population is 3.5 million. And we've tried to achieve a situation when the employees and whoever is involved in the education would, together with the students, work out these materials. And I think that this is the responsibility, the initiative that we have undertaken to make this program really efficient, and because eventually we wanted to see the effect of this education program in our society, and we are hoping that as a result basically the outcomes were good, and we can use it as a good example, because education field is of extreme importance for all the countries. Thank you very much, and I apologize if I have taken a lot of the time. So I would suggest all of the participants, if you would have questions, you would ask them during coffee breaks and dinner. And I'd like to thank all our speakers. All the subjects that were discussed today were quite useful. The platform occupation is actually, there are recommendations from the European Union, and I think we should basically study it quite thoroughly, because that's a new form of occupation that's really going up in the country. The financial literacy issues, unfortunately, we have a very big room for improvement here, from scratch, so to say. And as per the regulation of so basically the regulation and proportion of employees of various ages, and I think if you look into the offices of many of our companies, it's obvious we have some disproportions, and this subject is also relevant for our country. So everything that has been stated at this session was relevant for our country, and I'd like to thank our speakers for their interesting presentations, and I'd like to give the floor to the next panel session.
Құрметті ханымдар мен мырзалар, орындарыңызға жайғасуларыңызды өтінеміз. Келесі сессияның жұмысы басталады. Рахмет. Құрметті ханымдар мен мырзалар, орындарыңызға жайғасуларыңызды өтінеміз.
Dear ladies and gentlemen, I kindly ask you to get back to the hall and take your seats. The next session starts its work.
Добрый день.
Good afternoon. I don't know, do we have anybody who is there still drinking coffee, or we have here everyone who's present? Thank you.
So let's start our third session of the day under the name Investment Strategies, Risk Management and Supervisory Regulation. We have distinguished panel of speakers, and let me give a floor first to Mr. Ambrogio Rinaldi, who is social insurance supervisor of Italy and simultaneously president of International Association of Supervisors. Please, Ambrogio. Yeah, and because we are behind the schedule and need to finish in presumably in 20 minutes, but okay, let's try to finish in 45 minutes. Maybe we try to restrain ourselves to 10 to 12 minutes time for each speaker.
Sure.
Thank you.
But anyway, let me thanks very much the organizers for offering us and myself as well this occasion to know more about the issues relevant for pensions in this country and also in the region. Here I'm representing, as you know, the IOPS, the International Organization of Pension Supervisors. That is a worldwide organization, has 91 members. Kazakhstan, the authorities of Kazakhstan are a member. So we are glad to be here and to favor as much dialogue and exchange of views and experience as possible, not only with Kazakhstan, but also with all the countries of this area. We are really keen to reinforce and favor all kinds of exchanges of experiences on this area. So please contact myself or contact our secretariat that is in Paris. We are very much connected with the OECD in terms of labor current work. We have a lot of projects that we run together with OECD. You will find in my presentation an annex explaining and presenting all our initiatives, research, guidelines on a number of topics, focusing on supervision, but not only on that. So I'm sure that you will find something interesting for you. I'm not going to cover that now because actually I was appointed in this session focusing on investment strategies. So I will try to focus on what is more relevant for this and for the choices that you are making, that you are considering to make at the moment, offering again choice to members about different providers, private sector providers, and so on and so forth. So we can go to the second slide. I have the, so what, how can do I should point over there? No? Please help me. Okay, wonderful. Okay, so we will focus, I've presented IOPS already. I will focus in this presentation on the design of the defined contribution systems and schemes, then issues related to the choice for members, how much choice, what kind of choice systems and the schemes can offer to members, what are the implications in terms of investment strategies and investment options, and I will also talk about payout options, where also choice can be given to members, and also on this there are a number of implications in terms of investment strategies. And then I will focus at the end on major trends gaining consensus globally that may be of help of any country, included Kazakhstan. This is again what I IOPS does, but I have already covered this. You have the indication of our website for further information. So, first of all, let's look at how defined contribution systems and schemes can be designed. Let me say that, first of all, that design can vary a lot. Even when you have decided to have a defined contribution, fully funded pension schemes, you have a number of things that you still have to decide on. It can be mandatory, it can be voluntary, it can be something in between. Mandatory can be mandatory only for employers, only for members, both for employers and members, or you can have automatic enrollment that is defined as something that applies to members that are usually automatic enrolled, but they can opt out. And that is probably one of the major trends around. This is easy, automatic enrollment is easy to be applied to the employed people with a formal work relation, but obviously it's much more tricky for the self-employed and much more tricky for the informal workers. So there is a number of issues. Then there is an issue of where the money comes from for the contributing in the pension funds, because we are talking about fully funded pension funds, so you have to put money into the system. And there are a number of issues that we may want to consider. I don't want to focus on that because otherwise I wouldn't have time to talk about investment strategies. Then you have to look at how much choice you want to offer to members. You can offer no choice to members. That is one possibility. More or less, it is what you were doing in the last few years, probably. And this is not something very strange. Also, other countries do that and plan to do that. For example, the Netherlands, that are usually considered a leader in the way pensions are managed in general terms globally. This is what they are going to decide to do. They are going to go for fully funded defined contribution pensions, changing from defined benefits, because they currently are in defined benefit, but they will not plan to offer a choice to members. You can offer the choice of different providers. You can offer choice of investment options. Every provider could offer different levels of risk exposure, different combination of asset allocation, equity, bonds, very conservative, more aggressive, so on and so forth. And also here, one major trend is on defined default solutions. So some choice that is defined by expert judgment, let's say, that is supposed to be a kind of good for almost everybody, but then you have the possibility for individual members to opt out. Usually default solutions, the more popular are some kind of life cycle default solutions where you are exposed to more investment in equities, more long-term looking investments, looking more to a higher return in the long term when you are young, and then reduce that risk exposure when you are close to retirement. And then the same kind of issues about how much choice you want to give to members also applies to payout options, and that the reasoning possibly become even more trickier than what it is for the accumulation phase. And what I want to underline is that there is a very strong interaction between design of the pension schemes, regulation of the pension schemes, and supervision, because they obviously are very much, they have to be consistent. The whole picture has to be consistent. A good reference for the design of the defined contribution systems are the OECD recommendations. I was saying that we are, as IOPS, we are very much in contact with the OECD, and there is this very good document that in 10 points that you see it here. I'm not going into it because it would take too much time, but it is a very concise document, about two pages, little more than that, where you really can, if you look at that, you can find a lot of inspiration about how a system, a defined contribution, fully funded system can or should be designed. Let's start focusing on choice for members a little bit more. So I said you can, first of all, choose, offer choice to members regarding the provider. You have been for some time in the situation of not offering choice with only a public sector provider. There is obviously the possibility to offer choice between a public provider, a number of commercial providers. There is also the possibility to put in the picture also non-profit private organizations, like organizations sponsored by trade unions. This is something that is popular and also effective in a number of countries, including my country, Italy, because there you have, at the same time, you have an element of competition, because you have a number of providers in the market. But the non-profit nature of this kind of entities ensures that the competition goes the right way, goes not in the sense of having higher costs and possibly competing only on the commercial side, on selling products that is usually very expensive activity. So here, the main issues in the offering choice to the provider in terms of regulation and supervision is basically an appropriate level and nature of competition to keep costs low, to ensure value for money for schemes that are actually offered. And the established good practices that I would mention, one, I mentioned it already, the presence in the system of efficient non-profit making schemes. The other one is just to put in cost caps that allow, obviously, costs to be kept at a proper level. Let's go to the another dimension on which offer can be, choice can be offered to members. First of all, investment options. So different levels or different investment strategies, asset allocation that you may want to offer to members. There is one general principle in defined contribution schemes, that investment risk should be assessed from the perspective of members. It's not anymore from the perspective of the institution that manages the scheme, but should be from the point of view of members. But also here, it is important to focus on what are the implications when there is no choice or when there is choice. When you have a defined contribution system with no choice for members, basically what happens is that the fund administrators have, for the general principle that I was mentioning before, in principle to make the interest of members, but it is their own responsibility to decide what to do. So they are supposed also to change the level of risk to which they are exposed, to which the fund is exposed with respect to the market conditions and to a number of factors. And in this case, supervision focuses mainly on the quality of governance, the fact that the interest of members is actually taken into account. Usually, in this case, there are limits to investment in different kind of financial instruments, and so limits have to be respected. So it is a kind of more, the second kind of supervision is more compliance-based than the one that we used to call risk-based, that looks more to governance issues and the way risks are managed, not whether strict limits are actually respected or not. When investment choice is offered to members, actually the assessment of the appropriate risk, if you think about, is actually split between the administrators of the fund and the individual members, because at the end it's the individual members that make the final choice, even if you have default options, because they can always opt out. And so in this case, what is very important is the information that you give to members, the tools that you give members to make appropriate choices, so pension projections, and at the end, financial education, that we know that is an issue and not easy to be improved and increased in any country. So these are the kind of issues that you have to think about. And then we have the payout phase that in defined contribution schemes is usually separated from the accumulation phase. So it is another layer of decisions that has to be taken at the end of the accumulation phase. Usually what regulation does in terms basically of design of the schemes is favoring annuitization, favoring buying annuities. This was discussed before in other presentations. But an annuity market is difficult actually to develop, also in very, very well financially developed countries. Even just to make an example, in the UK, they did try to develop an efficient annuity market, but it was not fully successful. And for a number of reasons that I mentioned here, a few issues. We can discuss this if you engage with us on these discussions in the future or later at dinner tonight. And one thing that I want to mention also is that annuities have one undesirable feature, that they are regressive by nature, because as you may easily understand, life expectancy, so the number of years you can expect to live, are very much correlated positively with education and with income. The more you are rich, the more probably you can take care of yourself in terms of health expenses, and so you will live longer in terms, at least in terms of expectation of life. So while I was mentioning that in the accumulation phase, we do have at this point a number of consensus suggestions to be presented. Here in the payout phase, frankly, I must say that still there is no full consensus on what should be done, if annuitization is really a good thing to consider, because anyway it covers the longevity risk that is in principle what pensions are made for. But it is an issue anyway. So let me go to my final slide. Just to recapitulate the trends that are gaining consensus in the management, in the design, regulation and supervision of defined contribution fully funded pension schemes. First of all, they should be in a more general context of pensions, together with other pillars. So basically, in most countries are going for multi-pillar solutions where you have at the same time pay-as-you-go and fully funded components, where you may have a combination of components with or without choice for members. So basically the message that I can bring to you is that extreme solution, everything on the financial markets with a lot of choice for members, or everything on the public side with financed as pay-as-you-go with a solidarity scheme based more on taxes. These two extreme solutions probably are not are not good, and anything appropriately balanced in between is an improving thing that countries can do. Other very strong message is automatic enrollment, life cycle schemes, default solution as a life cycle scheme. So things that are thought about experts, but are not compulsory for everybody, with some element of choice that is offered to members. Then, because we are in the session talking about investment strategies and risk management, there are two trends that are obviously becoming more and more important. One is an increasing proportion of investments in illiquid assets, such as infrastructure, that I guess is important also in this country as in many other countries. Private equity and debt. Instruments that offer you in the long term a higher return, but they are basically well fit for what we can call patient investors, as should be pension plans. Pension plans should not look at the short term. The short-term volatility actually is not important. What is important is the long term. And then obviously also in this framework, looking at the long term, the sustainability issues, so the integration of ESG factors in the investment process. So I finish here. The annex is not for being presented here, but it is in the slides, and as I expressed it again, I really welcome all representatives from different countries in these regions that want to take contact with us and come to our meetings, engage for any kind of support and dialogue and assistance. Thank you very, very much.
Thank you, Mr. Rinaldi, very much. And I hope that Kazakh regulators, both on financial institutions regulator and social insurance regulator, will take more active part in the workings of International Organization of Pensions Supervisors. Thank you again. Yeah, as the organizers put in the schedule, our second speaker will be online. It is Mr. Bertrand Moreau, KPMG Canada, partner of KPMG Canada. Please. I hope everything is okay with the system.
All right. Can you hear me?
Yeah, we hear.
All right. Good morning or good afternoon, everybody. I'm based in Canada, so for me it's like 6 a.m. in the morning. Very happy to be with you today. Let me know if you're able to see my screen.
Okay, screen is here.
Yes. So just short introduction. My name is Edward. I'm a partner in KPMG based in Canada. I'm actually leading the risk management practice, and I've had the chance to work with many local and global pension funds around the world. I had a stint of experience in Singapore, in Australia, in Middle East, and now in Canada and the US, and I've worked with more than 20 pension funds. And the objective today is, and I know we have a few, I would say 15 minutes, so I'll try to really focus on the key salient points, is to focus on some of the results of a survey we recently launched in 2022 that aims to provide a bit of a state of the land in terms of risk management adoptions across pension fund. What are some of the priorities? What are some of the challenges? And what can we expect in terms of development, in terms of risk management? And obviously, I mean, we're talking about funds that manage anywhere from 1 billion to a trillion asset under management. So I think what is really important before we go into the detail of risk management state in pensions is always to look at it in the context of what's the purpose and objectives of pensions. And these are largely to deliver sustainable and stable returns to the members. And that means and entails focusing on delivering long-term growth and performance to remain fully funded. It's also about delivering outstanding services in terms of pension administration and payments and payouts, but also obviously, and we talked about it earlier around ESG, which is to contribute to making and creating a better world through investments. And this is not just for the members or the partners, but for everyone. So what does it mean? That means that pensions need always to make the balance between performance, maximization or optimization of returns within set limits and targets, with taking enough risk to achieve those returns, while making sure that they are taking calculated risk and avoid any undue risk of loss that would prevent them from meeting their financial and payout obligations toward their members. And pensions are exposed to many different risks, right? We can talk about portfolio or investment risks, such as market risks, around viability of investment returns in the portfolio as a result of market change, and this can include interest rate, which I think is a very important, obviously, component right now, or liquidity risk around difficulty in selling illiquid assets for its full price during a period of market stress. And these risks are typically managed through different portfolio construction and asset diversification strategies. There's also actuarial risks around change in demographics that affects assumptions around actuaries. And this is, for example, around longevity or retirement rates. And finally, an area where pensions have focused a lot of their time and efforts are on the non-investment or non-financial risk. And this includes, the traditional operational risk, cyber risk, protection of data privacy, third-party risks, sustainability around people. And these are risks that are managed through different processes, technologies, and people strategies. So yes, funds need to perform and achieve return. Yes, funds need to take calculated risks to achieve those returns. And ultimately, it's this junction between performance and risk where risk management applies. And the ultimate objective being to help organizations improve their ability and confidence in managing risks in line with their strategic objectives, while making sure that they can deliver on their financial obligations. The survey had many different takeaways, but I'll really focus on a few, and I'm happy to share the survey, the detailed report with the different participants. This slide really shows that, in general, pensions around the world have set up very strong governance around risk management. One of the models, the most commonly adopted, is the 3 lines of defense model, which is, I understand, a model adopted also by UAPF. And this 3 line of defense model really defines and segregates roles and responsibility across the organization in terms of managing risk. Typically, the first line is accountable to identify and manage the risks. So this could be the investment or the deal teams. The second line, such as the risk management function or compliance function, is here to provide some level of oversight and independent challenge and review of risk-taking activities happening into the first line. And the third line is here to provide independent assurance on the adequacy and effectiveness of risk management. these are typically internal audit function. And what we can see here is that the second line, so the risk function, is really taking increasingly a front seat in organization. And that really demonstrates that the efforts from funds to protect the assets, to protect the interest of the members, and to make sure that there is really this element of independent and objective review from the second line. And that means what? That means the risk function is increasingly being given the authority, the stature, the structure, and the support from management and the board to drive the risk agenda. So yes, most funds have a chief risk officer or equivalent, typically reporting to the CEO and independently to the board or to the audit committee or equivalent. And this CRO usually cover all risks, both investment risks and non-investment risks. Mandates, roles and responsibilities of the CRO function are usually clear and approved by the board, which is fundamental. And the size and complexity of the risk function really vary across organization. That will really also vary based on the size of the pension, whether it's managing 1 billion or whether it is managing 1 trillion. And the operating model in general of pensions in terms of risk management really vary across numerous pensions. As you can see on the left, all have actually already established what we can call a foundational risk management model, where the risk function set up the policy, provides some level of independent review, and facilitates some level of reporting. But what we can see is that there is a trend, as I mentioned earlier, to really further mature the risk management function to a more integrated model, where we build more specific skill set capabilities within the second line around specific risk topics that can be around, for example, ESG, information security, data privacy, operational due diligence on the external fund managers, and make sure that really risk management is not just a parallel process, but it's really integrated into everything that the pension is doing. The next slide is really showing you, again, a representation important to really understand the role of a risk function, where traditionally the risk function had more of a governance role, which is around setting policies, limits, standards, and facilitating reporting, to a way more integrated role, which is around to provide value by challenging the business, providing some level of independent review, but also acting as an advisor to the business on risk-adjusted return and risk optimization. This next slide is quite interesting because it shows from the survey results that, yes, organization and pension in general are fairly confident in the way they manage their investment risks. So typically market, liquidity, credit, leverage, and those are really core capabilities that have been built over time and are really integrated within the core of what investment means. What this also shows you is that all the non-investment risk, and we can talk about operational risk, ESG, third-party, talent, model, digital distribution, are areas that are becoming top of mind of many executives across pension. And those are areas where pensions are still less confident in their capabilities, experience, and ability to manage this risk. So definitely non-investment risk is going to be an area where you can see a significant progress and ramping up of capabilities across the pension. So talking about non-investment risk, as you can see here, what is happening right now is the fact that the risk management and the risk function toolkit is still largely work in progress. But the good news is that organizations are really in the process of sharpening and expanding their risk management toolkit to generate additional risk insights. A lot of these risk management processes or activities are really, I would say, inspired or taken from the regulated financial sector around banks and insurance companies. That tells you that you need to put risk and control self-assessment in place across the organization. You need to have mechanisms in place to be able to identify loss and being able to remediate them. But also you need to adopt a little bit more sophisticated tool around sensitivity analyses, correlation analyses, or stress testing, or even reverse stress testing, to measure the operational resilience of organization to extreme stress events. Another point where organizations are focusing right now is around making sure that risk management is really integrated within core change management initiative. And this can be, for example, going through large technology transformation project, which comes with a lot of opportunities, but also a lot of risks into the build-up. The next trends here is around, obviously we're a world where every day we talk about artificial intelligence, technology, data, digital. This is really becoming part of our day-to-day vocabulary. Again, this is an area where overall, globally, pensions are fairly, let's say, lagging, in the sense that a lot of risk management process and activities are still very, what we can call manual, or based on, Excel sheet, PowerPoint, etc. Maybe less on the investment risk side, but still on the non-investment risk side. And there is an ambition from a lot of pensions to go into a little bit more technology adoption to support their risk management program, but also making sure that the risk management program is connected to other risk and assurance related activities. And this can be making sure that your risk management, your compliance, your internal audit, your business continuity planning, your data management are all connected into integrated solution. And ultimately making sure that you get as much data and intelligence into your risk management process to be able to support informed decision making. I think the last slide, which I'd like to focus on right now, are extremely important, because this is the heart of the investments or the pension funds, is the fact that risk management is actually fairly well integrated within the investment management cycle. And this is anywhere from total fund management down to the asset class and deal for both public and private market. So risk functions are commonly integrated, involved into this cycle. And of course, there is a little bit more experience into portfolio construction around private public market. In the area of private market, which is an area, we discussed about it earlier, a little bit more illiquid, pre-deal. A lot of due diligence is being done on the investment risks. Informal due diligence being done on the non-investment risk, although there are more and more consideration around cybersecurity, legal, regulatory, ESG, and financial crime, because obviously these, when you acquire these assets, they come with all these risks that ultimately may have an effect on the pension. Post-deal, this is an area where during the lifetime of the contract or the assets, where risk management activities are way less done. And we can see now, if you look into the headlights or news, that obviously a lot of investments can turn sour, coming from some of those non-operational risk area. So to conclude, I think this is really positive. This survey, and again, based on experience, I work with more than 20 pension funds globally. Risk management is extremely important. It's the other side of the coin of performance and achieving returns. And what we can see is that risk management is really taking more of a front seat in the way pensions are being driven and managed. Thank you.
Thank you very much. Now our third speaker, Dr. Sweeting from Saudi Arabia, Hasana Investment Company, which manages social insurance assets in Saudi Arabia. Please, Dr. Sweeting.
Thank you very much. First, if I could heartily recommend this app here. It's a countdown app, which tells you how long you've got. I think it could have been quite useful for some of the speakers today. So for my 12 minutes, I shall be covering risk from my point of view in Saudi Arabia. Now, my point of view is quite specific. I'm currently an advisor to the asset manager for the Saudi state pension scheme, Saudi Social Security Plan. I was previously a risk manager, head of risk there at the plan itself, and before that, chief risk officer for the asset manager. So that means my point of view is from a defined benefit plan, a funded defined benefit plan, and one which has a separate asset manager. And those things are all going to have an influence on the way in which risk is viewed. And it starts with the liabilities, because social security liabilities are not traditional defined benefit liabilities. They've got much greater membership, they're much broader, and they're typically still open, which means they've got a much longer duration and less maturity, so much less uncertainty, and also compulsion. You can make people join them, so you can make sure they stay young and less mature. And also you've got the ability for governments in extreme situations to reduce or alter the accrued benefits. So there is more flexibility in those liabilities. One thing you can't change so easily is the contributions to them in the same way you can with private sector plans. You need to stick with whatever you've chosen for a number of years. But all these things have an impact on what the investment strategy should be. And it's important to remember the assets are invested to meet those liabilities. But measuring how the assets are performing or how they should be set against the liabilities isn't necessarily straightforward, because measuring the liabilities isn't very straightforward, and also there's long time scales. That amount of discretion you've got means that you're often just going to want to take a lot of risk. So your answer is going to be, there is a lot of risk, both from the liabilities and from a return-focused investment strategy. So what this means is that you can often just take a long-term view on risk tolerance in terms of the assets. And one way of doing this is to use something called a reference portfolio, which is the cut-off point between the liability side of the equation and the asset management side of the equation. So the pension fund itself can say, I'm going to express my view on risk in terms of two assets: a liability matching asset, such as government bonds, and a return-producing asset, such as a liquid equity index. And I'm going to take that as my long-term view on what my target level of risk is, and then I'm going to give it to the asset manager and say, beat that subject to an acceptable level of risk. So you set the reference portfolio, ideally using asset liability modeling, but if you're taking just one decision, it's important not to try to boil the ocean on this. It's going to be perhaps a metric based on solvency or contributions or some other measure, but it could just come down to belief that we believe that a 60% allocation to equity is about the right level of risk that we should be taking in the long run. And as I say, the asset manager will measure their performance against reference portfolio. And they'll do this subject to a range of constraints, but these constraints will often be around something like tracking error. And you can think about a tracking error limit, a sort of a forward-looking volatility limit, as a bit like a piece of rope that you give to the asset manager. So the chief investment officer will say, that's great, I've got some rope, I can use that to pull up my investment returns above the reference portfolio. And the chief operating officer will try to make sure there aren't any knots in the rope so they can do their best job. And the chief risk officer will say, that's a nice piece of rope, I hope nobody hangs themselves with it. So tracking error can be used to both drive returns and also to limit the amount of risks which are taken. But it's important to attribute your performance to different sources, so you can make sure the returns are coming from the areas they're supposed to be. And you can also use this for third-party asset managers as well to make sure they're doing what they're supposed to be doing. But from the asset manager, from our point of view, from Hasana's point of view, the kind of attribution that we're looking at would be something like, how much return are we getting from our strategic asset allocation decision relative to the reference portfolio, a more granular long-term outlook? How much return are we getting from tactical asset allocation, those short-term asset allocation decisions that we're making? And how much are we making from active management itself, so often allocating to managers who will themselves try to beat the benchmark. So when you're looking at building a strategic asset allocation, which is going to be more granular, have a broader range of assets than the reference portfolio, there's going to be several aspects to it. There's going to be a risk-return part of it, there's going to be a liquidity part of it, and a stress testing part. So the risk-return part is, your starting point might be a traditional efficient frontier, which could be mean variance, it could be mean value at risk or conditional value at risk. Essentially it's going to be how we expect to do and the risk of it not going right. That's how an efficient frontier typically looks. And for this you need to have return distributions for all the asset classes, and constructing the expected returns has a big impact on the attractiveness of different asset classes. So you need to be aware that any kind of ALM is basically just telling you back what you've told it in terms of the assumptions, and treat it with that level of caution. Now, the returns range from very objective to very subjective approaches, but they should reflect key beliefs on where risk premia are available. And the key ones that we think of are things like market risk premia, typically equity markets, term premia, credit risk premia, liquidity risk premium. If you go into illiquid markets, there should be a premium for that. Also complexity. If you invest in an asset class which takes a lot of time and effort to do, there should be a reward for that. It's also important to look at liquidity, which is or can be a key component. And there's different ways in which liquidity can be an issue. If you're cash flow positive, does your allocation allow you to invest at the rate that you'd like to, given the amount of money coming in? If you're cash flow negative, are you investing in stuff that you can disinvest quickly enough to make your payments? So this needs to be a test on any allocation. There's no good being mean variance optimal if you're going to run out of money. It can be difficult accessing some assets as well, and this can affect the strategic asset allocation. So, there are some asset classes where to get the amount of exposure in those asset classes that you wanted just isn't feasible with good asset classes. Things like venture capital is a good example. The ticket size of our asset class is very small, so you might want to have 20% in venture capital. You're not going to be able to do it. And stress testing as well is an important aspect, and there's several aspects to this. The assumptions that you use in your efficient frontier analysis, you should stress those to make sure that your result isn't driven too much by your assumption set. You should also consider the implications of extreme outcomes, and you should also look at your SAA through a risk factor lens. So it's okay looking at things in terms of asset classes, but several asset classes might actually be driven by the same underlying risk factor, a broad equity risk premium. Does your SAA imply over-reliance on particular premiums or not? It's important to look at that. And also your liquidity projections that you're looking at, those should be stressed. You might not necessarily get the cash flows in from your assets in terms of dividends that you might hope for. Tactical asset allocation I've kind of skipped over because it's similar considerations to SAA. But the final part is choosing active managers. So the default approach, in my view, should be passive management. It should be cheap passive management unless there's a good reason to go for active management. The exception is illiquid asset classes like private equity and direct real estate, where you just can't invest in a passive way. But active management should be reserved for those asset classes where you've got a strong belief or good evidence that there is alpha available. And managers shouldn't be assessed just on their performance, but on whether that performance has come from their claimed areas of expertise, which is something I mentioned earlier on. Now, the final comments on this aspect is that all social security systems are different. Liability structures and maturities differ. You've got different currency constraints, different exposures to different assets, solvency levels differ. So these mean that no one social security system is like any other. But the principles here, I think, are applicable to a broad range of funded systems. Now, one of the reasons I did go through this quite quickly, I still have 3 minutes left on the clock, is so I could talk a little about defined contribution as well, because I think the considerations there are a little bit different, and they're mostly based around questions. So the first question you have to ask is, what's the objective? What are you aiming for here? Are you aiming for funds which will be annuitized at retirement? Are you aiming for something which will give a multi-asset portfolio, which will be used to generate income in retirement? Are you aiming for a cash lump sum, which people can use in part to pay off their debt? All of these things will drive what the asset allocation should be at the point of retirement. And the asset allocation at retirement and your risk return around that should drive what happens in the period before that. And then that should drive what your earlier allocations are and also what your contributions are as well. And I think all of those endpoints are valid. Multi-asset is a perfectly valid endpoint. Annuities also, I think, are a very valid endpoint. I mean, they're expensive because you're buying certainty, and certainty is a valuable commodity. And whilst typical annuities can be regressive, as we heard, I think there are more modern options available which take away some of that risk. Impaired life annuities, for example. Annuities which take into account the specific health status of individuals. So it shouldn't be completely discounted. The thing is, if you want certainty, it comes at a cost. So those, I think, are some of the, in a nutshell, some of the key considerations around the DC stage. But it all starts with defining your endpoint. So hopefully that was useful. I would hope that we would have some time for questions. If not, find me in the coffee break afterwards, and I'll be happy to discuss any of these points with people in more detail. And I finished 1 minute early. Thank you very much.
Thank you very much, Dr. Sweeting. Yes, and this relevance of this defined benefit scheme considerations to defined contribution scheme are very important, I think. Okay. Our next speaker is finally Ms. Tang. Ms. Tang is Director General of Bureau of Social Insurance Fund Regulation in the Ministry of Human Resources and Social Security of the Republic of China. Please, Ms. Tang.
Good afternoon, ladies and gentlemen. I'm honored to be here, introducing you the investment and the regulation of China's basic pension, basic old age insurance fund. Okay. Firstly, let's have a quick look of the multi-pension system in China. After years of reform, China has established a multi-pension systems. The first pillar is the basic old age insurance. The second pillar is annuity. And the third pillar is personal savings-based insurance. Today I will focus on the first pillar, the basic old age insurance. It includes two schemes. Let's have a look. Okay, you can see it. It has two schemes. The first one is for the is mandatory and covers the working group and the retired. It operates as a combination of social pooling and individual accounts. The former is pay-as-you-go model, and the later is a fund accumulation model. The fund mainly consists of contributions from the employers and the employees. The employers' contributions are deposited in the polling fund, while the employees' contributions go into his or her own individual account. The other scheme is voluntary and covers those non-working people aged over 60. The scheme operates on an individual account model, and the fund comes from government allowance, collective subsidies, and also individual contributions. By the end of last year, the population covered by the basic old age insurance has exceeded 1 billion, and the accumulated fund balance reached 7 trillion yuan, renminbi. Now let's move to the investment and the regulation of China's basic old age insurance fund. Before 2015, the fund could only be invested in bank deposits and the national government bonds. To address the population aging issue, the Chinese government has adopted a series of measures, one of which is the reform of market-oriented, diversified, and specialized fund investment. The purpose of this reform is to preserving and increasing the fund's value. And this form has several specific characters. Let's have a look. Yeah. The first character is centralized investment at the national level. provincial governments are allowed to entrust the surplus fund of the basic old age insurance to the National Council for Social Security Fund. And this is an organization similar to the CPPIB in Canada. And I think also similar to the, what's the name? The institution in Kazakhstan. What's the name? Okay. And for the government, for the provincial government, they are forbidden to make investment of the basic old education funds by themselves. If they want to make investment, they can only entrust it to the National Council for Social Security Fund. And the provincial government has the right to decide whether to entrust or entrust how much of the surplus of their basic old age insurance fund for the scheme covers the employees. For this scheme, the provincial government has the right to decide whether to investment and investment how much. But for the scheme covers those non-working people, the provincial government, they must entrust the surplus of the fund. It was stipulated in 2018 that all provincial governments should entrust at least 80% of the annual increase of the surplus funds of that scheme covers non-working people to the State Council for Social Security Fund. And the second character is market-oriented operation and management. The National Council for Social Security Fund adopts a combination of direct investment and entrusted investment for its operations. Direct investment involves the National Council for Social Security Fund directly managing and operating funds limited to term deposits and equity investments. For the entrusted investment, this refers to the National Council for Social Security Fund, entrusting funds to the selected insurance companies, fund management funds through public bidding process. So the investment the fund of investment has divided two parts. One, the National Council for Social Security Fund, they can invest by themselves, and the other part, they need to entrust to other companies to make investment. The third character is the diversified asset allocation. Investment, currently the investments of China's basic old age insurance fund are limited to domestic assets, including fixed income products such as bank deposits, bonds, and also equity products such as mutual funds, stocks, and stock index futures, national government bond futures. Investments can also be made in national major projects and infrastructure construction. Meanwhile, to ensure the liquidity, the low limit of the investment is set at 5%. To control risks, the upper limit of equity assets is capped at 30%. So the fourth character is the commitment to our guaranteed minimum return. During the corresponding period, the entrusted investment, the return rate is calculated as the arithmetic average of the annual insurance rates of book entry government bonds multiplied by the interest years. If the investment returns exceed the guaranteed minimum return, 90% of the surplus goes into the entrusting province, and the 10% is allocated to the provincial of risk. The fifth character is the risk reserve extraction. The National Council for Social Security Funds extracts 1% of the annual investment return during the entrusted period into the provincial of risk, and which is used to cover investment losses. When the balance reaches 5% of the net asset value of the entrusted basic old age insurance funds, no further withdrawals can be made. If the investment losses occur during the entrusted period, then the provincial risk will be used until the losses are fully covered or the reserve is totally used up. And the sixth character is the multi-sector oversight. The Ministry of Human Resource and Social Security and the Ministry of Finance oversee the investment operation of basic old age insurance fund, mainly by formulating policies, establishing rules, and conducting limited supervision, but not involved in specific management. The People's Bank of China, the National Administration of Financial Regulation, and also the China Securities Regulatory Commission oversee the financial activities of the investment of basic old age insurance fund, as well as banks, insurance companies, fund companies that participate in the investment and operation of basic old age insurance fund. I think the key to the implementing of the investment of basic old age insurance fund in China is the establishment of a trust delegation mechanism regulated by the trust law to govern the actions and the relationships of all parties involved. Trustee institutions constitute the core of the entire governance framework. Their responsibilities include signing arrangements with provincial governments, formulating investment strategies based on investment objectives and risk policies, selecting and supervising investment management institutions, and organizing both direct and entrusted investments, accounting and auditing information reporting and disclosure, among other duties. The National Council for Social Security Funds manages the basic old age insurance funds. As a trustee, without charging fees, with personal expenses and the like, guaranteed by the central government finance budget. Custodian institutions play a crucial role in ensuring the safety of personal fund assets. The responsibility of these 6 institutions include safeguarding pension fund assets, opening accounts for funds, securities, and futures, handling clearing and settlement matters, accounting, valuations, supervision, investment activities of investment management institutions, and providing business reports, among other duties. The annual fee rate for those 6 institutions' service is not higher than 0.05% of the net asset value of the pension fund. Under the investment management institutions, there are 22 such kind of institutions are responsible for managing investment portfolios and projects on behalf of the National Council for Social Security Fund, striving to maximize investment returns. The annual fee rate for the investment management service is not higher than 0.5% of the net asset value of the pension fund assets. Actually, we think the reform is quite successful. By the end of, you can see here, okay. Yeah, let's see this slide. Yeah, the first year, 2016, by the end of the first year, the scale, investment scale is only 0.31 trillion yuan. And by the end of last year, we can see the scale has increased to 1.62 trillion yuan. So it's a quick increasement. And also the investment return is also very remarkable. We can see, let's slide. In 2006, the annual investment income was 16 million yuan, and the annual investment return is only 2.74%. And the highest annual return is in 2020. It's 10.95. Since the end of 2006, the accumulated investment returns reached 267 billion, with an average annual investment return rate of 4.44, surpassing the average guaranteed minimum return rate of 2.93 by about 2.51 percentage points, and exceeds the inflation rate during the same period by about 3.44 percentage points. We think the reform has achieved the goal of preserving and appreciating the funds of value. I think the time for me it's also used. Okay, that's my presentation for today. Thank you. Thank you for your listening.
Thank you very much, Ms. Tang. Yeah, very informative presentation. Now the organizers texted me. Actually, one announcement is that next fourth and final session of the day to take place immediately after we finish our session. And also because we are behind the schedule, also the same suggestion as this previous session, maybe for time after finishing the next session, there will be time to ask questions personally to you after we finish formal meeting. Okay? Thank you very much again.
Good afternoon, dear guests and participants of our roundtable. We need a final effort to close this event. The topic of this panel is quite interesting. It sounds very general, what's the future of the system, but in my view, it should be limited to a particular aspect of the topic. Now we are witnessing the change of the behavior of the consumers. They want tailor-made services, and that's consumer-oriented, consumer-centered approach is very important. On the sides of who provide these services, in our case, the pension administration agencies, there is also a lot of changes, both internally as well as responding to this request or demand. We are talking about artificial intelligence, digitalization, robots, and that's where the today's presentation will focus on. The first presenter is Dr. Marie Briere, Head of Investor Intelligence and Academic Partnership at Amundi Institute. I would like to mention that Dr. Briere is the Harry Markowitz 2014 award winner on sovereign wealth and risk management, a framework for optional asset allocation or sovereign wealth publication. So I would like to give floor to Dr. Briere, please. We couldn't hear you.
Can you hear me now?
Yes, yes.
Okay.
Please go ahead.
So sorry for that. Yeah, so thanks a lot for this very kind introduction. I would like to mention that I'm sorry not to be able to be with you today because you had a great conference program with a lot of prominent speakers. So congratulations for organizing such a great event. So I'm going to share my screen. Let me do that immediately. Can you see my slides?
Yes, we see them. Okay.
Okay, excellent. So I'm going to talk about financial robo-advisors for pension savings. So how much does digitalization, as you mentioned it, change investors' behavior in the pension space, and what can be the promises of robo-advising services for pensions? So my presentation is structured around two important topics. The first one is how can robo-advisors improve pension saving decisions? And then the second part, I would like to discuss some of the remaining challenges. And in particular, you mentioned AI. What can be the role for artificial intelligence in the pension space, and in particular for robo-advice? All right, so as we are all well aware, financial decisions, and in particular for retirement, are very complex, right? And they are very complex for individual investors that are faced with all these uncertainties in making their asset allocation choices. And when we observe the financial decisions that these individual investors make, we can observe numerous biases. So typically, there is a low participation to the stock market, also very frequently an insufficient diversification of the asset allocation. Then we can observe some biases, for example, the domestic or familiarity bias, that people prefer to hold stocks that are very close to them, like employer stock, for example. And last but not least, people have typically very limited attention to their savings, and in particular for retirement. So they do not observe their portfolio very frequently, they do not rebalance, so there is limited time they can dedicate to pension asset allocation and savings. And that's all particularly true for investors having low financial literacy, so these ones are the more prone to these kind of investor biases. Then the big question is, in that environment, can technology help? And we had a new technology offered over the last decade called robo-advice, right? So robo-advisors offer a digital relationship that is direct. The client can directly interact with the platform of services. It's accessible at any time. It can establish a dialogue based on the client's project. It typically gives access to a wide range of funds and offers asset allocation advice, so how to structure a strategic asset allocation, plus also rebalancing advice. I will come back to that later on. The market for robo-advice is rising relatively quickly globally. It's about 1.5 trillion if we look at this worldwide, and it's projected to reach 2.8 trillion in 2025, according to Statista. So what is a robo-advising door doing? First, it defines investment goals. Second, it assesses personal preferences, for example, risk aversion, but also the personal risks in terms of income, real estate exposure, etc. And based on these investment goals and personal preferences, it constructs and communicates an optimal investment strategy, which is typically based on a simple optimization procedure, like, for example, a Markowitz optimization or a Black-Litterman kind of optimization. So nothing really fancy or involving artificial intelligence, but I would say some standard portfolio construction techniques. And then, once the strategic asset allocation is defined, alerts are sent, alerts to the clients, or the portfolio is automatically rebalanced when the asset allocation drifts from the target asset allocation. So when there are significant discrepancies between the asset allocation and the strategic one, the target one, which has been defined by the client. And here I mentioned that it can be either alerts or portfolio rebalanced, because that leaves me to the description of the different types of robo-advisors that exist in the market, and I think this is quite important. There are typically three types of robo-advisors as they have been defined by the European Parliament in 2021. The first one, the generic robo-advice, is in a way disappearing. I don't want to spend too much time on that. But the two last ones, personalized robo-advice and managed account, are very important and growing, I would say, in parallel. In the managed account model, there is no client involvement. So everything is delegated to the robo, and the investor has nothing to do. It's all done automatically. In the personalized robo-advice type of services, it's the client that makes the investment decision. Alerts are sent via email on the platform, and it's the client that remains the ultimate decision maker. So the individual is then at the core of the decision. It can choose to rebalance if it wants to follow the robo-advice, but it can also choose not to do so and remains the ultimate decision maker. So this kind of model relies on human interaction, and in my view is something quite promising. I will come back on that later. What are the promises of robo-advisors? The first is improved clients' knowledge and the possibility to personalize the asset allocation to the client's needs. There is often a very detailed questionnaire about the client's characteristics, their needs, etc. The second promise, very important, is a reduced bias in client's treatment. Human advisors are typically biased. There are a couple of studies pointing that, for example, that they do not treat, for example, young people or women like they treat older people or male. They are less well treated in a way. They are less asked about their personal situation. So that's one type of bias. And also it has been shown that they typically propose their own portfolio to the client. So they have difficulties to personalize to the personal circumstances of the persons. So robo-advisors really, in a way, are able to reduce the bias in clients' treatment. In practice, they're often used more by young people. So in a way, they can also reintroduce one kind of bias. Last promise, which in my view is maybe the most important one, is financial inclusion. Robo-advisors reduce the cost of serving and advising retail investors. And with that technology, we can probably reach people that are traditionally underserved by financial advice. They typically require lower initial capital, and they charge lower fees than human advisors. I would like to share with you a couple of results we had at Amundi with our own robo-advisor. And with a colleague who's professor at Toulouse School of Economics, we wrote a couple of research papers analyzing the consequences of introducing robo-advice
Dr.
in
Briere.
pension decisions. Yes?
Yes, you are not changing the slides. Yeah, it's just the initial page. Yeah, if you could.
Okay. So that's very strange because I'm changing. Let me try to share again my screen. Maybe I will share the entire screen and that will be better. Let me try. What do you see here? Can you see my slides?
Yes, impact analysis 1 of 5. Yeah.
Okay, good.
Yeah. Yeah.
Then,
yeah.
and
Okay.
here,
Yeah.
do you see another slide?
Right. Yeah.
Do you?
Now it's okay.
Now it's okay. So I'm sorry because you missed some of the pictures I was showing, so really sorry for that. All right, so let me share some of the results we found on a robo-advisor that was installed for pension decisions in employee savings plans that are managed by Amundi. So this kind of service was introduced in 2017, and it was proposed for employees having their retirement savings that were managed on the platform. And the way it works is quite simple. It was the robo-advisor was proposing a strategic asset allocation based on investors' profile, and it was sending alerts when the asset allocation that people had was deviating substantially from the one that was advised by the robo. So it's a kind of human-robo interaction types of robo, like the one I was describing before. In that study, we were comparing the behavior of about 15,000 people that took the robo service to a couple of samples of randomized people that didn't take the service, that we call non-takers. And we were comparing how these people change their behavior and what impact did the robo have on the performance, rebalancing behavior, and also the strategic asset allocation and equity exposure that people had. What we found is that first, the robo induces a significant asset allocation change. We found that in average, with a robo-advisor, people had a plus 9% in equities in their portfolio. So that's quite substantial because in these plans, the average equity exposure is about 15% only. So people have difficulties to invest in equities. I mentioned that in my introduction, and that's also true here. But with the robo, they were really willing to increase their risk-taking. Part was coming from equity funds and a large part coming from balanced funds. We found also higher net inflows, so that people were saving more with the robo-advice. So maybe they were more confident as well in their ability to make the right choices and then saving more. Interestingly, we also found that the robo was inducing dynamic rebalancing. So that's something very important because when you leave people without any advice, retail investors or pension beneficiaries typically do not rebalance their portfolio. So they basically sleep on their asset allocation, so they let their asset allocation drift through time, and that's certainly not a very good decision. I mean, we all know as professional investors that there is value to rebalance, meaning trying to come back to your strategic asset allocation by basically buying when the risky market has come down and selling what it has been basically rising. So this kind of mechanical rebalancing behavior can add value in the portfolio. What we found in this research is that individuals reacted quite nicely to the alerts that were sent to dynamically rebalance their portfolio. And with that, they were increasing their risk exposure when the subsequent risky regions tended to be larger. So they were gaining exposure in the risky assets when it was profitable to do so, basically, through this rebalancing mechanism. All in all, so if you look at these changes in behavior, so first, higher risky exposure, and second, dynamic rebalancing that was implemented, we observed an increased performance of robo-takers compared to the sample of people that didn't take the robo. And in average, it's about 3%, 1/3 due to an improved efficiency in the asset allocation and more risk-taking, and 2/3 due to the dynamic rebalancing that people have put in place with the robo-advisor. Last thing, we also measured the cost of letting people choose by comparing the actual performance of investors with a counterfactual performance that they would have if they were perfectly following all the alerts, right in time, exactly rebalancing when the robo-advisor was suggesting to do so. And we found only a very small cost, in average about 3 basis points, meaning that letting people choose, letting people, the ultimate decision makers, has no important cost for people. They are not implementing so many biases or making wrong decisions. They were good pupils in a way, and they were following quite nicely the alerts that were sent to the robot. And I believe that through that mechanism, because of these interactions between the robot and the human, there is a potential also for them to learn. And so robo-advisors can be also a tool for financial education. We'll come back on that later. Last but not least, on the impact, we've also found an impact on financial inclusion. We found that the people with the smallest portfolio were the ones that were the most impacted. So the less wealthy investors were the ones that had the largest increase in risk exposure and also the largest improvement in their performance after robot take-up. So I think I've shown a quite rosy picture of the benefits and the merits of robo-advisors, and they can certainly help in making individuals make better decisions, in particular for their pension savings. But of course, there are a couple of remaining challenges that we probably need to think about if we think going forward on the larger implementation of robo-advice in the pension space. The first important question is, how far shall we go into personalization? I mentioned that robo-advisors are able to provide an individual asset allocation that is customized to the individual characteristics, its preferences, etc. So that's certainly very good. But I think we have to be very careful that these optimal asset allocations that are designed can be very sensitive to these parameters, these characteristics of the clients, which sometimes are very hard to estimate. Take just the example of risk aversion, which is a crucial parameter if you try to design a strategic asset allocation. Risk aversion is very difficult to estimate. People do not know how much risk they want to take. And if you look at their actual behavior, they tend to reprofile frequently because they are not sure. They are not sure how much risk they want to take. It can also change through time depending on their life circumstances. But as you can see, changing parameters can have dramatic impact on the asset allocation. And we can thus reintroduce parameter estimation errors, which can lead to have very suboptimal asset allocation for investors. Another challenge is the question of trust. We know that there is what we call algorithm aversion. I told you that in our experience, for example, young people were less prone to take young people were more prone to take robo-advisory services. Older people have more difficulties to go into that. So we have to be very, very careful with the question of trust. There is a lack of trust in algorithms in general, not only in financial services. And I like this example from HSBC, a survey they did to retail clients, where they were saying that 19% say they would trust a robo-advisor, so it's a relatively low number, and 9% would be likely to use an horoscope to guide their investment choices. So if you put these numbers in comparison, it's quite striking. So this algorithm complexity is typically problematic for people that have low financial capabilities. They are also very frequently less likely to trust a robo-advisor. So trust is an issue, and how to build trust. I think there are two important ways to build trust. The first is to give people control. I mentioned that there are these two types of robo-advisory services: the managed account, where everything is delegated to the machine. Individuals have no decision to take. And there is this other version, other type of robo-advisor that sends alert and organizes a dynamic interaction between the human and the robot. And I think these kind of services can bring trust because people like being in control. There were a couple of experiments done, for example, with financial forecasters, showing that when people are in control, can modify the output of the artificial intelligence algorithm, for example, they are more likely to trust and use the AI. Another way to bring trust is through explainability. So that's something that supervisors are very keen to implement and follow. Explainability is the possibility to explain a prediction or recommendation, even if it's based on a complicated model. And of course, this can bring a better investment decision as well, because people might understand better what's behind the algorithm in a way, and might also be able to come back in control when something happens. That's something we saw, for example, for automatic vehicles. So if you explain the functioning of automatic vehicles, then the drivers are more likely to respond quickly when an accident occurs and take the control of the car. So that's something which is also implementable for financial advice. So trust can be also improved through dynamic interactions between human and robot. And for that, we could think of having chatbots, and that's certainly a place where we could improve a lot. So use the chatbots to explain the decision, to educate retail investors on financial decision making. There are already a couple of robo-advisors doing that. For example, Schwab has a Project Bear, which uses AI to predict when investors are under stress, for example. So when they are vulnerable and might be prone to decision mistakes. And then there is a human advisor calling when they detect that the investor is under stress, calling and reinsuring on the investment decision to help the retail investors making better decisions. So there is a lot we could imagine in terms of human-robot interaction that could help and facilitate good investment decisions. So to conclude, I would like to say that all in all, I think that robo-advisors are useful tools to advise pension beneficiaries, to design a strategic asset allocation, and also for dynamic rebalancing, something that we as retail investors rarely do by ourselves. It's time consuming, we don't think about it unless we are alerted about it. There is of course a big question of should the robots remain become complements or substitutes of human decisions. So we see that there are these two kinds of models that are implemented, either fully automated or something organizing an interaction with humans. And I think that the latter has a great potential because of the possibility to learn through human-robot interactions. The alerts can be used as a way to educate the investor on the way to allocate portfolio and possibly giving him more insight on how to design an asset allocation and save for retirement. And in that space, I see also large potential for generative AI, so these large language models such as ChatGPT. I mean, we are not there yet, of course, and there are a lot of risks that these kind of models pose, but in a way, their capacity to interact very smoothly with clients, with retail investors, would be a great value added for these kind of services. So with that, that concludes my presentation. If you're interested, we have a couple of research papers on these issues, so please don't hesitate to have a look at them. You have here the references. Thank you very much.
Thank you, Dr. Brière, for a very interesting presentation. And also special thanks for references. I think those who are interested could dive into this topic. Our next speaker is Dr. Raoul Rouget-Afrique, Social Security Development Branch Director at ISA. Doctor, are you with us?
Yes, I'm here.
Yes. Please.
Nice to meeting you. It's a pleasure to be with you. And unfortunately, couldn't participate in person, but I'm very honored to be in this event, and it's a pleasure. It's a pleasure to be with you in this session. And let me share my PowerPoint. Do you hear me well? You hear me well?
No.
No?
No, unfortunately not. Okay, we see you now. Please.
It's okay now? Okay. So I start. No, thank you for the invitation. It's a pleasure to be with you. Unfortunately, couldn't be in person, and I hope that next time they will be able to be with you and Kazakhstan. But in any case, I think it's an excellent session, and it's a pleasure to share these experiences. So let me share the PowerPoint. It's okay. It's the PowerPoint. It's fine.
Yeah, it's fine. Yeah.
Fine? Okay. So my presentation, it's about customer-centric and design and agile methodologies and in social security institutions. And the objective of the presentation is to present some experiences and new experiences on how to develop and advance customer services and using these new approaches in order to improve the reaching the different type of customers, different type of users. So the background of the presentation is the importance of service delivery. Service delivery is a critical function of social security systems for achieving effective collection of contributions, delivering benefits, the registration of workers, employers, beneficiaries, and also supporting the population in times of emergencies and crises. So if we think the impact that now service delivery, social security service delivery has in the Social Security Administration, and you will find out that it's one of the key areas that when it works well, it's a, let's say, it's a plus for the institution. When there are problems, this starts to become a problematic area. So service delivery, it's a key area in which institutions, social security institutions worldwide have been improving in the latest years. And the quality of service delivery, has an important impact on the effectiveness and the quality of social security services. So the better are the service delivery, and the better are also the higher are the impact, or the more positive are the impact. And there are some success factors for a quality service delivery, which are providing the right service to the right persons, also ensuring services effectiveness and reliability. And the last one that we would like to focus on, this because it's what we are going to address in the presentation, is that services should be adapted to customers' needs and characteristics. And this is what led to the idea of customer-centric service delivery, developing service delivery and service delivery options for different type of customers and to do them in a personalized way. So how does customer-centric and add value to the social security services? The first area of value is that it enables to better respond to the needs of the diverse groups. Now, in social security services, the institutions have to provide services to very diverse groups. For example, employers, for example, retirees, for example, different type of workers, employees, self-employed, and many countries also have geographic diversity, and there are also vulnerable groups that have to be let's say reached in a specific way. So it's important to address the needs of these diverse groups in a personalized ways. The third area of value of the customer-centric services is the possibility of using different channels, tools, and methodologies to expand the and the number of channels to develop what we call a multi-channel approach in order to enable customers and the different type of persons to interact with Social Security Administration in the way that it's better for them, is the most effective for them. And also the third part for customer-centric added value are the possibility to carry out different strategies, that customer-centric strategies that can help developing this type of services in a more efficient way. So this sounds very good, but on the other hand, there are also a number of challenges to implement these customer-centric services. Because developing them involves understanding the customer's needs and characteristics, and this we know that, when maybe we are talking about homogeneous groups, for example, employer for contribution collection, is something that is relatively feasible. But when we are talking about beneficiaries or different types of workers, it's more complex because of the diversity of all these persons interacting with Social Security services. And also the needs and the characteristics of these persons, of the different groups, and they may evolve in time. So this is a challenging point. It's also challenging to identify the effective channels to interact with different groups of customers. What is the best for different group of customers in terms of categories, in terms of age, in terms of personal preferences, and there we have all the diversity of counter-based in-present services, call centers, web applications, mobile apps, and also chat. Of course, the traditional human, but increasingly the intelligent chat based on artificial intelligence, etc. So it's important also and challenging to identify the most effective channel. Also, it's very challenging to involve customers in the design of Social Security services. And this is, many of you will say, whoa, this is really complicated because already developing services and systems and they're based on the internal specification, and it's complex. To do that is still the more complex. And traditional software development methodologies are very limited in this way. And of course, all that has to be done and compliant with the different implementation projects, schedule, and budget. So, talking about customer-centric development, it's interesting and has a lot of potential, but also has a lot of challenges. So let's have a look now to new approaches in terms of design and in terms of implementation that have been applied by some members and that show very promising experiences. So the first type of approach that helps for developing this type of customer-centric solutions is what we call the techniques that are called design thinking. So design thinking techniques enable to define solutions, to build solutions, and based on focus groups, based on groups that are going to co-design the different type of output. In this case, what we want to design, and it's a customer-centric and Social Security service. So design thinking and the process consists of mainly of these 5 steps. The first one is what we call empathize, which involves in doing interviews and seek to understand in a know and judgmental approach what the customers, what the persons, what the public, the Social Security public needs, and in terms of the services. The second step is to define the type of roles, the type of models, the type of profiles, and of the persons or the customers that the service has to be oriented to. The third is about ideating the solution, and the fourth is prototyping in order to have quick and preliminary approaches and solutions, and the fifth one is to test and if it works and how it adapts to the reality. So this approach of let's say of design thinking has shown to be quite effective in the development of these Social Security customer centric services. But when we are talking about developing a software solution, it's important also the productivity of the software, the development of the project development. And for that, there is another approach now on the IT area, on the software development area, which are called agile methodologies. And the agile methodologies are not universally agile, no, it's not automatic, no, it's not that they work quicker than the others, but they are called agile because they have shorter cycles and they try to deliver intermediate results, intermediate outputs, and in a shorter delay than the traditional methodology. So these agile methodologies basically emphasize cross-functional collaboration between the functional areas, the business areas, and the technical areas. So the idea is to work in cross-functional teams in order to co-create and co-develop, and of course each of them with different roles, and the customer-centric solutions. And the idea is to carry out an iterative test and learn approach with very short-term cycles in order to have quick results. And the idea is to allow teams to explore, fail quickly, and of course, correct course in order to respond to the lessons learned. So especially when developing a new type of solution, and these agile methodologies are also very appropriate in order to go quicker and to correct, let's say, from the experiences of the different iterations. So agile methodologies can enable an effective development of customer-centric social security services through design thinking. And this connection, of course, both techniques are interesting and by themselves, but the connection of the design thinking for the concept, for the definition of the idea of the services, and agile methodologies for the implementation, and it has worked quite well, and again in some of our ISA members. So let me show you, and let me share with you some experiences. The first one was developed by our Canadian members of Employment and Social Development Canada, and they developed a laboratory or a structure and approach for service transformation based on the design thinking and what they call the acceleration hub. And the Canadians colleagues, they would practice as a Award of Americas, not this triennium, in the previous triennium, and with this experience. And what they did is they leveraged a multi-channel approach for customer-centered solutions involving different departments in the institutions. Another interesting experience is in Morocco for members of CDG Prévoyance, who developed different tools, especially a multilingual chatbot in Arab, in French, using artificial intelligence, and to fine-tune these developments, they carry out customer-centric application development. As you see here, the picture, the image, they implemented this customized and design thinking approach that follows the 5 steps, but they customize them to their needs and to their type of project. I'm going to go quickly because I don't have a lot of time. I want to respect the time. The other experience I wanted to share with you is the one developed in Spain by the General Treasury of Social Security, which is an institution in Spain and responsible for registration, worker registration, and employer registration, and also collection of contributions. And the Spanish and the members, they have issues for the formalization of domestic workers, and because there were a gap between the traditional systems and this population group, and also the employers of the domestic workers. And so they developed a new portal, a new solution, and which follows a multi-channel approach, providing clear messages and saving time for all the individuals, the beneficiaries, and employers. And the development was based on multidisciplinary team, including the process experts, design team, and development team. These all experiences are documented. Really, I recommend also to have a look to the Spanish experience, because it's quite interesting in this sense. There are other experiences from Saudi Arabia that they developed now. They did a switch from project-centric to product-centric, adopting the product-centric delivery model, and also they achieved a process enhancement involving customers. And colleagues in Finland and in Malaysia, they also they focus on developing multi-channel services and improving the efficiency of delivery. Now, some conclusions to finalize. So customer-centric service delivery allows providing quality services to challenging population groups. And this is an important point, because nowadays most of the institutions, they have e-services, they have mobile services. Of course, they differentiate what is contribution collection, service delivery, the most important categories of services. But when we are talking about the same type of service to different type of population groups, this is more difficult, and also for institutions are reluctant on and carrying out risky projects in order to have eventually a marginal improvement and with some population groups. So this type of approach of customer-centric service delivery based on the techniques that I presented to you has worked very well and some institutions so, and it's really interesting to have a look. And the combined application of the same thinking and agile development methodologies have shown to enable and to improve the efficiency of the implementation of these new type of solutions. And from the ISA, we support you, we support ISA member institutions applying this type of advanced techniques. And through articles, reports, guidelines, but also webinars, seminars, participation in conferences like this one, another conference that we organize usually. So let me also share with you the relevant guidelines and for this topic, which are the guidelines on technologies, also the guidelines on service quality, and the guidelines on human resource management, because they also involve the digitalization of the staff. And I think that I'm okay with the time, and I hope that it was interesting with you, and that you can have more material at the ISA website. Thank you.
Many thanks, Dr. Raul Rugia-Frick, especially for practical experiences in different countries of customer-centered services. Our next speaker is Brian Lee Archer, internationally recognized independent advisor at social security and digital transformation. Please, Brian.
Dobro večer. Brian.
Good evening. My name Brian.
Turn to English. Look, thank you very much and to the United Accumulation Pension Fund and to the ISA for the invitation to participate in this event. And it's been a pleasure being here today, and it's been really enjoyable, some fantastic presentations. It's been a long day, and so hopefully a little bit of discussion around artificial intelligence will be enough to lift us up and send us home or wherever we've got to go after this, feeling good about the day. Look, it's been a pleasure to be here in Almaty. Almost to the day 30 years ago, I landed in Almaty as part of a World Bank mission. And in fact, I was en route to Bishkek in Kyrgyzstan, where I led 3 technical assistance missions on social sector reform. Almaty was sort of a transition point for all the World Bank teams coming in and out of the region. So I came through Almaty many, many times. So it's a real pleasure to be back here 30 years. I was very young then when I first came here. And I've also had the opportunity to be, the last time I was in Kazakhstan was in Astana in 2018, which was the ISA, technical forum for ACT. So again, it's been great to see, and at that time I could see Kazakhstan and the social funds were starting to present a lot of the great work they were doing with e-government platforms. So yeah, it's really interesting being sort of the tech guy at an event like this, surrounded by lots of experts in policy and risk management and investing and whatever. And you think, wow, how can I, what's the tech guy doing here? And the thing is I'm here to talk about artificial intelligence, but I'm going to do something a little bit different because Raul, my good friend Raul Rugia-Frick, talked about agile. So because I've had a long day, I'm going to be agile as well. So I'm going to change the way I do this presentation, and I'm going to go to the end. Because it has been a long day, and when you leave, at most there's only 3 things you're going to remember. So why don't I help you with those 3 things without giving you all the presentation, because you can read that later. To start off with, the 3 things I want you to remember, to take away, when we're talking about artificial intelligence, it's all about data. It's data. Don't worry, forget about the technology. What matters is data. And that data is your data. And it's your citizens' data. It's really valuable stuff. And you've really got to be careful with it. Remember, it's all about data. The second point I want you to remember is we're now putting the focus on policy makers. I've spoken at many of these types of events over the years, and the focus from the technology angle has been on service delivery, making claims online, making contributions, all great stuff, and having e-government platforms. And we've seen terrific progress all around the world. Policymakers, when the tech guy usually stands up at a conference like this, policymakers think, this doesn't affect me. Technology is not something I need to worry about. I mean, I use technology, I use my spreadsheets, I use my statistical packages, R or whatever to help me do my analysis. But as a policymaker, my job has not really changed in 40, 50 years in how I go about doing policy. In many cases, it's more artistic than it is evidence-based. So artificial intelligence is now really creating an opportunity here, and my advice to senior people in your organisations is to be talking to people in IT saying, I want this to help our policy development. Because what I've heard today have been a whole range of really complex policy questions. And the one that keeps coming through is things like pensioner poverty. It's great to have a well-managed pension fund, but at the end of the day, what really matters is, when people retire, how are they going to live? Have they got enough to live on? Some pensioners won't. So there needs to be some other policy responses to unite and bring this all together. So point one, it's all about the data. Point two, the data now is something for policymakers, and this is where they should be looking to bring AI right into their daily working lives. They're the ones who have really got to get across this. Point number three is really simple. Go back to point number one. It's all about the data. With that, I'm finished. No, I'll give you a little bit more detail. Look, what I wanted to really, in the presentation, you can get more you'll get the detail. But in terms of when we hear AI, remember this is the tech industry, which I've been part of for many years, in big multinationals, IBM, SAP, Accenture. This is the tech industry in overdrive. There's a lot of hype out there about what AI is. It's a collection of a massive pool of different types of technologies. When the one that's right in front of us at the moment, and was spoken about before by Marie Briere, ChatGPT. Fantastic, great tool and whatever. But do you know about the data that ChatGPT is using? Do you understand it? Where did that data come from? So it keeps coming back to the three things I asked you to remember. When you're using ChatGPT, as I said, I used it a few weeks ago to write a poem to somebody who was leaving the organisation. I've never written a poem in my life. ChatGPT wrote me a fantastic poem. Didn't really matter in terms of its quality. But if I'm going to use ChatGPT to help me write a policy proposal, I need to understand where the data it's using and where it's coming from. So AI, as I said, it's a very broad term. It's here. And of course, the title of this presentation was around, is it friend or foe for Pension and Social Security Administration? Of course, the answer is it can be either. And it certainly can be a foe. And again, if you are not across your data and you're just feeding data sets into AI algorithms and you don't really understand where that data came from and its quality, then you are really putting yourself and your organisation at great risk. But the opportunity side is enormous, because by really getting into the data, we can get beyond the correlation that a lot of our statistical analysis gives us and finding correlation, but actually getting into causation, getting right down into the detail. The sort of thing that, of course, researchers, and we saw some of the examples of that today, research that's over many years will work through different types of data and try and bring it all together and link it and make all those conclusions about what was the causation. But they're often using data from several years ago, and it takes them many years to get to the answers. Whereas we've now, again, through artificial intelligence, we want to be asking those policymakers to be able to come up with those conclusions in a much faster time. So the productivity benefit we're looking for is not that we can process a claim quicker, because we can already do that pretty well. We actually want to get good evidence-based policy quicker. Evidence-based policy that's really addressing those really complex problems that we heard about quite regularly today. Because one of the things in terms of the social protection system, because it has many pillars, and we've heard about pillars of pension, because there's pillars of social protection across all the different risk categories. And of course, focus today has been on retirement or age. But of course, people's lives go through the life course. They pass through, and different stages of their life, they're touching different parts of the social protection system. Now, the social policy that sits behind each of those pillars of social risk have served us very, very well. Old saying, don't throw the baby out with the bathwater. But we do need to have policy responses that are able to cross through those different pillars, because people's lives are complex. Now, AI, and certainly ChatGPT and those things, do not understand the complexity of human life. And so the reality is, going forward, is we're not looking to replace our policymakers. We just want to give policymakers superpowers. And the superpowers comes from using something like AI, augmenting their capability. So instead of having to do 3 years research and sort of a master's or PhD level thesis to really understand a problem, we're actually able to compress that, because policy responses need to be much faster and much more supported by the evidence, rather than just populist responses by the politics of the day, which of course will always keep happening, but at least from a policymaker's perspective, you want to be in the position where you've got the evidence to support your argument. So what that leads you to then is, as we go down the AI path, one of the things you need to really be thinking about is the responsible and ethical use of AI, because it's your data and your members' data, your citizens' data. And of course, the only people who will be able to make those decisions around responsible and ethical use is you. And that's a big responsibility. And that's the thing around with AI. With great power comes great responsibility. A quote attributed to quite a few people in history. I like to refer to Spider-Man. There you go, that was the message for Spider-Man when that comic was issued, when they started in 1962. But that was the message. And with the fact that we've got all this personal data, we've got all these algorithms processing this data, it is enormous responsibility on you as administrators of social security systems. And as they say, nothing is risk-free. We've heard a lot about risk today. Nothing is risk-free. No risk-free investment. There is no risk-free use of technology. And what we're seeing, and what AI is really opening up, is a great leap forward, but there's a corresponding great leap forward in the risk. That's not a reason not to pursue AI. It's just a reminder that the risks are there and we really need to be very conscious of them and manage them very carefully. And in the paper, and certainly in some of in the reading material that I've referenced in the presentation, there's some really good case studies and examples where things can go off the rails and with some disastrous results. So really, what I wanted to just finish with then is how do you win, you know? And really, it's about harmonizing and connecting digital data as a foundation for insight and knowledge. So data is data, you know? I mean, you think about the investment board of, or the, one of the business ministries here in Kazakhstan, they would probably keep a record of how many international conferences are held in the country in a year. Very important to, we have 150 international conferences, of which this is one. They count them probably. But what really matters is who was here at this conference? What was it about? What were some of the findings of it? This is examples of what we call metadata. Often we just collect information that says there was a conference and we counted it. All the information that really gives you the context about this conference, this event, is often lost. And so when you're a policymaker and you're grabbing data sets to be able to start doing your analysis, often all the metadata, or large parts of the metadata, have been stripped, have been lost. And so often, as a policymaker, when you are trying to make those really important connections and linking, you're flying a bit blind. That's why the researchers take 3 years or 4 or 5 years to, to really get to the nut of a problem. So what we're doing, this is where the effort around AI should be focused on solving those problems. How to make those linkages between all these different sets of data that actually then start to give you a picture of, say, a person's life course. So we heard a lot about the gig workers today. And again, count the gig workers. Yep, 20% of people are in the gig economy. Great. I've got a data set that tells me there was this many gig workers. But where's all the information that tells me what type of, when was this collected? Who collected it? How reliable is that data? If I'm going to start using that in some sort of algorithm to, provide some sort of extra support to gig workers, how well do I understand that data set? And most of the time, I really don't know much about it at all. I just grabbed a data set. It was given to me by the Statistics Bureau. It was given to me by, someone else in the policy department. Yeah, this is a great file with lots of data to use. Great surveys were done. So I just want to finish then with, it is about looking for knowledge and insight from your data. That's what AI can give you. And that was what will help you address some of those really complex problems. And I have a quote there from a colleague of mine, Alfonso Lara Montero. He's the Chief Executive Officer of the European Social Network. I think he summed it up really well. He says, as the use of technology continues to evolve, it will be important to strike a balance between leveraging the benefit of digital resources and upholding the core values of the social services sector. By embracing technology responsibly, social services can harness its potential to improve outcomes, enhance efficiency, and promote inclusivity while safeguarding against potential risks and biases. And that will happen by people such as yourselves having the superpowers that AI can give you, augmenting your capability to start acting and operating like this. So thank you once again for the invitation. Remember the 3 things: data, it's about policy now through AI, and then it's all about the data again. So thank you very much.
Thank you, Brian. You shared very important thoughts in such a light manner. And our next speaker is Eric Chen, the Executive Director of Mandatory Provident Fund Schemes Authority, Hong Kong, China.
Thank you, Emma. This is Eric Chang from the Mandatory Provident Fund Schemes Authority of Hong Kong, China. Can you hear me well?
Yes, we see your presentation. Please go ahead.
Okay, thank you. It's my pleasure to join this international high-level roundtable today to exchange valuable insights with experts and delegates from all over the world on experiences in improving retirement protection systems in their respective economies. The presentation just now on robo-advisors, customer-centric design and AI are all very fascinating. And I hope that my presentation will add a useful perspective to this discussion. In today's rapidly changing world, the role of technology has become increasingly important. It has accelerated digital transformation across different sectors, making our lives more convenient and easy. The MPF system is no exception to this mega trend. And recognizing the need for change and improvement, Hong Kong has commenced a journey of developing the eMPF platform, which is a groundbreaking digital platform that will reshape the scheme administration model of the MPF system and deliver better retirement protection for our working population. So to give you the context for the development of the eMPF platform, let me just begin by giving you a brief overview of the MPF system in Hong Kong. I'll be quite quick. And with reference to the World Bank's multi-pillar retirement protection framework, the MPF system is modeled primarily on Pillar 2 to provide basic retirement protection for our working population. And this is intended to work together with other pillars in the multi-pillar framework, including Social Security Program under Pillar 0 and individual savings under Pillar 3 and public housing and public healthcare under Pillar 4. This slide shows you the key features of the MPF system. The key benefit of the MPF system as a privately managed system is that it's fully funded and with defined contribution. So this arrangement ensures financial sustainability and eliminates the risk of shortfalls of assets as seen in some defined benefit schemes elsewhere. So MPF schemes are operated by trustees approved by MPFA. Each MPF scheme offers a wide range of funds to its scheme members. So to facilitate enrollment and contribution, employees are mandated to join MPF schemes arranged by their employers, but they are free to choose from the range of funds to construct their own portfolio to suit their investment needs based on their life stages and risk appetite. So the key challenge to the MPF system as a privately managed system is really the operation under a decentralized landscape, where each trustee operates its own scheme administration system, which is independent from each other. Here are some statistics illustrated the decentralized landscape. So we have 13 MPF trustees offering 27 schemes with 415 funds, and these collectively serve 4.7 million scheme members. Total assets accumulated under the MPF system has exceeded 1.1 trillion Hong Kong dollars, or 142 billion US dollars. So in terms of asset allocation, equity funds and mixed asset funds collectively represent more than around 80% of MPF system's NAV, and they are the most popular choices among scheme members. So this slide shows you a history of the average fees of MPF funds. So because MPF is privately managed, the level of fees charged by MPF trustees has always been the focus of the public, especially when our net asset value continues to grow. So over years, significant progress has actually been made on lowering fee levels. So the average fund expense ratio has come down by more than 1/3, from 2.1% in 2007 to 1.32% in mid-2023. But the members of the public consider that we can do more, and we agree. So according to our research, scheme administration is the biggest cost driver of the MPF system. So out of every dollar collected by trustees as fees, around 40% would go to administration. So improving scheme administration efficiency can really save a great deal of money for our scheme members. So in the next few slides, I will discuss how the eMPF platform will achieve this goal. As mentioned just now, MPF schemes operate in a decentralized model, The multiple business models, data standards, process designs, and system infrastructure for scheme administration have made it difficult to achieve standardization and cost economies of scale. The digital take-up rate among the employers is less than 50% at present, and it already received a boost after the COVID pandemic. To make this worse, 65% of some 30 million MPF scheme administration transactions per year are paper-based. So this contributes to higher administration costs and lower efficiency of the MPF system. The eMPF platform is designed to be a one-stop common electronic platform for scheme members to manage their MPF account across multiple MPF schemes through online and mobile applications anytime, anywhere. I emphasize across different MPF schemes because of in Hong Kong, the labor mobility is really high. So our workers change job maybe once every 2 years. And so over the years, many MPF accounts will proliferate across the account. So it's really important to have a facility for them to reconnect with all their accounts so that they can actively manage their assets. So the eMPF platform will operate as a not-for-profit public utility by a wholly owned subsidiary of the MPFA. And it is expected that after the implementation of the eMPF platform, the digital take-up rate will gradually go up to 90%, and thereby vastly improving the efficiency of the scheme administration. So by centralizing, standardizing, streamlining, and automating scheme administration processes, the eMPF platform promises to reshape the ecosystem of the MPF system. At present, MPF services has 4 key elements: investment management, trustee services, asset custody, and scheme administration. So by taking care of the scheme administration centrally, the eMPF platform will allow the MPF industry to focus on competing the other 3 more value-adding elements. And this will lower the barrier for market entry, as potential entrants into the MPF system will no longer need to invest a lot to build up a large administration system. As we can see from this slide, the eMPF platform will allow scheme members to perform a comprehensive range of functions. So for instance, scheme members can access account details, make enrollment, switch funds, and consolidate accounts in a real-time, safe, secure, and paperless mode. They will therefore benefit from shorter processing time for managing their MPF savings and have a much better experience. Employers can also handle their contributions through this electronic platform. Standardized and automated scheme administration processes can reduce paperwork, human errors, and inadvertent delay in contributions, which would result in financial penalty. This is a timetable of our project. According to the current progress, the migration of MPF account information from the existing trustee systems to the eMPF platform is expected to commence in the second quarter of 2024. The whole onboarding process is expected to complete in 2025, and by then the whole system will be fully operational. All in all, the eMPF platform will lead to a better user experience and improve significantly the operational efficiency of the MPF system and create room for fee reduction. You create a win-win-win-win-win situation for our employees, employers, self-employed persons, trustees, and MPFA as the regulator. Given the limitation of time, I just zoom in the benefits brought by the eMPF platform to our scheme members. So fee reduction will be the single most important deliverable from their perspective. In the first 2 years after implementation, the scheme administration fee is expected to reduce by 30% on average. And the cumulative quantifiable financial savings from the eMPF platform will be up to $5 billion over a 10-year period after the full implementation of the system. As a major financial infrastructure, the eMPF platform will also open up a lot of opportunities and pave way for next reform initiative for enhancing retirement protection provided by the MPF system. A case in point is the government top-up contribution for low-income workers in the pipeline, which will leverage on centralized data provided by the eMPF platform. So to conclude, the eMPF platform is a groundbreaking transformation of the MPF system, and it will surely deliver better retirement outcome to the working population in Hong Kong. So thank you so much for your time, and I thank again for inviting me to this conference.
Thank you, Mr. Chen, for a very detailed description of eMPF platform, its benefits. This presentation concludes the list of presentations for today. So if the audience have enough energy to ask questions or make comments, you're welcome. In that case, I will share my thought, which came after all these presentations. What future awaits us? Will it be a dystopian one where global AI will provide pension schemes to retired robots? Or maybe not. I wish in the future, not only pension administrators, but the governments in general will be customer oriented, and their policies will be to provide better services to all citizens. So on that, I would like to thank all our presenters and all of you for taking your time till the final moment of our conference. Thank you, Unified Pension Fund, for this organization. Thank you.
Thank you. We have finished all the sessions. Thank you for all speakers and moderators for great job. And now we would like just to remind you that we are having dinner tonight at 8 o'clock, yes? It's still at 8 o'clock, yes? At 8 o'clock, 8 p.m. here at the same place. Thank you.